It is 9 a.m. on Thursday, April 1st. Be careful out there today, folks. Beware of press releases from German auto giants. This is Yahoo Finance Live. I'm Julie Hyman with Miles Udland and Brian Sassi. Thanks for being here. Let's take a look at stock futures here this morning as we kick off the quarter. Nasdaq futures indicating a higher open and leading the way upward here, almost a return to the mean, at least if you looked at the mean for late 2020. The Dow and the S&P futures, though, are also showing strength this morning. Building back everything, seemingly, President Biden's infrastructure proposal takes broad aim at transportation, education, manufacturing, healthcare. Will assess the tension points for Congress. Electric vehicles are also in that plan. What about autonomous driving? We're going to catch up with Austin Russell of Luminar about how close we are to real autonomy behind the wheel. And turning stimulus checks into sneakers, we'll hear from the CEO of Foot Locker about the hottest kicks and selling trends as we hopefully emerge from the pandemic. But we do start with that big infrastructure proposal. And for details on that, we go to Jessica Smith in Washington. Not just details on that, but what happens now, Jess? Because this is only the beginning of the process.
Yes, it is definitely just the beginning. This proposal now has to be turned into legislation, and the Biden administration and Democratic leaders have to get enough lawmakers on board. The White House says that it is already reaching out to Republicans, and we heard the president say yesterday there is no reason this could not be bipartisan. He is making the case that this is a once-in-a-generation investment in America that will make sure the U.S. remains competitive globally. But Republicans and business groups argue that raising the corporate tax rate to 28% will make the U.S. less competitive. We heard from Minority Leader Mitch McConnell, who called the infrastructure plan a Trojan horse hiding tax increases. President Biden addressed the pushback that we're seeing from business groups and Republicans about raising the corporate rate yesterday. Let's watch.
No one should be able to complain about that. It's still lower than what that rate was between World War II and 2017. Just doing that one thing will generate $1 trillion in additional revenue over 15 years.
Now, there's also some pushback from progressives who say they like what's in the plan. It's a good start, but it needs to go further. We heard from Congresswoman Alexandria Ocasio-Cortez, who said the U.S. might need to spend something like $10 trillion in 10 years. Now, remember, this is the first of two long-term economic recovery plans from the White House. The next one is set to be released at some point this month. It will be called the American Families Plan, the president said yesterday, and that is going to focus more on education, child care, and health care. Miles and Julie.
Thank you so much, Jess. So again, not just the beginning of negotiations, but beginning of other ambitious plans to come from this administration. Let's talk to a representative of this administration. And I should mention, as we have this discussion, the backdrop for this is the jobless claims numbers that we got this morning, ticking up to 719,000, higher than estimated, breaking above 700,000 once again as well. These numbers are noisy, so to speak. There is allegedly some fraud in the numbers. There's also a lot of seasonality. So take them for what they are. But we, of course, are still getting a monthly jobs report tomorrow. To talk about all of this and what this new plan from the administration could mean, Heather Boucher is with us. She's a member of the White House Council of Economic Advisors. Heather, it's good to see you again. You know, as we hear Jess talk about the sparring that now begins about this plan, with such a big, ambitious plan, how are you viewing the sort of core, most important, deal breaker parts of it that really are the most important to you?
Oh, that's such a great place to start. You know, after spending so much time thinking and working on this and understanding just how important all of these pieces are to the American people and to our economy, it's hard to pick just one. But let me focus on a couple that I think are really pivotal. You know, we know that the United States has fallen behind in our investments in infrastructure writ large, defined broadly across our economy. And we know that in order for us to remain competitive as we move into this 21st century, we need to make up for the fact that we are falling behind, not just in investing in physical infrastructure, but in human infrastructure and in ideas and in innovation. If we want to be competitive, if we want to be that innovative leader, these are the kinds of investments that we as a country need to make. So I'm particularly excited about the investments in research and development. I'm excited about the investments to own the electric vehicle industry, those investments in battery technology, and in making sure that we have those charging stations all across the country so that we can be a leader in what we know will be a really important technology that's going to drive the future of automobiles. And I'm really excited about the way that the whole package thinks about economic resilience, both in terms of climate change, but also in addressing the families, the needs that families have for the kinds of care infrastructure that's included in this package.
Heather, what we didn't hear yesterday is how much taxes on households may go up to help pay for this plan. Is that 400,000 mark that President Biden has cited repeatedly, is that the red line in the sand here?
That is definitely, it has been the red line. It continues to be the red line. It is a priority of the president. The tax package that was announced as a part of the American Jobs Plan, the Made in America tax plan, focuses on corporate profits. And what it does is it seeks to readjust our corporate tax system to focus on making things here in the United States, to not encourage firms to shift their profits overseas or to shift their production overseas, and to make sure that we have a tax system that is fair and taxes those excess profits from those most profitable firms in our economy so that we can make these investments that benefit every firm in America, that benefit every family in America, the kinds of investments in basic R&D, in roads and bridges, transportation, safe drinking water, a power grid that doesn't fail. All of these benefits that are included in the plan will benefit firms across our economy.
Heather, it seems as though there is some moderate willingness perhaps to wiggle on that corporate tax rate, but maybe not to 28%. What could the administration live with in terms of an increased tax rate, but maybe not that high? Would it be 25, say, as a compromise point?
Well, so the president has been very, very clear, and he said this in the speech yesterday, that this is the opening bid. This is where he is starting the plan that he has put together that started on the campaign, and he wants to hear from people. He wants to hear from folks on both sides of the aisle. The team is out meeting with people, listening to them, so that we can make sure that the package really meets the needs of the American people. But like with the American Rescue Plan, the goals are clear. This package needs to make sure that it addresses the urgent and important needs in front of us.
And, Heather, along those lines, thinking maybe more philosophically about how, fiscal policy gets done now and going forward, there was such a focus for so many decades on, everything needed to be paid for and how you balance all of these plans. Just in your conversations, kind of as a team and also talking to lawmakers, is there now a view that we don't need to account for every last dollar because over time, these things will pay back, not to mention the fact that markets are obviously quite amenable to additional deficit spending from the U.S. government?
Interest rates remain at historic lows, which provides the federal government with a lot of opportunity to make the investments that we believe are the most economically important for America's long-term competitiveness, to grow America's middle class. So I think that's where we start. It is also the case that the tax plan that was laid out yesterday is in the best interest of our economy. It addresses fundamental distortions that were introduced as a part of the 2017 Tax Cuts and Jobs Act that encouraged profit shifting, that encouraged firms to move overseas. And so there's both good reasons to implement this tax package, and there's good reasons to make sure that the necessary spending that we need to do happens, even if we can't quite match every single dollar. But the important thing is that we need to focus on what is going to be best for the American people, what's going to grow the middle class, and what's going to enhance the long-term competitiveness of our economy, and making investments in infrastructure and making sure that our tax system is fair and just and encourages investment here in the United States. Those are the goals.
Heather, we talked to a good number of CEOs here at Yahoo Finance, and they universally say we need an infrastructure plan. We're on board with it, but we don't think a 28% corporate tax rate is globally competitive, and we might pull back on our investment plans. What's the administration's message to CEOs?
Well, what we've seen is, really in recent decades, we've seen tax rates fall. We saw that very sharp cut in corporate tax rates as a part of the Tax Cuts and Jobs Act. And what the research evidence has shown is that you actually did not see a strong burst in investment due to those tax cuts. So I think the question that we need to ask of the American people and American businesses is we need to make these investments. We can't have bridges falling down. We can't have lead in our water. We can't have power grids that fail. We need to make these investments, and we need to focus on a pay-for that makes sense and that taxes those that are making the most profits, that are benefiting the most in many ways from the magnificent resources of our country, both in terms of the physical infrastructure, the human infrastructure, and the natural resources. So that I think is the administration's response to that really important question.
Heather, great to see you. Thanks for being here. Heather Boucher is a member of the White House Council of Economic Advisors. I appreciate your time this morning. And we are going to take a quick break. When we come back, we'll have the latest developments on coronavirus, including new research on how long immunity lasts following the vaccines.
All right, welcome back to Yahoo Finance Live on this Thursday morning. The race to vaccinate the population against COVID-19 continues here in the U.S. And this morning, we got some positive news on Pfizer's COVID-19 vaccine. Yahoo Finance's Anjali Kamlani joins us now for the latest on this story and all the developments in the COVID fight. Anjali.
Thanks, Miles. Yes, so Pfizer let us know this morning that they have completed observing their phase 3 trial participants for 6 months, which is what was required by the FDA in order to move ahead for full approval. So they're now in a good position to do that. And what they observed was that in the 12,000 adults, they saw 91.3 efficacy reported, which means that among the participants, even those who were vaccinated, some of those did get COVID-19, but there was only one case of severe disease, so it remains pretty strong. Also saw strong results against the South Africa variant in the trial participants there against that B.1.351 variant that is prevalent down there. So all really good news and puts the company in a strong position to apply for full approval of this. And that will move them forward to being able to market it and be able to expand where it is delivered. Meanwhile, we also heard from Johnson & Johnson some concerns there about a plant run by Emergent Biosciences that is producing the Johnson & Johnson vaccine. The New York Times reported late yesterday that plant did run into some trouble on a batch based on human error. But what it is apparently is just not an authorized plant right now. So that batch will not immediately affect doses that are supposed to be committed in arms. The company did say in a statement that plant did run into the errors based on a quality control process. And so for right now, it's not authorized. And so those doses will not be affecting the future. It remains unclear what will happen after April, because that's the latest that we have information on the commitment of doses from Johnson & Johnson. Meanwhile, some more good news in the testing space. We know that rapid antigen tests are really one of those things that everyone is looking for, more widely accessible in order to reopen public spaces like schools and offices, et cetera. Abbott is now out with their Binax now. That's the same rapid antigen test that was bought by the government for about $5 each and sent around to nursing homes. So those are now going to be available in stores in quote unquote coming weeks. The company has said that while it has not set a price just yet, it does commit to putting it into the single digits of dollars. So it would be a low cost option. Right now, we know that some of those that have been approved by the FDA for over-the-counter, no prescription, are in the double digits, low double digits, between $25, $30, et cetera. So this would likely be one of the lowest out there. Guys, back to you.
All right, and Anjali, we see the B-roll there, I guess, of how that at-home test works. I haven't taken one yet, so I guess I'll figure it out someday in the future. I just want to quickly follow up on the J&J news, because I think it caught everyone's attention, and there's always concern when you see human error essentially spoiling 15 million doses of the vaccine. I made the point in our meeting this morning to the team that, well, we're vaccinating like 20 plus million people per week, so what's the big deal with 15 million doses? But what's the read-through here, I guess, on the risk to the vaccine supply chain? Is this a J&J specific issue, or are there other concerns with Moderna and Pfizer's vaccines that we should be more aware of or more cognizant of or be more guarded against, I suppose?
Well, in general, the vaccine production process has been, we've seen some delays based on other issues. It is an easily error-ridden process. But what we do know is that, number one, the 15 million doses was not confirmed by Johnson & Johnson. They actually did not give a number, saying that the New York Times is the one that reported that number. And it's based on the biologic process. You can't exactly figure out the doses, you can estimate. But on that note, the doses that we're currently getting from Johnson & Johnson are from the Netherlands. So it's not disrupting that throughput to what we're getting over here. We're relying on that plant for right now, but this could have been, a more long-term future out. The same plant is also working on AstraZeneca doses as well. And we know that those aren't authorized yet in the US. So it's really more of a future outlook problem and what could happen down the road. To your point, yes, we already seem to have enough doses, basically just from Pfizer and Moderna. So we haven't seen any major issues crop up that could delay that rollout. And those commitments, they already seem to be ahead of the commitment actually on those full 300 million doses that they had committed to through June of this year.
All right, Yahoo Finance's Anjali Kamlani with all the latest on the COVID-19 fight. All right, off for a short break here. Again, futures higher on this Thursday morning, the first trading day of April, first trading day of the second quarter of 2021. We're back with the opening bell right after this.
Welcome back to Yahoo Finance Live. We are approaching the opening bell here this morning, and it looks like futures are kicking off the first day of the second quarter with some rises, some increases here. Nasdaq futures indicating a higher open. This is even after, I mentioned earlier, those jobless claims numbers that we got coming in worse than estimated, but that's pushing bond yields down. So maybe that's good news for markets here this morning. Let's talk to Michael Aroney about it. He's Chief Investment Strategist at the U.S. Fighter Business at State Street Global Advisors. Michael, it's always good to see you. You wrote a note talking about, despite sort of Fed rhetoric to the contrary, the need to hedge against inflation. Talk us through here your reasoning on this as the Fed keeps telling us they're not worried, but you say, not so fast. Maybe we should at least be worried enough to hedge against it.
So, Julie, you rightly point out, so over the last couple of weeks, the Fed has done everything. They've gone out of their way to assure markets that any type of inflation we're going to get will be temporary, transient, kind of transitory, whatever word you want to use. They're saying it's nothing to worry about. So what's interesting here is if you look at producer price indexes, PPI, now for the first time since July 2019, it's actually greater than consumer price index, CPI. What this tells me is that businesses are experiencing rising input costs. And we see that everywhere, right? Oil, lumber, housing, aluminum, copper, all have been climbing. And so far, businesses have not translated these rises in prices to consumers. So this will become an important barometer going forward, because if they do, you will start to see inflation expectations creep up. And markets are expecting it. As we know, the break-even rates have been climbing, suggesting that markets are anticipating much greater inflation as the economy reopens, as the pandemic gets pushed behind us, and we have all this stimulus flowing through the economy. So I think the risks are growing that investors don't do anything about it. So yeah, the Fed might be right. They could be right, but I think the risks are growing to ignore some of the inflation data that we're getting.
Well, Michael, I guess then to kind of go at this topic another way, though, we've seen, value stocks do so well. We've seen obviously energy had a huge first quarter. We've seen rates come up, and that to me would suggest investors are pricing in some amount of inflation. Are there, levels or numbers that you're thinking about that would say, oh, this probably suggests that the market hasn't priced that in, or what do you think has been anticipated right now by markets?
Well, I do think that the markets have priced in an increasing element of inflation. We're seeing that in break-even rates. We're seeing that in the difference between the PPI and the CPI. I think one thing that's interesting is that the Minneapolis Fed did a survey of traders. And traders, about 30% of survey respondents suggested that they anticipate consumer price indexes of north of 3% going forward. And so, so 30% doesn't seem like that much, but about a third of respondents to that survey suggested that they think that inflation will be north of 3%. That's much higher than the Fed's anticipating, and could force their hand, if those traders are right, that something, inflation could be kind of a greater problem or run hotter than expected. So I think that's kind of an important barometer from that standpoint as well.
Michael, Julie mentioned if now is a good time to hedge against inflation. Is now a good time for a trader or an investor to hedge against higher corporate taxes? They're headed higher. That was made very clear yesterday in light of this new infrastructure plan. I tweeted out a photo of the tax rates that the FANG companies pay currently. It's all under 20%. It's going to hit their profits. So how do investors position for that?
So there's a couple things here too, and absolutely from a tax perspective, the plan to pay for some of this infrastructure plan is to raise corporate taxes, and that's highly unusual. Corporate tax rates have only climbed twice in the last 80 years. It's really been a race to the bottom, and so it's kind of an interesting dynamic. So this will take about 9% off of earnings per share growth should we move from 21% to 28%. Now, there's going to be some negotiating, but the point is it's going to weigh on corporate profits. And just kind of relating that back to the kind of inflation discussion, you combine that with this idea that if businesses are experiencing higher input costs, that's already eating into their profit margins. Now, higher taxes will further eat into their profit margins. If this isn't priced in terms of stock prices right now, this could be a risk to the market. Now, my belief is that investors have been bracing for both higher taxes and a little bit of inflation. So I'm not sure that, and even this morning, right, markets don't seem to be too concerned with it. But it is something to keep an eye on, especially with valuations kind of at stretched levels. If profit margins start to get crimped, that could be an issue.
It could be an issue, and it could hit multiples, it could hit profits. Then in that case, Michael, as an investor, where do you go?
Well, I still think that here in the near term, you have to think about some of the cyclical value plays in terms of the financials, the materials, the industrials, particularly with this incredible infrastructure package that's likely to come forward. Admittedly, it's going to take a while to negotiate, take a while to flow through to the economy from that perspective. However, I do think that as the economy continues to reopen, as the pandemic gets pushed behind us, I do think, and rates and inflation do tick up, I think the best way to do this is kind of rate-sensitive stocks or economic-sensitive stocks. And those lead me to financials, industrials, materials, energy from that standpoint. So I still think that's the best way to hedge against this kind of rise in interest rates and inflation expectations. And quickly, sorry, the other thing is if you think about it, technology and healthcare have been the biggest beneficiaries from falling taxes because they have the lowest effective tax rate. Now with it rising, they could feel the most pain. So again, it would suggest that pivoting towards some of the cyclical value sectors of the market is probably a good idea for investors.
Michael, I have one more kind of precision or question on taxes, and it centers on a word that you just said, which is effective tax rate, because we know companies don't pay 21%, many of them, right? So I always struggle with, the difference between the rhetoric on taxes and the reality on taxes, that companies complain about the effect this is going to have on their profits. We know they're not paying that rate, and that they have ways to get out of things, and that they figure out a way to grow just fine, typically, taxes notwithstanding. So, how are we to take really the idea of higher taxes?
Well, one of the things that I think is getting a little bit lost in the shuffle around yesterday's unveiling of the infrastructure plan is the taxation of profits earned outside the United States, Julie. And so here it looks like the Biden administration and Democrats are going to do a number of things to try to address that, to kind of put in a bottom rate for corporations at 21% that they'll all pay. They're also going to do a number of things to eliminate some of the kind of accounting gimmickry that goes on so that they can't hide profits in low tax locations and things. So I think there's a number of things on the table where Biden's going to try to address that very thing that are concerning from a market perspective.
Michael, thank you so much for being here. Great tax discussion here. Chief Investment Strategist of the U.S. Spider Business at State Street Global Advisors. Thanks, Michael. And we just had the opening bell there a moment ago. It's Compass, those very excited folks who are ringing the bell this morning, very excited on their IPO day, even after they cut that public offering by half hours before the share sale. It is, by the way, a SoftBank-controlled real estate company, so we'll see how that ends up doing on the first day of trading. Right now, though, we are going to bring in our Jared Blickery for some details on how we are getting underway this morning. Jared.
We got the tech sector leading higher, and we're going to take a look at that in a second. First, I want to point out our international indices, and we have a lot of green on the screen here, not only in Asia, but Europe and also the U.S. Nasdaq is the biggest leader here. It's up about 1.2%. Dow is the biggest laggard, up 0.33%, and that's good for just over 100 points. Also, the Russell 2000 up about 60 basis points here. Well, looking inside the Nasdaq 100, the mega caps are leading the way higher along with chip stocks. And we got to take a look at Micron real quickly because nice guidance there from the company. And let's go to a year to date so we can see exactly what it's done recently. It's been basing, kind of consolidating here over the last 6 weeks. Maybe this will be the impetus it needs to break to new highs on that rosy outlook too. Also getting some information that they might be looking to make a big purchase in the chip space. So we'll see how that works out as well. Now, looking at the sector action, it's the FANG-laden sectors that are outperforming today. That's communication services, tech, and consumer discretionary. All three of those are the outperformers. To the downside, we got defensive names like staples, utilities, and healthcare. Those are the ones in the red. All right, looking at the travel sector, looks like a lot of green here. Royal Caribbean up 1.5%, Live Nation up 1%, Carnival Cruise Lines up 1.85%, and the airlines not doing too bad either. JetBlue up over 1%. Just getting a notification here that KLA 10 Core, guess what? That's at a record high, and we focused on the chip space before, but here is our chip heat map, and we can see Taiwan Semi looking to spend about another $100 billion. That's up 3%. Sometimes costs don't matter, or do they? We got to check in on Tesla and the EV space. Tesla's up another 2%, coming up nicely off of the lows that we had last week. And we can see after this washout below 630 here, this level here, we're going to be paying attention to that because we have broken through this negative trend line. We can always form another one, but we may have the beginnings of a bottom in this bellwether stock. And also got to check in on the VIX and bonds. Here's the VIX. Guess what here? We're looking at an 18 handle. Haven't seen that in a while. Notably, we settled the day under 20. We settled the quarter under 20, excuse me. Also looking at the bond market here, guess what? 10-year T-note yield down 5 basis points, guys.
Jared, talk to us about the FANG stocks because they have been on my radar screen this week. They've put in some good sessions. That hasn't been the case, but it has been the case the past few sessions. What are you seeing in the individual names?
Yeah, we took a look at Tesla before. I think I almost consider Tesla part of that group because of its sheer size, but Apple is really the big kahuna here. Now, we've been watching this particular negative trend line. Looks like it's just coming out of it, but we still have this basing action. So for the month of March, basically going sideways, have this kind of triangle pennant formation here. If we are to break to the upside here, that would be a huge boost for risk markets. As Apple goes, so goes the rest of the market. And if it sneezes, well, everybody else catches a cold. That's the way it works.
Well, and on the opposite side, obviously, if it's going up, then it looks like stocks overall are going up. I think we're at a new record on the S&P 500. We're above 4,000. We've broken above 4,000. That much closer to the 8,000 target that Brian Sazzi talked about the other day. Jared, can you confirm that for me?
I'm looking at it right now, 4,001. That is a record high, and I don't have an S&P 500 4,000 shirt, but I tell you what, we get to S&P 500 5,000, and that's going to be the new name. I will don a hat for that purpose.
Excellent. I look forward to that day. Thanks so much, Jared. Appreciate it. We are going to take a quick break right now. When we come back, we are going to be talking about autonomous driving with Austin Russell of Luminar. Stay tuned.
All right, welcome back to Yahoo Finance Live on this Thursday morning, April 1st. Not a joke, just want to check the markets quickly here. S&P 4,000 for the first time. We just talked about Brian Sazzi's 8,000 price target. It's not your price target, Sazzi. It's what folks on the street are saying the S&P will go to. Look, we could do a whole thing on how modest the gains in the Dow would have to be for the Dow to get to 100,000 in not too short a time, but we will save the compounding growth conversation for another time. Let's get to another part of the market that we have talked quite a bit about over the last few months, and that's what's happening on self-driving technologies. We've seen a number of SPACs come to market. One of the first that we talked to was Luminar Technology. They're building LiDAR systems for eventual self-driving vehicles. Joining us now to discuss how the development is going with that company is founder and CEO Austin Russell. Austin, great to have you back on the program here. So let's start with the IRIS program, and as a layman trying to understand exactly where this fits into your eventual production of something that might be in a vehicle that I might drive, and sort of what has happened there over the last few months and where that roadmap is headed.
Yeah. No, it's certainly been going well. We just did our whole year in review call in earnest for 2020, and kind of highlighted some of those key milestones, really meeting all of the core product, business, commercial, economic milestones, and with IRIS specifically, continuing to execute on that. It's a LiDAR, and really the first thing that can enable that has the specifications to enable true autonomy in series production. And this is where we've been able to continue to successfully execute on it. We proved out the core technology, some time ago, but continue to develop, industrialize, leading up to this. So, I'm actually here today in our advanced manufacturing facility that we've stood up for a pilot line in preparation for series production, developing the process for how to successfully assemble these units at scale. And with that, really just continuing to execute, and also, no shortage of things going on, so far this year, with a couple of new key announcements from a commercial standpoint, with the launch of Sentinel, our whole transformation from a LiDAR company, so to say, to a broader autonomous vehicle company, as well as continuing to execute commercially with SAIC, China's largest automaker, now counting as a partner that we're going into series production with in China.
And also, I just want to follow up quickly because, in kind of going through, a couple of your videos, and your presentations, I'm just trying to, figure out for myself series production and where that fits within the development of a product as you guys are speccing it out, I guess, on the R&D side, and then actually, where that sits on the road to getting it into vehicles, that a consumer might interact with, some years down the line.
Yeah, no, totally. And uniquely, we've been able to help lead the charge of the transformation of this autonomous vehicle industry out of R&D and actually into production vehicles. And the key thing is working directly with OEMs to be able to establish these programs to enable what's otherwise, historically been largely just testing, with roof racks full of sensing systems and a supercomputer in the trunk and all of these things, to actual systems that can be on the road, and even cars that you can buy, that have autonomous capabilities and features. Now, it's starting out with the constrained scenario of highway autonomy and then expanding outward, in addition to much more advanced active safety features, that we're calling proactive safety. So that's really how this industry is being kicked off, and otherwise still fully on track for the by year end of next year of the start of production timeline for what we've had. So it's been otherwise good, and that's how you're going to see this industry realized as we kick it off.
Hey, Austin, it's Julie here. You mentioned in a recent interview talking about Tesla's so-called autonomous capabilities, which really are not fully autonomous, and certainly you're not the only one who has said that. That's been broadly talked about. So when we talk about autonomous, whether it's your Sentinel stack going into cars or the IRIS product going into cars, what do we mean by autonomous? Like, what is the sort of definition or baseline for what people should expect from autonomy with your products?
Yeah, so when it comes to autonomy, it involves a much broader picture than just the LiDAR, so to say. You really have to have a number of different software components that are stacked in there to be able to make all of this work. And that's key to actually successfully enabling the OEMs at the end of the day. In addition to, frankly, the majority of them that don't necessarily have all of the infrastructure and teams and everything in place to be able to build a full stack solution. So that's where, in addition to all of our own work on the software side, we also have, we partnered with a subsidiary of Volvo called Zensact that's about 500 plus person team of software engineers that's been developing this solution for highway autonomy and proactive safety with us here to be able to deploy it with other automakers as well. And that's key to enabling this in a widespread capacity across the industry. But I'd say when it comes to the self-driving side of this, the key thing here is that there isn't and there hasn't historically been any way to get any kind of true self-driving modality out on the road, or really even dramatically improve vehicle safety by having these new kinds of feature sets. And that's what we're transforming as part of this and kind of leading the charge with. Again, when it comes down to it, you're starting with more constrained scenarios, for autonomy, and then expanding there on out. But as part of this, this is where, at the end of the day, in addition to the business and the technology, it's all about lining up the commercial side as well. These things have really long design cycles. They can be, the platforms can last, 7 to 10 years, as long as that from the start. And it has to take a few year lead up, into these automotive platforms. So that's why it's been such a critical time. You got to get designed in and work closely with all these guys, and that's been our focus, to work with the leaders.
Hey, Austin, has the chip shortage had any effect on it? Does it play a role in your technology, or is it limiting the automakers you're working with's capability to have vehicles for you to have development phases in?
Fortunately not. When it comes to this, it's a good question. I'd say, to be honest, a lot of the day-to-day stuff when it comes to the broader automotive industry and all the things that they deal with when managing those complex supply chains and other aspects of the business is really almost a little bit of noise, when it comes to us and our partners. We're extremely focused on seeing this through, into these production programs. And with that, there's still a lot of work and lead up and everything to do when it comes to this. It's the same reason why, COVID doesn't really have any kind of, substantial effect here on everything too. I mean, the launch of everything that we're talking about is starting, SOP, but before the end of next year. So, it's something that, you kind of have to put yourself, in the place of OEMs and everything, like more a year and a half from now than it matters today, and exponentially as it scales up. But there's no question that automakers always continue to face the day-to-day challenges with a chip shortage being one of them.
Austin, since we talked to you on IPO day back in December, there's been tremendous attention on Luminar, tremendous attention on you as an entrepreneur. How have you just tried to stay grounded on a personal level?
It's a good question. I think folks on a team can attest. I don't know if anything in terms of the actual business and execution, everything has dramatically or maybe even changed at all when it comes to it. I mean, you just remain super heads down, focused on how do you successfully ensure that we can enable all of these different key business areas and milestones that we have, coming up for the year. There's no shortage of things going on though in terms of what we have ahead, and that really includes everything from from the core product side of things and actually preparation for series production. I mentioned I'm in the advanced manufacturing facility here of, testing through all the auto grade specifications, ramping up the pilot line here for a contract manufacturing process transfer down in Mexico, building C samples. To the commercial side, we actually outlined a goal of being able to have 3 kind of major commercial program wins this year, which one of which we've already announced with SAIC, continued Sentinel development and leading up to an alpha release by the end of the year, growing the forward-looking order book by at least 40%, which is ambitious, but something that I think we'll certainly be able to do, by at least that. And then, ending the year with a greater cash position than what we started with, from some of what's raised from the warrants and otherwise. So I think we've been in an awesome place on all those things, but, try to set some of the metrics for, how can people judge us over the course of this year. Sounds ambitious, but we've certainly been able to hit milestones and then some all the way so far. So that's what we're all focused on.
All right, Austin Russell, founder, CEO, Luminar Technologies. Austin, really appreciate you taking the time to talk with us this morning, and I hope to talk soon. All right, let's take a look at the markets here. We are at record highs on the S&P 500. We are just below 4,000, as we mentioned earlier, trading above 4,000 for the first time on this first trading day of April. Back with more on the markets coming up right after this.
Foot Locker shares have been coming on strong of late, rising about 12% over the past month. Analysts point to consumers using their new stimulus checks to buy footwear and apparel as one of the reasons for Foot Locker's stock pop. Yahoo Finance sports reporter Reggie Wade and yours truly talk with Foot Locker's chairman and CEO Richard Johnson about the state of the footwear retailer.
It's the perfect time of year, right? I mean, we're getting into springtime. There's stimulus money, there's tax refund money. We know that when our customers got money in their pockets, that they're out shopping, and whether it's digital clicks or it's walking into malls where they're open, we like the position we're in right now. Serving the customers, something going pretty well right now.
You mentioned stimulus checks, Dick, and we've seen some pretty good data of late. A lot of folks are taking those checks and they're buying clothes. Have you seen that in your business?
Yeah, well, historically, we talked about tax back in years ago, right, when the tax checks started to flow in February, and it just has created this energy. And anytime our customer has money in their pockets, they really are looking for great footwear. They're looking for great sneakers. Serving the customer with the product that we've got, is something that we're always about. So it's the best product possible, and the consumer, loves to spend money in our segment of the business. I know Reggie loves to spend money on sneakers.
Oh, you know it. You know it. You should see my bedroom, or my shoe room, as I call it. But Dick, I have to ask you, has Foot Locker's role in the sportswear market changed as major brands like Nike and Adidas are bolstering their own direct-to-consumer channels?
Well, it's a really big ecosystem, right? The sneaker ecosystem, as you well know, encompasses direct to consumer from our brands. It's great, retailers like us that have a multi-branded portfolio that we sell, and it's the secondary market, right? All of those create this energy around sneakers. So living in the ecosystem where we share, consumers always get to make the decision on where they're going to shop and how they want to shop. So our job is to create the best engagement possible with the consumer and bring the best storytelling, the best content, the best customer connections that we can. And we like the way that we serve customers. Our customers really truly like the way we serve them. We launched an FLX program about a year ago. We've got 17 million members in our FLX program, which is a membership program. So it tells me that we're doing something right in this big, complex ecosystem.
And I am one of those FLX members, one of the 17 million. In 2019, you guys made a huge investment in GOAT Group, getting in on the secondary market. Will we see a more expanded GOAT presence in Foot Locker's retail locations coming up in 2021?
Well, Reggie, I appreciate the question. We continue to work with the team out at GOAT. They've got a great customer interface. They work really hard on the authentication process. We invested in GOAT to understand the capabilities and the platform that they operate in the secondary market. But we absolutely know that we have to have a line between the secondary market and the primary market, or we lose credibility with our customers. So we support the GOAT business. We look at them to understand how the customer, transacts in that secondary market. But our real energy and our focus is on driving our primary connection with our customer in the primary market.
Dick, the conventional thinking on the street is that GOAT was a phenomenal investment by a Foot Locker. Would you want to even take it a step further? Can you see yourself owning GOAT at some point?
Well, I wouldn't talk about any future opportunities like that, Brian, but we've got a ton of respect for the secondary market, and the team out at GOAT has done just a fabulous job. And I think they created this authentication process that really adds validity to the secondary market. So when you're combining a buyer and a seller, if you are the buyer, you know that you're getting the real deal if it's coming through GOAT. So again, great platform, great group of a great team out there that continues to push the envelope on how to service that customer in the secondary market.
Dick, Reggie and I were talking before we came on here about just the robust innovation from a Nike, from an Adidas, from a lot of companies in the retail space right now that are selling footwear. What's the post-pandemic footwear look? What are going to be some of the key styles?
Oh, it's a great question. And, the one thing that I'm really confident of, Brian, is that people aren't going to go back to wearing what we used to call dress shoes, right? Casual is the way of things. And, it's going to be comfort, right? You've got classic silhouettes, the AF1s and the AJ1s that people are always going to want, and great collaborations. But you look at running silhouettes for people that are on their feet, that want cushioning, that want support, that want comfort, and they want style. So I think it's blending all of those things together, and it's across a myriad of vendor partners. It's across a myriad of brands and silhouettes. So I look to comfort, both in apparel and footwear as being one of the key things that sticks with us after the pandemic.
Dick, Yeezys have seemed to cool off as Jordans are heating up. Are you seeing that on the ground in your Foot Locker locations as well as online?
Yeah, I mean, I think both of those silhouettes that you called out, Reggie, continue to bring heat to the marketplace. And I think on any given launch day, depending on what else is going on in the marketplace, they seem hotter, they seem colder. You can go out to GOAT and see what the post-purchase prices are. Again, we think that they both add tremendous energy, but, brand Jordan is incredibly hot right now. The right Yeezy silhouette is incredibly hot right now. And I think that there's just so much energy around the sneaker market, as you well know, that I think they both are still driving a lot of heat and a lot of excitement around our customers.
Jake, the COVID-19 pandemic has changed the way that everyone does business. What are some of the lessons that Foot Locker has learned during this time? And has that changed your approach as CEO when you think of things like corporate governance and running a business such as Foot Locker?
Well, there's been a tremendous amount of learning, Reggie, right? I mean, we made a decision last year on March 15th to close our stores starting on March 17th, right? Nothing that we had ever really thought about closing the entire fleet of 3,100 stores. So one of the things that I think we've learned is that you have to be really agile. You have to be able to react. You have to try to predict what you can, but you have to be able to react to the situation. And as you reflect a year ago, right, every morning there was new news that we had to react to from a company perspective, whether that's in North America, whether that's in EMEA, whether that's in Asia Pacific. We had to react to all of those. So, we certainly learned, our store team and our field team really learned how to take good care of themselves, take good care of their customers when we could reopen, and we learned how to be able to do business in store even during a pandemic.
And it's say goodbye to dress shoes post-pandemic, says Foot Locker CEO Richard Johnson. You know what? I am down with that. And we will be right back with no dress shoes. Stay tuned.
You're watching Yahoo Finance Live. Let's get a quick check on markets here. We are seeing a record in the S&P 500 as it touched above 4,000. It's fallen back a little bit below that level, still up about 2/3% on the day. And we're seeing strength in large cap technology today, as we have intermittently as of late, with the Nasdaq up about 1.5% in today's session. Some of all of this has to do as stocks seem to be taking a bit of a cue from treasuries. We're seeing yields pushed lower in today's session. We'll be right back with much more Yahoo Finance Live.
All right, just after 10 o'clock here on this Thursday, April 1st, welcome to Yahoo Finance Live. I'm Miles Upton, joined as always by Julie Hyman and Brian Sazi. Let's take a look at markets this morning. We had the S&P trading above 4,000 for the first time, record high there for the benchmark index. We'll see where things shake out as we get through today's trading session. Another day and another electric vehicle SPAC. We're going to talk to the CEO of Electric Last Mile and challenges facing last mile deliveries and their solutions there. And April always brings us one of the sports world's great months. Opening day in baseball happening today, the Final Four up this weekend, Masters next week. And on that theme, we're going to talk about what's happening at Jim Dolan's MSG empire with Jonathan Boyer. We're also going to hear from NFL star Patrick Mahomes later on this hour. But we begin this morning with a look back at the first quarter of 2021. Of course, wrapping that up yesterday's trading session, writing about that a bit in the morning brief this morning, and the way that the first quarter of 2021 was really a reminder, and the calendar told you as much, but a reminder of how much different this trading environment is than what predominated in 2020. All those themes that became the defaults in 2020, buy growth, buy tech, buy anything, stay at home. Those themes just were not a part of the market action in the beginning of this year. And there's, a couple of zeitgeisty stories in here, guys, right? NFTs, GameStop, the kind of decline really of what's happening with retail involvement in this market. But, coming off a quarter where energy is up, 30%, financials are up 16%. And, that stat that we talked about on yesterday's program of top 25 performers in the S&P, in 2020, down about 3% in the first quarter, bottom 25, up about 15%. And so, overall, Julie, we just continue to see the market, act differently. Today, we've got the VIX back under 20 for the first time, I guess, in almost 12 months here, really 11 months that we've seen the VIX at these levels. The S&P is now at 4,000. And I think a lot of that, a lot of those easy trades, I guess, in hindsight, the easy trades that predominated in 2020, those are just really not a part of the picture anymore.
I mean, if you just bought the SPYs, then you'd be fine with the S&P 500 at new highs, right? If you didn't try to get cute about rotation into this or that. But it's not, as we were having this discussion yesterday, I was having the same thought, which is that it's not unusual as we see the turn of a calendar year to have rotation out of the worst performers or out of the best performers and into the worst performers, right? That's something that typically happens. What doesn't necessarily happen is that it stays, that trade has some longevity, that the calendar shift means anything substantive when it comes to an actual shift in economic trends. And yet this year, that is what we have seen, which has been quite interesting. What's also interesting to me is that even though we already seem to have gotten the push of good news, optimism over vaccines, every economist on Wall Street raising their GDP forecast, that the market does continue now to drift higher without that additional catalyst. Yes, we had that proposal from President Biden yesterday, but we all knew that was coming. So I do wonder at what point will we see another pause with another catalyst necessary to continue to have things like energy and financials and industrials that people have rotated into to continue to work.
Yeah, the action we're seeing today here, guys, really underscores what Miles usually says. Stocks usually go up.
That's it. It's easy. You cannot lose money.
It is easy. I have nothing more here to say. Stocks usually go up.
Those are the rules. That's right. That's right. All right. Let's talk a bit more about the markets and talk about really the value trade that has been such a big feature. Going back to November of 2020, we saw the vaccine news. We saw the election of Joe Biden as president. And that really catalyzed this value rally that continues to today. Joining us now to discuss is Jonathan Boyer. He's the principal at Boyer Asset Management and president of Boyer's Intrinsic Value Research. Jonathan, great to talk with you once again. Let's start broadly with the idea of the value kind of trade right now and what you've seen from your vantage point over the last few months and how much more durable you think this move into value can be as we head into the rest of this year.
Great. First, thanks for having me. And yes, I think it's definitely durable. I think this rotation has legs after a decade of, value trailing historic margins. I think there's a lot of pent-up energy to bring it back up. However, investors really need to be cautious. And I think, as what you said earlier, chasing rotation is very dangerous. And it's terribly tax inefficient. So I think investors really need to proceed with caution, know what they're buying, and buy it at reasonable prices.
Okay, so Jonathan, what does that mean exactly then? We've just been talking about how a lot of the places people have been going have been into financials, into energy, into industrials. What criteria, what should people be looking for specifically?
Well, for us, what we do and what we think are reasonable prices is we look at every company as if we're buying the whole business. And if you're able to buy it at a discount to what an acquirer would, then over the long run, you should be able to make a lot of money. Obviously, it doesn't always work, but it's a great strategy to have. So you have to be very careful on valuation. You have to look at what similar businesses have gone for in transaction, as that's the best guide to see what a business is worth. But investors shouldn't just go all in on one rotation. They should kind of inch their way in, and instead of trying to buy the flavor of the month.
Jonathan, when's your dinner with James Dolan?
I don't think I'm invited to his house for dinner or the garden. Although I won't wear one of those T-shirts that says bad things about the Dolan family at the garden. But yes, James Dolan and the Dolan family have been very good partners to invest alongside of if you're a Knicks fan or a Rangers fan, you probably aren't too happy with how they've done. But if have been a shareholder like we have, you've been handsomely rewarded.
Now, John, you did write a pointed letter to James Dolan after the recent deal that he just made. Is it time that he just waves goodbye to MSG entirely? Does he have to go?
The deal that you're referring to in the letter that we released on Monday is the definition of self-dealing. Just a little bit of background. He controls 3 entities that are related to Madison Square Garden. And one of them is Madison Square Garden Entertainment, which owns essentially the Garden and other venues. And he also owns Madison Square Garden Networks, which has the rights to broadcast the Knicks and the Rangers. That's a cash cow. And he is attempting to buy MSGN at a price that can only be described as a take under. And since he controls both companies with super voting shares, it's a smacks of self-dealing, and this is something that needs to be stopped, and hopefully one of the major shareholders will be able to do that. But yes, it's extremely unfair to shareholders, and MSGN, which is what they're taking over, has great growth prospects, especially with the potential legalization of sports gambling in New York, which could significantly increase their business over the next couple of years, and MSGN shareholders are not going to be able to participate.
And Jonathan, when I think about the MSG kind of complex of businesses here, what I always end up coming back to, and maybe it's just sort of the well, that doesn't really matter, but I understand why you would think that part of this is like, I mean, the Knicks stink. I know it's a great brand, but the Knicks are kind of listless. And I do wonder, you look at the sports part of the portfolio, which has been spun out. I mean, is there, like, how much does the performance of the actual franchises play into this? And then also, you mentioned the cable networks as a cash cow. Live sports is certainly the best part of the cable bundle, but it's still exposed to what we all agree is a declining industry there. So as you think about both the product that is on the court or on the ice and how it is distributed, is there a risk there? And maybe that is why, at least from the Dolan perspective, they would say we need to make this one entity so we're not too exposed to some of these secular trends.
Well, there is no strategic rationale for MSGE to be buying MSGN. And to go back to the valuation, the Knicks are the most valuable team in all of the NBA. And this year they're not terrible. I think they're 24-24, but they've historically have been terrible. Think about how valuable they will be if they actually were good. And 2, how valuable it will be once sports gambling is legalized. And that will really help the networks in a multitude of ways, mainly the fact that you're going to get, even if the Knicks are not good, people watching the games because they're going to be betting on them. And you can turn MSGE, the Madison Square Garden, could be a sports book the way it happened in Washington. There's so much optionality, but to go in and basically steal a company from shareholders to help fund their growth really makes no strategic sense. And what they really should do is look back at what they did in 2007. So in 2007, the Dolan's owned Cablevision, which housed all of these entities into one entity. And they wanted to take it private. And what they said is, we control Cablevision, and it would not be fair or good corporate governance for us to approve the deal because it would be self-dealing. And they opened it up to the minority shareholders to approve it. And the minority shareholders struck it down. And after that, Cablevision went on a streak of being unbelievably shareholder friendly. And we hope that they continue with the same playbook.
Yeah. And Jonathan, you're right. I think I catch myself here defaulting into describing the Knicks a certain way, which in reality, they are not. They're incredible team this year, probably going to make the playoffs for the first time, I guess probably since 2013, at least since Carmelo was there with the Knicks. All right, Jonathan Boyer, thanks for joining the program today. Jonathan Boyer is the principal of Boyer Asset Management and host of the World According to Boyer podcast. Appreciate the time. We'll talk soon. All right, let's take a look at the markets here as we head off to break. All three majors are higher here. S&P 500 trading above 4,000. Back with more right after this.
I know we have talked a lot about how electric vehicle stocks have been all the rage. We've talked less about a less sexier part of the electric vehicle market, shall we say, and that is delivery vehicles, and specifically delivery vans. Our next guest is aiming to get those vans on the road, so-called Class 1 electric vehicles. Jim Taylor is the Electric Last Mile co-founder and CEO. The company, by the way, is set to go public in several weeks through a SPAC deal. It's scheduled to close. Jim, thank you for being here. First of all, I'm just going to dive right into it here. You guys have about 45,000 pre-orders. And as we know from some of the other companies developing these types of vehicles, it can get a little tricky. What does pre-orders mean in this case?
Yeah, I think it's best to translate that into several plain English words: hand raisers, reservations, standing in line, certainly non-binding. But in this business, to gauge demand and to take a pulse, early on, is the way that this industry typically measures that. In our particular case, given that we're going to be the first entry in the so-called Class 1 segment, the smallest of the cargo delivery vans, our pre-order, let's say, call it backlog, but pre-order list has been growing and growing, primarily because there'll be nobody else in that segment but us. Will be the first movers in that segment. The demand, as you guys know, from e-commerce down to all of the delivery van business is extremely high given the growth of e-commerce. And so people are basically, again, raising their hand, putting in a reservation and say, count me in, because they don't want to lose out on this opportunity to be one of the first to get our particular product.
Jim, that van behind you, is that a workable van? Can you drive that? And what are some of the specs on that? Because I imagine that's one of the key selling points for these pre-orders.
It is, yeah. That's a working van. In fact, if you've got the video up that I'm watching, you can see it there in a working form. And the most important specs, it has the lowest total cost of ownership. We can come back to that, but If you compare that to the existing gas-powered vehicles in the segment today, it's about 35% lower overall total cost of ownership. It carries 170 cubic feet of carrying volume, and of course that's extremely important, as opposed to the maybe historical weight classification, so-called Class 1. And the second is really important, as a full electric vehicle, is 150 miles of range, which is more than adequate in this particular segment, given it's literally last mile, short distances. Typical range in these vehicles on a duty cycle today of vehicles in that segment would be about 40 to 60 miles. So 150 is more than ample to avoid anything like range anxiety and those sorts of things.
And Jim, right now the electric vehicle space has really been focused on consumers, and we've seen a lot of companies, say they want to focus on commercial clients, commercial customers. We haven't seen too many of those products come to market yet. As you look at what your potential customers would need from their vehicle, what are some differences as you approach development of, not just the first one, but future versions of this van? What are some things that your commercial clients are going to need that a consumer, for instance, might not particularly be interested in with their electric vehicle?
Well, I think I'll pick back up on what I just mentioned. Consumers, of course, are very concerned about range. They're not really sure where they're going to go every day. And so there's a feeling of somewhere north of 300-mile range is adequate for the consumers. As I mentioned, in this particular case, when vehicles, especially commercial vehicles that are on planned routes, leave in the morning, they know exactly how far they're going. The companies that manage all these fleets, of course, have it predetermined right down to how many terms per route that they're going to take. It's a very heavy focus on efficiency. And given that these are business support tools, it's business-to-business transaction, the number one issue is reliability and cost. And so they're going to look at this as an investment, and uptime, of course, is super critical, that these vehicles are doing business, not in the shop, obviously. And then second, cost. And they're going to measure that across the lifetime of the vehicle, not just the daily operating cost, but the overall lifetime until it's replaced. And so we have in place a very extensive execution system. From my background and the team that I've assembled, it's all focused on people who have been through many, many launches and are looking at the details and all of the important building blocks of ensuring that we have a good execution process in place from an engineering standpoint, the plant, of course, quality, but lastly, reliability and uptime to ensure that we meet those customers' goals. The second thing that is a requirement is data. These, again, are managed, these vehicles, as fleets, and looking at the overall efficiency on a day-to-day basis of how they can be improved, watching the vehicle itself if there's any issues with it. And so, again, we have an extensive data system in place to be able to give to the fleets and the fleet management companies that operate this. The third aspect of delivering what the customers want is so-called upfitting or customization. Each one of these vans, of course, starts as a pretty plain white van, but ultimately is customized to ensure that it meets exactly the use case that each of these customers are going to put these vehicles into place.
Jim, I noticed you had UPS's longtime CFO, Richard Peretz, on the board. I've talked to him a good amount of time through the years. Do you have orders from a UPS? And if not, would a UPS or a FedEx, would they be giving you orders? Do you want to work with them?
Yeah, yes, definitely. Many of the other early entries in this space have got UPS orders. In our particular case, yes, having Richard would be a natural. We're very happy to have him on the board with his knowledge and background in that space, especially as we become a public company, and all of his guidance in that regard for compliance and all of the things that are going to be required. But in addition, of course, his knowledge of the space. In UPS's particular case, they start their purchases from so-called Class 3 and up, a larger van. They don't actually purchase these small vans. However, FedEx does. They have both small and call it medium and large size vans. And so we're definitely pursuing these large fleets and looking to get them moving from, as I mentioned earlier, this pre-order space down into confirmed orders. And to do that, basically it's a technical exchange. We have to first get their requirements, and then we have to go back to them with a proposal, and then and finally a test drive to say, we meet your specifications. They physically demonstrate that, and then they'll be changed to confirmed orders.
Jim, thank you so much for being here. Jim Taylor is the Electric Last Mile co-founder and CEO. Appreciate it. And speaking of electric vehicles, as we go to break, just want to take a look at shares of XPeng, which came out with its deliveries, 13,340 smart electric vehicles in the first quarter of 2021 is what the company said it delivered, although XPeng, like many other vehicle makers, has talked about its production being somewhat crimped by the lack of chips, the chip shortage. That increase, though, is 487% year over year in terms of its deliveries. We got deliveries from NIO as well, another Chinese electric car maker, which delivered just over 20,000 and whose shares have also been higher in today's session. We're going to take a quick break. We'll be right back.
All right, welcome back to Yahoo Finance Live on this Thursday morning. We've talked about a lot of industries that have seen big changes as a result of the pandemic and folks, defaulting to those activities when there's not a lot else to do. We talked to Academy Sports yesterday. We've talked about what we've seen in the golf business. Also been a big resurgence in what we'll call the outdoor recreation space, also maybe known as the hunting business as well. Joining us now to discuss the company's latest quarter is Chris Metz. He's the CEO at Vista Outdoor. Chris, thanks for jumping on this morning. Let's just start with what you've seen over the last several quarters. This time last year, no one really knew what was going to happen next, but certainly, your core consumer was able to resume most of what they wanted to do, and certainly did it even more in 2020. They were able to get out and shoot, go to a range, go hunting at a lot higher clip. Do you expect that kind of momentum to continue as we get into 2021?
Well, Brian, it's good to be on this morning, and we do expect it to continue. Many of your listeners may not be 100% familiar with Vista Outdoor, but we go to market as the largest outdoor recreation products company with about 34 brands in our stable, leading brands that people are familiar with: Camelback, Camp Chef, Bushnell, as well as our hunting and shooting brands. So one of the silver linings of COVID was that people got cabin fever, shelter in place, wanted to get outdoors, and they got outdoors and recreated in a huge way. So, we've got a fiscal year end of 3/31, and year to date, our sales have been up over 25%, the most recent quarter up 35%. So, we certainly participated in the silver lining of people wanting to get outside and recreate.
Chris, 8 million new gun owners last year. Who are these 8 million people? What do they look like? And what are they buying right now from you?
Well, it's a really interesting question. It's one of the neat phenomena that we've seen. So 42% of the 8 million new shooters are women and people of color, many of them trending much younger. So what we saw was a dramatic increase in hunting licenses, over 1 million new hunters that were welcomed into the space. And there's a lot of young folks that have gotten into the farm to table movement over the last decade and have migrated to field to table and filling their freezers with wild game rather than running down to the grocery store. So we see a lot of increase in hunting. Now, we are one of the leaders in a lot of shooting sports, and we saw a lot of clays throwers for sport shooting, paper targets. And so we've seen the consumption of those products dramatically increase as women and new users are participating in ranges at home for a variety of different means.
Chris, I know we're jumping around a little here, but I want to ask about bikes. That's been something that people have not been able to get really at all during the pandemic. You go to a Dick's and the entire bike section seems like it's always cleaned out. What's the supply bottleneck like for you there as we head into the second summer of this? And have you been able to get more product out the door in the fashion you would like, certainly given where demand is at?
Yeah, our bike sales have been crazy. So we're the leader in bike helmets and accessories. We go to market with Bell and Giro. So not just biking, but skiing as well. And honestly, we just can't produce enough helmets to satisfy the demand, and that's why the shelves are bare. So when we all grew up riding bikes, and a lot of kids nowadays are playing video games inside, but they got outside with parents and relatives and friends, and have been biking. So the critical supply chain issue is really just the capacity at all of our facilities to be able to get the raw material in, produce to the demand, and be able to supply that. But we've got a tireless workforce that has been working in many cases 24/7 over the last number of quarters to be able to meet that demand. So hopefully we're catching up on it, but we don't see it slowing down anytime soon.
And Chris, you recently won a contract with the FBI. What's the value on that deal?
Well, we don't share the value of strategic contracts, mostly because the contracts are fixed to a minimum extent, but then they can be extended, they can be changed as they go forward. And for competitive reasons, we don't do that. But we are proud that we support and are the leading ammunition provider to every branch of the U.S.'s armed forces. We're the leading supplier to law enforcement agencies around America today. So we like to believe that we're working hand in glove with our protection folks and keeping America safe.
Chris, it's Julie here. Of course, a lot of other people on the other side of the law can buy ammunition as well, as we have seen both legally and illegally to do things like kill people, as we saw just last night, overnight when there was a mass shooting in Orange, California. Do you think there should be federal background checks for ammunition purchases?
Well, Julie, they've got back in the 80s, they passed the Brady Bill. And the Brady Bill was the first to bring in a national instant background check. So that is in place today. And we've worked with legislators to try to tighten it and try to improve it. But I think our government has done a good job in making sure that they ferret through criminals and people that should not have products to be used in that way. And the unfortunate part is there are deaths every day, and many of them are despicable and many of them are avoidable. But deaths by firearms is a smaller percentage of the overall suicides and deaths that we see on a daily basis.
All right, Chris Metz, CEO, Vista Outdoor. Chris, appreciate the time this morning. Thanks for jumping on. All right, let's take a look at the markets here as we head to break. All three majors higher on this Thursday morning, first trading day of the month of April. S&P 4000, Nasdaq up almost 2%.
continue to watch developing stories around the chip shortage that is ongoing and affecting all kinds of different industries. In terms of how it's affecting the chip industry directly, it looks like there's a bit of a scramble for capacity here. And latest evidence of that is a report in the Wall Street Journal that a Japanese semiconductor maker, Kioxia, could be the target of a bidding war potentially between Micron and Western Digital, could value it at around $30 billion. Kioxia, by the way, is controlled by Bain Capital. Not clear a deal is going to happen, but this is reflective of these companies wanting to get that capacity. Micron, in the meantime, Brian Sozzi, was out with earnings and is seeing, as you might imagine, strong demand for its memory chips.
Right, and Micron shares fourth hottest ticker right now on the Yahoo Finance platform. And no surprise, a solid quarter from Micron on the top and bottom lines. And the conference call last night really left you with the sense that this chip shortage is not going to end anytime soon. The CEO of the company at Micron noting that demand remains very strong, pricing is very strong. But outside of Micron here, guys, we're getting a report this morning. We got a report this morning out of Taiwan Semiconductor looking to invest, and it's a whopping number, $100 billion over the next 3 years to expand capacity of its chips potentially. That's in a report according to Bloomberg. You know, and I think back to what Intel CEO Pat Gelsinger told me last week. They're investing $20 billion over the next few years to build 2 new chip plants. And it's going to take some time, Miles, for this production shortage to end, and we continue to see really the rolling impacts of it.
Yeah, I mean, I think it's just it's amazing how it went from boy, there's going to be a big mega investment cycle here, and all the current semiconductor players, Micron, NVIDIA, all the chip players. TSMC has really been at the center of that, big part of the ARC portfolio, so on and so forth. It's gone from that industry story, and the way that it's morphed to the automakers continues to really surprise me. And when you think about the amount of technology that now goes into a standard car, and these are not electric cars, right? These are internal combustion vehicles, but they still cannot be made because of a chip shortage. Ford out last night warning that profit could be hit by up to $2.5 billion. They're taking, 7 plants offline. They're not going to have an update on this situation until the end of April because the company just cannot make the cars without these products, without the chips coming in to their factories. And you think about sort of this infrastructure bill that the president is rolling out last night. And, Julie, you kind of realize that there needs to be, or there is going to be, a large part of this impulse on the infrastructure side, kind of a national industrial policy built around semiconductor fabrication. And I think that it's quite surprising that, maybe I just was asleep at the wheel here, but quite surprising that we went from we're going to have a trade war with China to we're reindustrializing the U.S. economy as kind of an offshoot of that. And also, because of where the economy is heading and what so many businesses need as a component and what they cannot be dependent on foreign, subsidiaries for.
Right. And the president obviously has talked a lot about that. So we'll see how and when that materializes, if it's going to be rapid enough to help with the current shortage. We're going to take a quick break. When we come back, we're going to talk wings. Is there a shortage there? I don't know. We're going to ask Brian Sozzi.
Kansas City Chiefs star QB Patrick Mahomes is not only trying to build an empire on the field, but also one off the field. I talked with Mahomes about his expanding portfolio of investments.
Yeah, I'm trying to build an empire off the field in every way. And I feel like business is a huge part. If you watch a lot of the great athletes that came before me, they found ways to build their empire and to build themselves up off the field. And so I'm trying to do that as much as possible. I'm learning more and more about health and wellness, which is important to me. And I'm able to utilize my connections with these companies to help become great partners with them and really build myself up, not only on the field, but off of it as well.
Who do you look up to in the world of business? And you say, you know what, I want to build my business life like they did, or are doing right now?
Yeah, I mean, there's a lot of people. I mean, as far as athletes go, I mean, you look at like Michael Jordan, you look at LeBron James, you look at Alex Rodriguez, and then I look at guys like Mark Cuban and some other businessmen as well. I mean, you try to take away from what they have done successfully, what they've done that hasn't worked out, and try to make it your own. And I've been able to do that so far, of just learning and learning more and more at a young age. And obviously, I don't make every decision right, but if I do have a failure, I try to learn from that and be better the next time.
What have you learned from some of your early failures?
Yeah, I think it's to me the biggest thing is do stuff that you love, that you have a passion for, because if you do that, you usually figure out a way to make it work. That's been big to me, is not just invest in everything, but invest in stuff that you truly believe in. And that's what I feel like I've kind of narrowed my focus down to, and now I have a passion for it and want to make sure it has success, not only for me but for others as well.
So you've had a lot of different business ventures, and I definitely want to talk about the NFTs, because that one caught me off guard when that announcement was made. But any dabbling in stocks at all? Have you gone that route yet?
Yeah, I do a little bit, but I have a financial advisor that kind of steers me in the right direction that way, and I'm pretty conservative, I would say so myself. But as I learn more and more, I try to do a little bit more and more, but I kind of let him handle that for the most part.
How do you spot a good business opportunity? I imagine there are so many people putting pitches to you right now. Patrick, work with me, I'll give you this. How do you just say, you know what, I'm not going to do that, or I am going to do this?
Yeah, kind of back to my earlier point. I think at first it was everything sounded amazing, and I was kind of ready to do anything with everybody because everybody's pitch sounded great. But now I focus on what would I utilize, what would I do, and I think that when I have a passion for it and something that I believe truly helps me out on a day-to-day, that's when I really know that's something that I want to put my time and effort towards.
How did you get involved with AirShare? AirShare, it's going head-to-head with NetJets, which is owned by billionaire Warren Buffett. That's a pretty big battle.
Oh yeah, no, but obviously AirShare, Kansas City based, and then I met the people. And just amazing people that want to grow together, not only have success for themselves, but they want me to have success as well. And so they've done a great job of not only helping me get to where I need to be at all these business meetings, be able to train every single day, and then get to where I need to be at after that. But they help my family out. I mean, they bring my family up to every single game in Kansas City. And make sure my mom and dad can get back to work the next day. And so to me, it was all about the people and how much pride they had of not only having success for themselves, but having success for me and my family as well.
Well, let's touch upon NFTs. What was the outcome of your NFT auctions?
Yeah, I mean, I thought it was a success. I was able to not only venture into this new space of NFTs that I find extremely interesting, of another way of memorabilia and these museums and these artwork that I'm able to go out and have my own kind of taste, my own spice with. But I was able to give back to my charity a lot, and I was able to really help finish off the Martin Luther King Park that I've been working on for a long time now. And so I thought it was a kind of a win-win, where I was able to kind of be in something new that a lot of people are getting into, but also help out something that I've been working on for a long time.
Are you going to be doing more in the space?
I've looked into doing more. It's something that I think you can't rush, something that you can't just go back to back and keep putting out more and more NFTs. But as I kind of continue to grow and learn more about them and see other people get into it as well, I feel like I'll be able to continue to build more into that space and more NFTs and things of that standing.
And you recently also too got involved with a SPAC called Disruptive Acquisition Corp. How did that come about?
It actually came about. I was talking with Marty Fish and Justin Verlander, and we were talking about how we can utilize kind of the health and wellness that we kind of fields that we work with already, and help them build and help them get better and help them grow. And they knew the perfect people, the business people that were able to help us bring this back to life with those two and the Canelo and Naomi. I mean, there's so many people of great athletes that really truly believe in health and wellness and bringing in these companies like Whoop and Hyperice and try to do whatever we can to bring them and give them the notoriety that they already have, but they want to continue to build and that we truly support.
And clearly busy days for Patrick Mahomes, dabbling in some NFTs, SPACs, stocks, and of course training for the football. And oh yeah, he's a new father to about 1 month old Sterling Sky. And we'll be right back.
Well, I bet you could cook up some tasty wings with those laser eyes, Brian Saucy. Sorry.
Wow.
Wingstop. That's my segue. Sorry, Wingstop.
Wow. Okay.
Please,
all right. Well,
please
Julie,
take it away
yes,
from there. So
Wingstop caught my attention this morning. No stranger to this program. Friend of the show in Chairman and CEO Charlie Morrison. Same-store sales up 20.7%. Wingstop reported those pre-announced results after the close yesterday. Same-store sales up 20.7%. Digital sales up 63.6%. So very good gains there. Consensus was only looking for about a 14% same-store sales increase. Hence, you're seeing shares of Wingstop up about 7.5% here in the early going. And I caught up with Morrison ahead of the show via phone for a few minutes, really telling me a couple things here. He did see the benefit in sales because of various sporting events. We had the start of the NCAA, of course. Also noting that stimulus checks may have been found their way to the likes of a Wingstop. Consumers getting stimulus checks towards the end of the quarter, out there buying some food for themselves. That is always good. Did ask him a little bit, Julie and Miles, about wing price inflation. And last time we talked to him a couple months ago, he was calling that out. It says they put in actions to mitigate wing price inflation. Wings are a strong seller at many menus, not just Wingstop, seeing it across the board. So wing prices have come up. And of course, Miles and Julie, we've also seen a lot of chicken sandwich wars out there too, which is also putting upward pressure on chicken prices overall. But nonetheless, Wingstop shares on the rise here this morning after that better than expected first quarter sales result. And you have the likes of John Tower, Wells Fargo, restaurant analyst, noting that this quarter may put to bed concerns among Wingstop that it can't comp its comp. Just some Wall Street lingo here saying that this company can't put up strong sales versus strong comparisons to a year ago. Wingstop doing its part disproved that thought today.
Yeah, it's interesting though, Saz. Just as you're talking, I was, saying let's just pull up a couple names that are kind of in the same bucket, as Wingstop and see what we're looking at over the last 3 months. Because to me, this speaks to that theme of a trend that worked so well in 2020. People can't leave their houses and they want comfort food. They want junk food, right? And so we saw how well the national pizza chains have done. Wingstop had a huge year as well. You look over the last 6 months, I mean, these stocks are flattish, up a little bit. Wingstop is almost exactly unchanged over 6 months. S&P 500 is up about 20% in that period. So you continue to see this divergence, I think, in some of these default stay-at-home trades. Again, they're starting to lap that 1 year, and you mentioned analysts thinking about how they're going to lap the comps. I don't know. I think it's going to be interesting to see if, a Domino's, if a Papa John's, if a Wingstop can have a new kind of growth story, because it was really just what they call it yesterday, a COVID cyclical. I think one of our guests called it. And I think that's an interesting bucket to look at.
Yeah, we'll see what effect sports opening back up has. Also, if people have more games to watch at home, are they going to be ordering wings to watch those games? I don't know how that. I do neither of those things. So we'll see how that affects the whole dynamic. All right, on behalf of myself, Miles, and Laser Eye Brian Sazi, stick with us. There's much more Yahoo Finance coming your way. Jared Blickery sitting in for Zach Guzman today.
to Yahoo Finance Live. I'm Akiko Fujita. We've got Jared Lickery along for the ride for the next 2 hours today with Zach Guzman taking the day off. And we are starting a new quarter with a new high. Take a look at where stocks are trading right now. The S&P 500 crossing the 4,000 level for the first time. We are seeing it up about 35 points. The Nasdaq up about 220 points with strong gains for the tech sector. And the Dow up 111 points. Going big on infrastructure, President Biden unveils an ambitious $2 trillion plan to supercharge the economy. We'll break down the specifics of the American Jobs Plan and the concerns over the price tag. A new study boosts confidence in Pfizer's coronavirus vaccine, while new questions emerge about the quality of Johnson & Johnson's. And the economic case for equity and inclusion. We are talking to Twitter's VP of Diversity this hour about the tech company's aim to increase the number of women and minorities on its executive team. Let's begin this hour with the president's bet on infrastructure, though. Biden unveiling that $2 trillion American Jobs Plan on Wednesday, saying this is the moment to reimagine and rebuild a new economy. Our very own Jessica Smith following this story for us today. Jess, I'm going to have you walk us through some of the details, but of course, there are questions about what the next steps are to getting this package passed in its entirety.
Right. President Biden did lay out that plan that has more than $2 trillion for revamping the nation's roads, bridges, highways, broadband access, and much, much more. The administration says it's going to create millions of American jobs, but now that plan has to be made into legislation, and Democratic leaders and the Biden administration have to convince enough lawmakers to get on board with this plan, and that's going to be a challenge. The White House says it is already reaching out to Republicans. We heard the president say yesterday that there's no reason this cannot be bipartisan. He says he's really trying to make the case that this is a once-in-a-generation investment in America that needs to happen in order for the U.S. to remain competitive globally. But Republicans and business groups are pushing back on that, saying that raising the corporate tax rate to 28% will make the U.S. less competitive. The plan is also getting some pushback from progressives as well. Let's watch.
The short answer is I'd love to do an infrastructure bill. I'm not interested in raising taxes across the board on America. I think it will send our economy in the wrong direction. Hopefully, they don't choose that path, but they may.
If we actually want, in good faith, to make this vision and the commitments that they've put down happen, we need a more robust investment.
Congresswoman Alexandria Ocasio-Cortez there saying that the U.S. may need to invest up to $10 trillion in 10 years. Now, remember, this is the first of two economic plans that the White House plans to lay out. Another one called the American Families Plan will be introduced at some point this month. The president says that is going to focus more on education, childcare, and healthcare. So this is really just the beginning, Akiko.
Okay, Jess, we will be following its progress. Thanks so much for that. Jared, we've got some big moves in the market on the back of this announcement, of course, because of what is detailed in this plan. Let's look specifically at semiconductors, though. $300 billion overall set aside for U.S. manufacturing, but $50 billion of that is for semiconductors. We've been talking a lot about the chip shortage, the need to manufacture here in the U.S., and it looks like we're seeing some significant moves in the market on the back of the president's announcement today.
Yeah, I think so. And plus throw in Micron earnings after the bell yesterday that really wildly exceeded expectations. They upped their full year guidance. And, the memory chip business is very cyclical. We were in a drought a few years ago. Take a look at Micron here. You can see a lot of green in the heat map in the semiconductor industry. And I think the trade war, President Trump's trade war back in the day, was kind of a shot across the bow for a lot of manufacturers that we need to get supplies. We need to put at least part of the supply chain in the U.S. And if the Suez Canal has taught us anything, it's that just-in-time supply lines do have effects, and they can really hurt industries. As you mentioned, the chip shortage with automakers, game consoles, not so much reflected by Micron, but there's a lot happening in the space. And both Micron and Western Digital, according to the Wall Street Journal, are bidding for Kioxia. I think that's how it's pronounced, not sure. Offshoot of Toshiba a couple years ago. These are big deals. You got NVIDIA still making a bid for ARM technologies. Just a lot of consolidation going on in industry, and also continuing on the trend that you have the fabricators, those who make the chips, and those who design the chips. So, NVIDIA designs them. Intel has doubled down on fabricating them and designing them.
Yeah, and you get the sense that maybe that's kind of where the pendulum is swinging back after so many of the chip makers went fabless because of the shortage and some of the choke points we've seen in the supply chain, really hampering manufacturing for a lot of these companies. The other space we're watching closely today on the back of the president's announcement is, of course, the EV space, where we have already seen a huge run up this year. But the president specifically talking about $174 billion to boost the U.S. market share of EVs. He's already talked about adding the charging stations, 500 EV charging stations by 2030. What are you seeing in that space in the session today?
Well, it's up. I think everything that could be up on the back of this is basically up. You're not seeing it reflected in some of the traditional companies like Caterpillar or Deere, although they're going to benefit from this. Even the transports are going to benefit, but the outsized winners in the long term are going to be those who can benefit from the government tax credits. Tesla really has made a lot of money. In fact, a large portion of their profits are in carbon credits. So this is a big deal. It looks like it's going to probably happen within the next few months. I think July might be an ambitious target, July 4th, specifically for U.S. Independence Day. But I'd say in the big picture, think about every filling station in the U.S. Being converted into a charging station of some sort. I mean, it's going to happen in one way or another. So we're really in the the beginning stages here.
Yeah, of course, with EVs, I mean, there's so many different moving pieces. You've got the oil and gas side of things, where things are moving there. As you pointed out, there's so many part suppliers to electric vehicles. And of course, the car makers themselves really going through significant transformation. Jared, let's add another voice here to the discussion. We've got Chris Wallace, who's Von Nelson Investment Management CEO, CIO, and Senior Portfolio Manager. Chris, let me just get your first reaction to what we got from the president yesterday. Certainly the market was expecting a big infrastructure plan. How much of this is pretty much in line with the moves that we've seen already?
I think it's very consistent with the moves we've seen already. And first off, I think it's needed. If you look at the fundamental base economy we live in, it's still a low growth, low inflation environment. So we're in a situation where you're going to need federal spending to boost economic activity and kind of restore economic health. But more importantly, we need the government to lead in these new initiatives, whether it's clean tech and EVs, and even in basic R&D. And it's spending that we should have been doing the last 5 or 10 years that's finally going to happen. So I think it's pretty positive for the economy overall and the markets in general.
Yeah, and we're seeing the economy heat up here. We just got the ISM manufacturing print, highest since 1983. Is there potential here? Any concerns do you have about overheating? In other words, just turning up the dial too quickly here, too fast?
No, I don't. I think it's important to take both the first quarter and really the very end of the fourth quarter in context, which is it's still a reopening trade. When we shut down the economy for the pandemic, we broke a lot of supply chains. And we drew down a lot of inventories. We're still trying to catch up and rebuild inventories across the economy. We're all acutely aware of the shortages in the semiconductor space, but it spreads out through almost every supply chain you can think of. And we're in an accelerating growth, accelerating inflation environment. That's good for all sectors of the stock market and the economy. We're going to remain in this mode at least through the second quarter and probably into the third quarter. And so I'm not worried about an overheating. If anything, everything still points to the fact that the inflationary pressures we're seeing are real. They're more than base effects, but they're still transitory. They're reflective of the stimulus we've seen. They're reflective of the breakdown in global trade where you've had high cost producers to be able to compete with the low cost producers. And let's keep in mind the investments we made during the pandemic are high productivity investments. So we still have all that productivity to come through over the next 12 to 18 months. So I'm not at all concerned about overheating. We're already getting leading indicators that show we'll have a global growth slowdown on the industrial side later this year. So everything points to this is just a normal cyclical recovery with the nuances of the pandemic.
Chris, let's talk about some of the sectors that are likely to be big beneficiaries if, in fact, this infrastructure package passes in its current form. Electric vehicles, one Jared and I were talking about before we came to you, so many EV companies that have come to market, either the direct route or through SPACs. What are some of the names you like in that space, especially given the amount of money the president has said he wants to set aside to really supercharge this transition into EVs?
Sure. I won't get into specific names only because compliance will come after me. But let me break it down beyond just your typical EV companies that everybody's familiar with. Those are the early winners from a stock performance standpoint. They demonstrated the attractiveness of the market. It's time for investors to start branching out beyond the names we all know and look at the subcomponent suppliers, look at the material companies beyond even the rare earth, copper, and cobalt. When you think about the transition that's underway, it's going to completely change the content in your average vehicle. And there's going to be a much higher IT component of that. And that's true all the way down the value chain. So it's beyond just semiconductors and software. It's higher end materials that are going to be needed even for painting applications. So as we develop more self-driving technologies, you need different reflective characteristics on the paints themselves. So this is really going to proliferate throughout multiple supply chains, not just in tech. We're going to see beneficiaries also develop in traditional auto space. I mean, one name I'm not afraid to mention because we don't own it, which is Volkswagen, right? We're going to watch this company completely transform and likely be one of the largest producers of electric vehicles by the end of this year. And we're just early in the S curve. So I think it's an exciting time. I think it's going to create a lot of excess capacity. I think Jared, you mentioned earlier in your commentary, we're just in the infancy. We do not know who the winners and losers are going to be. So as an investor, what I'd prefer to focus on are the choke points. Focus on the suppliers, the picks and shovels that are selling into these OEMs.
Yeah, I'm glad you brought up Volkswagen because they've really stolen some market share from Tesla in Europe. And I do remember the time they briefly became the most valuable public company in the world in a short squeeze. But I want to shift over to the electrical grid. We've seen a number of cracks in service. California comes to mind, Texas more recently with the polar vortex. What can we do to get this up to snuff? Because decades of neglect leave us with some real problems here.
Yeah, it's a really critical issue. I mean, we can't think we're going to compete in the world stage as an economic superpower if we don't have stable energy. And like every other element in our economy, we've underinvested in it. Not only do we need to harden the grid, we need to boost generation capabilities. There's a lot we can do. I know when people start thinking about clean tech, that you automatically go to non-renewable sources for energy production, but there's a lot of investment that can be made so that we can take traditional sources of energy generation and use carbon capture and dramatically reduce the carbon footprint. And that's going to be necessary for the transition anyway. So we're going to see big investments in generation. We're going to see big investments in hardening the grid. And a lot of these get to, strategic issues. I mean, we like to think of this as things that are nice to have, but the reality is these are going to become national security assets, similar to the White House's push to bring semiconductor manufacturing back to the U.S., because those are strategic assets. These are going to be like defense assets. So we're going to see big investment in the investment grid across all areas, not just renewables, but in traditional generation, hardening, a lot more transmission and distribution, and we're going to have to. I mean, it's silly to think we're just going to start filling up our cars off the electric grid and not have to make some major investments along the way.
Chris, the flip side to that is what happens to the fossil fuels industry. And we've had so many guests on who are really bullish on oil right now, energy stocks in general, stemming directly really on the reopening trade. both WTI and Brent crude today up more than 1%. Of course, we're looking at the OPEC meeting on the back of that as well. But how are you positioned in that space, especially if we're talking about this grand plan and this ultimate transition that's going to happen that will reduce the amount of fossil fuels in the market?
Yeah, I think it's important to realize, I think we would be lucky. We'd need breakthrough technology to really reduce the amount of fossil fuels that we're going to consume on a go-forward basis. I think a better way to think about it is we're going to see traditional fossil fuels have a lower and lower percentage of overall energy that is consumed, whether that's for transportation or other sources. I think it's going to be very dangerous to not continue to invest in our fossil fuel production. I think it's, unfortunately, the U.S. was a one-time beneficiary of our shale investment. That was a bubble. It's unsustainable. Without it, we would have already been in an energy crisis. Unfortunately, we have not, as a globe, we have not been investing in fossil fuel production since 2014. A lot of the projects that were started then have already been brought online. So as we reopen, as we continue to consume fossil fuels and grow, it's going to put a strain. So I'm relatively constructive on oil prices and even natural gas prices. I would caution people, we're not going back to 100 unless we have a geopolitical event, but $60, $65 oil is a high enough price for investment to occur. I think, unfortunately, some of the policy stance we're taking is going to deter investment, and that's going to lead to price spikes in fossil fuels. This transition is a multi-decade transition. And I think a broader point for investors to think about, over the last 2 or 3 years, we've been focused on one sector winning versus another sector, value versus growth, financials versus tech. We need to clear those misconceptions. We're in a position now, everybody's going to do better. The investment that's being pushed forth is good for everyone. We've kind of repositioned the market in the first quarter. So just because it's good for clean tech doesn't mean it's going to be good for traditional, not going to be good for traditional energy players as well. We're going to be in a pretty broad-based positive environment for a while.
Jared, it looks like you're muted there.
Rookie mistake, first day of the quarter. I do get one of these. I just wanted to note that we do have some OPEC Plus headers crossing the wires as you were talking about the price of oil. They are going to agree to resume gradual monthly output hikes. That's according to a delegate, and the talks are going to continue on details of that output agreement. So Chris Wallace, Vaughn Nelson, Investment and Management, CEO and CIO, thank you for joining us. All right, if you're sitting at home scratching your head wondering if you've got COVID, congrats, you've now got some options. The FDA is authorizing an over-the-counter rapid antigen test by Abbott Laboratories, as well as an at-home test by the diagnostics company called Quiddle. Abbott stock is up about 10% on the year. And sticking with pharmaceuticals, coming up, we're going to discuss a number of developments in the vaccine space, which we'll chat about with Dr. Amesh Adalja from Johns Hopkins. Stay tuned. A kink in the vaccine rollout. Johnson & Johnson is tossing out a batch of its COVID vaccine. That's after they revealed one of their manufacturing partners, Emergent Biosolutions, botched a 15 million batch due to human error. Here to discuss is Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar. Welcome, Doctor. So the optics on this are bad, but the safety protocols, essentially at the end of the day, they work because they caught this. What's your big picture take on what happened, and does this do any damage to the vaccine rollout?
I don't think this will do anything to the vaccine rollout time scale. I think we'll still get to the goals that we're going to get to. Johnson & Johnson has been able to deliver vaccine for March, and this is for future shipments, and we do have Moderna and Pfizer. But I think that the larger issue is that anytime there's a bad headline about these vaccines, it's going to add to vaccine hesitancy because people tend to forget the actual details of what the story was about, but they remember another glitch or a hang up with this vaccine. And I think that's the part where we have to really be proactive in trying to talk to people about the fact that there are multiple safety measures in place and human errors can occur when you're manufacturing something at such a large scale. And this was caught, and it's not really going to derail any of our plans to put this pandemic behind us through the use of this vaccine.
Yeah, that's certainly been a big concern among healthcare workers of people not wanting to go and get vaccinated because they're not sure if it's safe. Now that most states have expanded the pool of those who are eligible for these vaccines, how much of that hesitancy are we seeing, and what more do you think needs to be done from an education standpoint?
It's hard to know exactly what the hesitancy is going to look like when we get to a time when we're not supply constrained, when the vaccine is in plentiful supply. And I think that's going to be the case. But the issue is that we have to really do is be proactive and provide information to people. People are going to ask questions about a new vaccine. That's normal. We have to be able to give them trusted sources of information to look at the safety, to look at the efficacy of this vaccine. And I think that's the best thing we can do. We have to also reach out to populations that are more vaccine hesitant. For example, we're seeing conservative males being one group where they don't want to take the vaccine. So there have been specific campaigns aimed at them. So we just really have to set the tone of this debate, and the vaccines data speak for themselves. And I think we can really all we can do is really give people the data and meet their concerns where they are and try to answer them and hope that they'll make the right decision.
And Doctor, the other news we got on the vaccine front is Pfizer and BioNTech coming out and saying that essentially their vaccine has shown to be effective over the last 6 months. Of course, we're just still talking about the early days of seeing in real life what the efficacy is there. But what's your takeaway from the study, and what does it ultimately mean in terms of being able to get to herd immunity by summer?
You have to remember what we're doing are natural history studies. So we're following people who are vaccinated and looking at their antibodies, looking at their T cells, looking to see if they get reinfected. And I suspect 3 months from now, we'll read another study saying that the vaccine is effective for 9 months. It likely is going to be something that has some duration of immunity that maybe would be 1 year, 2 years. We don't quite know exactly where it is because we can't foretell the future. But I do think that this induces robust immunity, and we probably won't need boosters on a yearly basis. Maybe it'd be something more on a two-year basis or 5-year basis. It's hard to know exactly. But what we're seeing with all of this data is that these vaccines are tremendous and that the benefits of having this vaccine rollout are going to accrue. And I think we'll have to stay tuned to see exactly if we need to update the vaccines because of variants or if we need boosters to boost our immunity. But so far, everything is looking really good when it comes to these vaccines.
And Doctor, we've gotten a number of warnings this week as more and more people feel comfortable going out, states start to lift restrictions, that we are not out of the woods yet here. Dr. Fauci, of course, warning of the plateauing of the numbers. We heard the CDC director also talk about concerns. As you look at where the case count stand, where the hospitalization stands nationally, what's your biggest concern when you counter that with the lifting of restrictions?
So I'm somebody who thinks that this vaccine rollout was really geared to do 3 things: stop serious disease, hospitalization, and death from COVID-19. So that's already starting to happen. If you look at nursing home cases, nursing home deaths, if you look at national hospitalization numbers, they are low, they're going down in most places. And when you even look at places where there is an uptick, it's nowhere near what it was during the winter surge, for example. So I think what you're going to see is a decoupling of cases from severe disease and hospitalization. And we're going to have to start looking more at hospital capacity because this vaccine is really doing a great job. And as we roll out the vaccine into younger groups, those those who are getting infected now, we're going to see those benefits accrue. It's important for people to remember, however, that if they're not vaccinated right now, we're still in a pandemic. You still can get infected. You still can have a very hard time with this virus. So we need people to continue to wear masks and to continue to wash their hands a lot and try to avoid crowded places. As states increase capacity and reopen, the best way to do that in a safe manner is by making sure that people are still wearing masks and to accelerate your vaccination program.
And Doctor, finally, we're talking to you on opening day of baseball. And when you look at nationally what the capacity is, it really does vary. Over in Texas, of course, the Rangers have gone to 100% capacity in the stadium. The Astros going to 50%. The Rockies over in Denver at 40% capacity. And then you've got this news that just came down. The New York Mets, their season opener has been postponed because of COVID issues. What's the concern here is, to your point, more and more people feel comfortable going out there. Should we be concerned that stadiums are starting to fill up again?
If the stadiums are open and having fans there, and they have appropriate measures in place, social distancing, mask policies, trying to encourage vaccinated people to go there. But I don't know if every baseball fan is going to be vaccinated at this point. That's the way to make it safer. You can do this in a safe manner and you can do it in an unsafe manner. So it's really important that you get this right, because mass gatherings like that can be places where you can get a lot of cases and a lot of chains of transmission set off. So you want to make sure that you really have a policy in place that's going to reflect the fact that we're in a pandemic. And I think that's going to be different in each state. Each state is handling it differently, but people have to make smart choices and risk calculate. I think you can do a baseball game safely if people remain socially distant, if people wear their masks, if you're vaccinated. I think it's a much safer prospect to go to than if you're not vaccinated. But I think we're kind of in this limbo stage where the vaccine has given people a lot of hope, rightly so, to getting back on track. And we're not quite there yet because we haven't gotten the vaccine into those groups of the population that need it now because they're getting infected. So I think this will probably change over the next couple of weeks. We'll start to see a better environment in terms of cases and for gatherings like baseball games.
Yeah, a good word of caution there. Dr. Amish Adalja, Johns Hopkins Center for Health Security, senior scholar there. It's always good to have you on the show. Thanks so much for your time. Coming up, we're looking at the big moves in the chip space. Micron potentially on the cusp of a new deal. Jared's going to break down the moves for us in this space after this short break. Welcome back to Yahoo Finance Live. We are paying close attention today to shares of Micron and Western Digital. Jared, on the back of that headline we got from the Wall Street Journal today that they are in talks to potentially acquire Kioxia, which I think a lot of reviewers may not be familiar with in terms of the chip space. It's a spinoff of Toshiba's chip business a few years ago. But what do you make of the moves here? We're talking both stocks up more than 4%.
Yeah, what do I make of it? I'd say it's bullish. This is an exciting deal from a number of perspectives, and it's really representative of what's happening in the industry. We were talking about this at the show open about the consolidation and whatnot. But just take a look at a one-year chart. We got Western Digital here. You can see we really got liftoff around the election. That was last November, and we've just been consolidating near highs over the last 4 weeks as tech has really taken a backseat to some of the other sectors. And also, here's Micron. That's up 132% over the last year, a very similar chart. After consolidating most of last year during the COVID mess, really came alive in the latter part of the year and the beginning of this year. There's a lot going on in the market today, though. In the Nasdaq 100, the mega caps really leading the way. We got Alphabet up over 2%, so is Microsoft, Apple, under 1%, Amazon and Facebook a little bit more, and then Tesla up 1.5%. Worth checking in on the EV space, especially after that big infrastructure bill speech that President Biden gave last night. XPeng Motors up 3%, still up 77% from the year, although they've given back a lot from the run-up they had in November. Also got to check in on European stocks. We just closed. Settlement is underway, and we can see in London, the FTSE is up about 0.4%. In Frankfurt, the DAX up 62 basis points. And in Paris, the CAC 40 up about a little bit less, 0.6% as well. Well, let's go back to the heat map space because I do want to check in on the sector action. And we've seen the tech and communication sectors. Those are both in the lead, the only ones that are outperforming. So the mega caps really driving the moves higher. By the way, S&P 500, 4,000. Can't wait till it's S&P 500, 5,000. I'm going to break out a hat for that. But taking up really the defensive sectors. We got staples, utilities. Those are not the least bad, the most down, the biggest laggards here, Akiko.
I was going to say, I think you have hats for a number of levels, right, in the market. Do you have your 4,000 hat?
Not yet. I think I'm going to hold out for 5,000. Maybe get a Bitcoin one. Wait for Dow 50,000. Who knows?
Yeah, I mean, given that a lot of our guests have said Bitcoin's going to exceed 100,000. Might as well get that hat ready. We'll see. All right, coming up, pro-democracy activists in Hong Kong face jail time for their involvement in the 2019 protests, plus the fallout from Deliveroo's dismal IPO. You see it under pressure there yet again. We'll be right back. In our worldview today, prominent activists in Hong Kong face up to 5 years in prison for their alleged involvement in the 2019 protests. 7 leaders, including media tycoon Jimmy Lai, were convicted on unauthorized assembly charges in yet another blow to the city's pro-democracy movement. Beijing's been tightening its grip on the city since changes to Hong Kong's extradition law sparked massive protests in 2019. Earlier this week, Chinese leaders officially approved changes to Hong Kong's constitution, dramatically reducing the power of democratically elected officials. Secretary of State Tony Blinken said China had severely undermined the rights and freedoms of people in Hong Kong. The defendants will be sentenced on April 16th. Over in Brazil, President Jair Bolsonaro is facing growing calls to step down. Opposition leaders demanded his impeachment in parliament for his, quote, illegal attempt to co-opt the armed forces. This comes after Bolsonaro fired Brazil's defense minister on Monday, prompting military leaders from all 3 branches to step down. Bolsonaro is already facing public outrage over the government's handling of the coronavirus. Nearly 320,000 Brazilians have been killed so far, making the country one of the hardest hit in this pandemic in the world. And over in France, the country's prime minister declaring the 3rd wave of the coronavirus has arrived. Speaking at the National Assembly, the prime minister detailed additional COVID restrictions after President Emmanuel Macron imposed a limited month-long national lockdown starting April 3rd. Schools and daycare centers will now be closed for much of that period, while travel within the country will be banned. A 7 p.m. curfew has been extended to the rest of the country. Daily new COVID infections in France have doubled to nearly 40,000 since February. Let's turn our attention to overseas markets. We are seeing green across the board over in Europe. Let's bring in Yahoo Finance's LaToya Harding, who's tracking that, as well as the fallout from that dismal IPO for Deliveroo.
Yeah, as you said, stocks are in the green today, and they've all just closed not too long ago. And that was after Deutsche Bank today upgraded its growth forecasts for the UK economy. And that follows a revision as well for last year from the Office for National Statistics yesterday. Now, Deutsche said it expects this year at 6%, which is a 0.3 percentage point increase and a 1% increase as well above the Bank of England's February projection. It said that a faster roadmap out of lockdown meant that the UK is poised to grow a lot faster than its peers. So that pushed the FTSE up today, and the pound also higher against the dollar and the euro. Both of them also were buoyed by encouraging manufacturing data we had today. We had a survey that showed that manufacturing growth hit a 10-year high in March. And that was thanks to, again, the swift vaccine rollout in the UK. But the DAX, the CAC there also closed in positive territory today. They stayed pretty positive throughout the session, opened high, buoyed by President Biden's infrastructure plan, and reports that ministers are planning a traffic light system as we head into the summer to unlock foreign travel, which lifted travel and leisure stocks. And these gains, again, coming despite that 3rd wave of infection happening across the continent, and of course, tighter restrictions in France as we heard that decision to impose a 4-week national lockdown from Saturday in the country. And just finally, yes, Deliveroo dropped another 2% today, and that was after, of course, it nosedived yesterday on its market debut in London. Now, yesterday, that marked the first day performance. It was the worst first day performance of an IPO in the city for at least a decade. And of course, tens of thousands of retail investors who invested in the firm through a primary bid, they're facing heavy paper losses. Again, that went down today, and it's bringing into question how bankers that worked on the deal got it so wrong. So people, we've got bankers like Goldman Sachs, we had JP Morgan, Bank of America, and Citigroup. They're amongst some of those that were behind the deal, and it's expected that these lenders will face criticism in the coming days about the valuation they placed on Deliveroo.
LaToya Harding, good to talk to you today. Thanks so much for that. Coming up, the economic case for diversity and inclusion. We are talking to Twitter's VP of Diversity Partnership Strategy about the tech company's aim to increase the number of women and minorities on its executive team. We'll be right back.
following through on its 25 by 25 pledge. That's the Silicon Valley initiative dedicated to advancing diversity in the Bay Area. The company is aiming to make 1/4 of its executives be either women or unrepresented minorities by 2025. Here to discuss is Yahoo Finance's Reggie Wade and Candy Castleberry. She's the Twitter VP of Diversity Partnerships, Strategy, and Engagement. Candy, I want to throw this off to you first. Can you give me an overview of the 25 by 25 pledge and exactly what Twitter is doing to advance the representation of minorities and women?
Yeah, so first I would like to acknowledge that the head of diversity inclusion at Twitter is an amazing woman named Delana Brand. I am grateful to be here as one of the Elite 100. And I am primarily focused on the external work of diversity and inclusion and our partnership together. However, in specifically responding to your question, our 20 by 25 pledge is a shared commitment that we also have with a number of Silicon Valley companies. And that is well documented, as well as I think that when you think about this vision for 2025 and 25% of the leadership being women, you will not only find that we're committed to that, but our deeper commitment goes through our workforce being 50% women, 25% of our tweets, which we are called Twitter employees, being from underrepresented groups. That would include 10% Black, 10% Latinx, and other multiracial and indigenous groups.
Candy, Reggie Wade here. I remember your 2016 TED Talk, and you said differences are barriers only if we allow them to be. Do you think that people are allowing their differences to become barriers, especially on social media in this day and age?
I do believe that in 2016, when I said that, I wasn't working, obviously, at Twitter. However, what I can tell you is social media is a reflection of who the world is. And sometimes there appears to be an expectation that social media, and particularly social media companies, can solve for that, which are societal issues that are only expressed on social media. Differences are still only barriers because we allow them to be. And I know that I, along with a number of DEI leaders, both people who are working internally and externally, get up every day to try to ensure that those differences aren't barriers in workplaces. And for those of us who have a focus on community, to ensure that we are working together to create unity of our voices, as well as amplifying those who are doing amazing work to prevent differences from being barriers, both in workplaces and communities.
Candy, when you look at so many organizations that are trying to address the issue of diversity and inclusion, there always seems to be a real wall between the business side and then those in charge of diversity and inclusion. And I wonder how you think about the structure over at Twitter, especially given that some would argue when you talk about the discussion about diversity, race, social justice, things that have really dominated the headlines over the last year, a lot of that has been elevated by Twitter. What do you think about your ability to address those issues in your role, and how Twitter looks at that overall?
Well, I would say I've worked for a number of companies doing diversity and inclusion work. I've worked for companies where the CEO is committed or the HR leaders are committed. Well, you have a D&I infrastructure or team or councils who are committed. I would say Twitter is the first place that I've worked where I believe we have both a committed CEO, committed leadership, and the team that Delana Brand, who is, as I mentioned before, the head of people experience and I&D, are all committed to ensuring that it isn't just a set of words, that there are actions. Delana publishes a blog on a regular basis, quarterly and annually, that will provide any updates that people need about Twitter's progress. And the work that I'm doing specifically externally is bringing together both nonprofits, NGOs. We work closely with a number of Black, Latinx, Asian, LGBTQIA organizations to think about ways that we can strategically work together to not just think about how we make improvements in the industry, but specifically how we can work together to create sustainable change. It is not going to be sustainable if only Twitter gets it right. It is going to require all of us to work together. And sadly, I think that many people lean in on a single organization or a single industry. And many of the issues that for those of us who've been in this space for any period of time know that they are systemic. They have gone on for decades. And that the only way that these changes come about is through collaboration across industry, across disciplines, and more specifically, that they are integrated into systems change and not just words, that they are supported by actions.
Candy, you're a part of Diversity Women's first annual Elite 100 Black Women in Corporate America. What does that accolade mean to you and being part of such an illustrious group?
Well, I was raised by a Black woman. I stand, I work, I trust, and I work and win with Black women. I'm surrounded by powerful women who are humble, who are smart, who are loyal, who are resilient. And I count myself as one of the humble people to be named amongst this 2021 cohort. I aspire for us to not just be able to acknowledge 100 women for their contributions to corporate America, but someday that perhaps there will be 100 Black women on boards, 100 Black women who are CEOs, 100 Black women who are leading businesses and that are on lists that are not only inside of corporate America, but are doing things that the world can see and acknowledge the contributions that Black women can make to America if we work to eliminate the barriers that in many cases prevent that from happening today.
Candy Castleberry, Twitter Vice President of Diversity Partnership Strategy and Engagement. It's good to talk to you today, and our thanks to Yahoo Finance's Reggie Wade for joining in on the conversation. Coming up, taxes in crypto. That's what we're tackling in our crypto corner today. Certainly a lot of questions given the rapid changes that we have seen in this space. We've got it all covered for you on the other side of the break. We'll be right back. In our crypto corner today, we are talking taxes, specifically what constitutes a taxable event when it comes to digital currencies. We've got Michael Meisler. He is EY America's Cryptocurrency Tax Center of Excellence leader. Michael, a lot of questions in the space, especially because so much is changing. We've seen it grow at such a rapid rate. Answer that first question for me, though. What is considered a taxable event when we're talking about so many different types of currencies?
So lots of different ways to get there. For those that mine Bitcoin, for example, merely mining it and receiving a reward can be considered is considered a taxable event. If you're investing in cryptocurrencies, then any sale or exchange where you're trading one cryptocurrency for another is also a taxable event. And I know there's a lot of interest in NFTs these days, and people should also be aware that if they're exchanging cryptocurrency for the purchase of an NFT, then that transaction itself will require that they recognize gain or loss on the cryptocurrency they're exchanging for that purchase.
Yeah, I want to kind of delve into the nuts and bolts of this. Most people don't think taxes when we're talking Bitcoin here, but I read the other day that simply buying a Tesla with Bitcoin, which you can now do, that's a taxable event because then you have capital gains on it. What kinds of things are going on? What should people have to watch out for as they manage their nascent crypto investments?
So you hit on it, right? As companies are starting to accept cryptocurrency as payment for goods, just buying that asset will require that taxpayers calculate their gain or loss on the cryptocurrency that they're using to buy that asset. So that's the first one. The other one, which for a couple of years, it felt like a lot of people just thought there was the opportunity to exchange one crypto asset for another. And that's not the case. Any exchange of one asset for another is potentially a taxable gain or loss, and taxpayers have to calculate their gains and losses and report them.
Well, that's pretty interesting. Another thing that I've noticed is that we have people who are basically losing their Bitcoin. They lose the keys to their wallet. It's essentially gone. If that happens, is that a tax write-off? Exactly how would somebody account for that, or a corporation for that matter?
That's potentially a problem right now for individuals. After the Tax Cut and Jobs Act, there are some limitations there's some additional limitations on taxpayers' ability to claim losses for theft or outside of being in a federally declared disaster area. So that's something people will need to get additional advice about if it happens to them. If you're holding existing cryptocurrency assets, there are over 8,000 cryptocurrencies out there now, and not all of them have the same value. If your cryptocurrency asset merely becomes worthless, that is potentially a taxable event, and taxpayers can deduct in the year that it becomes worthless. But if it's just lost, that could be problematic as of 2018.
Michael, to what extent has the IRS kept up with the wider adoption of cryptocurrencies? And do you get the sense that there could be more guidance coming?
I hope there's more guidance coming, and I believe that there will be. As I was preparing for to talk with you today, as recently as this morning, there's an article about a new John Doe summons where the IRS has asked an exchange to provide information about its investors. There's no current obligation for information reporting by the exchanges out there, but that doesn't mean that taxpayers don't have to report their gains and losses. And the IRS has a couple of initiatives already in place where they are clearly looking for taxpayers that are trying to avoid their responsibilities. The IRS announced something they're calling Operation Hidden Treasure a couple of weeks ago, where they are working with their criminal division and their fraud division to find taxpayers that are not meeting their obligations. Because the blockchain that these cryptocurrencies trade on, it may not show the name of the individuals trading, but it shows wallets and addresses. And the IRS can find the people behind them if they work hard enough at it. There's also a recent announcement of a bounty on a number of blockchains that are intended to provide anonymity to the folks that are conducting business on those blockchains. And finally, taxpayers should really be paying attention right now as they're getting ready to file their 1040s, the IRS has put right on the face of the 1040 a question asking whether taxpayers have engaged in any sales, exchanges, other transactions involving cryptocurrency. It's right there under the address block on the return. You can't miss it. So they are looking for that information.
Yeah, I definitely didn't miss it myself. Well, we got you, and we got time for one more question here. I got to ask about NFTs, non-fungible tokens. Is that simply a property, like a piece of art that's taxed? Any ins and outs that make this digital, different from the more analog offerings that we're used to?
So NFTs are the latest in a long range of topics that have come up in this space that we don't have clear guidance for at this point. As I look at it today, as we've looked at it, based on the activity we've seen, there's the potential for NFTs to fall into this category, the special category of assets the IRS considers collectibles. And if so, collectibles held for more than a year, when and if they're sold or exchanged, come with a higher tax rate potentially of up to 28%, rather than the normal long-term capital gain rate of 20%. So if you're engaging in activities with NFT, it's another area where you really want to talk with an advisor, think about the facts behind that, and think about what rate you should be paying tax on that asset.
Michael Meisler, EY America's Cryptocurrency Tax Center of Excellence leader. A lot of questions there. Certainly, we hope to have you back on the show again soon. Thanks so much for that. We've got much more coming up ahead in our next hour of Yahoo Finance Live. We're going to be digging into some of those climate initiatives in President Biden's $2 trillion stimulus or infrastructure package. Much more coming up ahead. We'll be right back. Welcome to Yahoo Finance Live. I'm Akiko Fujita, along with Jared Blickery today, filling in for Zach Guzman. It's the first day of the new quarter, and we've got a new high in the market here. Let's take a look at where all three major indices stand, because the S&P 500 holding on to those gains, crossing the 4,000 level for the first time, while the Nasdaq up about 200 points. Going big on infrastructure, President Biden unveils an ambitious $2 trillion plan to supercharge the economy. We're taking a closer look at the climate initiatives in the American Jobs Act this hour. The return to the office, a growing number of tech companies swapping out remote work for in-person collaboration as they look ahead to life after herd immunity. And lessons learned from the Archegos fallout, the takeaways for retail investors as major banks look to recover from the hedge funds collapse. Let's begin, though, with that infrastructure bill and the climate initiatives that could lead to a dramatic shift in the country's energy mix. The president calling for a national standard that requires utility companies to determine the energy mix, increasing the mix for solar, wind, as well as other renewable energies. Let's bring in Rob Gramlich, who is Grid Strategies LLC founder and president. Rob, let me first get your thoughts on the initiatives here that's included in the American Jobs Act. The president said he was going to go bold on the climate initiatives, and certainly this marks a huge transformation if the bill goes through as in its current form.
Yes, great to be here. It's an ambitious plan, but it's everything we've been hearing from the president throughout the campaign and in his early months about really jobs and climate going hand in hand. So this is a deployment-focused plan for clean energy and a variety of related sectors to power, transportation, and heating with electricity and increasingly clean electricity.
Rob, let's talk specifically about this national standard that the president is calling for in terms of utilities to have their energy mix. Certainly, those who have been in favor of this shift have said that renewable energies are so much cheaper than they used to be. But the concern has been about the storage elements of all of that. So we're talking about an ambitious plan. To what extent is the technology there to be able to scale out in the way the president is calling for?
The good news now is renewable energy is very cheap, and we know how to integrate it into power grids to get an overall reliable supply of power. It does require storage, as you mentioned. It also requires transmission, and those are both parts of the plan. We can get to 70, 80, 90% of our electricity from renewable sources, as long as we have those complementary technologies. We know how to get that far. There'll be some R&D probably necessary to develop other sources by 2035, which is the end target for the president's plan to fully reduce carbon out of the power sector.
Yeah, I want to focus on cybersecurity right now and how the nation's grid is vulnerable. We know that. We've seen some attacks around the world at various locations. I think we've been spared mostly any big disasters, but how big a priority is cybersecurity when it comes to the nation's grid and electric supply?
Cybersecurity is a huge issue for all utilities around the country. They, of course, control their power systems. They have all sorts of sophisticated cybersecurity protections. They're not using the software that was used in other countries that were hacked, and we have good government oversight at the federal level. So there are a lot of protections in place, but at the end of the day, as everybody knows, with many systems and many attackers, we're always at risk. And I think it is something that everybody needs to be prepared for. Local authorities always need to be prepared for the unexpected. And things can happen to the power system, as we saw in Texas, that nobody expected, and we need to be ready for things like that.
Rob, where does this renewed focus on renewable energies leave natural gas? For so many years, we have talked about natural gas as sort of this bridge fuel, although the industry would argue now that they think there is a future there alongside renewables. How do you look at that as part of the mix?
Yeah, I think right now the natural gas system is the battery. It is the real battery that is there when the wind and sun are not available. At nighttime and when there's slow wind speeds, and that's how most systems are operating right now. So gas is that firm, flexible source that's there and available, and I think it will be for quite some time. Now, if we obviously in 15 years want to be fully carbon free, then some other source will be needed to provide that produces no emissions. And that could be gas plants where they capture the carbon, or it could be a variety of other sources. And that's where R&D come in, and they're also part of the jobs plan that the president just released yesterday.
Yeah, and we're seeing the government kind of step in and provide a lot of subsidies for the industry. Historically, this is something they've done. At what point in the future can the government just kind of step back and say, all right, the market's mature enough, we can let it take care of itself? Or do you not see that happening at all?
There's two ways to look at that question. One is, will clean energy grow without any form of policy support? The answer is yes. The economics are so strong. Wind and solar are so cheap. But the other way to look at it is, do we want to meet carbon and greenhouse gas emission targets and lead the world and get all the other countries who are often bigger emitters to do the same? And if it's the latter, then we do need some policies to accelerate the pace. And that's what this Biden plan does.
Rob Gremlich, Grid Strategies LLC founder and president. It's good to talk to you today. Appreciate your time. Let's turn our attention to the market implications of this $2 trillion ambitious infrastructure bill. We've got Simeon Hyman, ProShares Global Investment Strategist. Simeon, this announcement was anticipated for a long time here, but certainly it comes at a time when there are concerns about the inflationary pressures that are building. How do you look at this in that context?
Sure. We've had rising rates since last summer, since they really bottomed out right in the midst of the worst part of the pandemic. What's notable, I think, is we had those little hiccups back in February, but the markets held up reasonably well in the face of those incessantly rising rates. And the big driver overall is the fact that the economy is growing really strongly. If you're looking for a key driver of today's rally, ISM manufacturing this morning at a high not seen since 1983. So that is coming from, yes, the anticipation of some more fiscal spending, the plan that was just enacted, and of course, very high savings rates. So at least for now, the equity market writ large is saying, I think the growth is coming along with those rising rates, and therefore risk assets are in a decent place.
Yeah, I did a double take when I saw that ISM print this morning, especially with that headline, 1983, pretty incredible. I want to shift to the broader market here. S&P 500 tops 4,000 for the first time ever, record high. But we've seen some violent rotations under the market's hood since the COVID sell-off. In this rally that we have, where do you see the hot money flowing into the future, especially on the back of this infrastructure deal?
Yeah, let's think a little bit less hot, because we like to think in quarters and years and not weeks. But, indeed, there has been a little bit of rotation towards value, but we think perhaps the more enduring rotation is to higher quality alternatives like consistent dividend growers. And I bring that up particularly in the context of a pretty good day for technology, because one of the perhaps not as well understood applications of focusing on dividend growers is in the technology sector that has begun to mature. In fact, technology is now the highest source of dividends in the S&P 500. So if you look at an index like the S&P Technology Dividend Aristocrats, it's actually done really well this year, substantially outperforming the broader tech sector and QQQ and the other pieces of what was really part of the 2020 story.
Yeah, it's interesting to think about Apple maybe becoming less of a growthy tech company and more of one of those stable dividend payers. But I want to talk about the dividend space and the value in cyclicals, because you mentioned finding these quality companies. Is it simply about the balance sheet at this stage, or we've seen the GameStop, Reddit phenomenon, where hot money just chases these, what I'm not going to call it a garbage stock, but I'm going to say the fundamentals probably don't justify the values. How do you filter out the noise and find these companies?
Yeah, look, there has definitely been some elements of a junky rally here, and even if you look at small caps as an example, forgetting the eye-popping names that you're talking about, but even if you look more systematically, you would see that, for example, the lowest quality of the Russell 2000 have been the strongest performers of late. For a more enduring trade, yes, you look for quality. You could chop apart balance sheets. You could chop apart income statements for margins and things like that. Our perspective is if you find those companies that have grown their dividends consistently for many years, it's an elegant approach because it captures all of those elements. And if you look at the S&P 500 dividend aristocrats a little bit more broadly, what you would see this year is the achievement of almost all of the returns of that quick momentum shift to value. But we think perhaps a more enduring trade because not only are the balance sheets stronger, but it's the growth of the dividends that make them extra resistant to rising interest rates, because that's really important here. The rates really are rising, and if you don't show up with some notable, not just nominal, but real growth, you could be left behind. And those S&P 500 dividend aristocrats actually grew their dividends 14% last year in the midst of the pandemic. So those are, we think, really important attributes.
Tim, and you're talking about the data we've gotten so far that points to the economic activity picking up again. Jobs numbers coming out tomorrow. What are you going to be looking for in that data, especially given the number we got yesterday for private payrolls, adding to the gains for the first time or the strongest gains we've seen in 6 months?
I think the key over the next 6 months is going to be the increasing in the participation rate. That's what's going to be really important. One of the reasons why I think we would say we're not so worried about inflation is that you have low numbers in things like capacity utilization. You have low numbers in things like labor force participation. So there's room there. As that participation rate increases, I think we'll start to keep more of an eye on that. So I'm looking at participation as much as the specific numbers of jobs that are created or the headline unemployment rate.
Well, let me follow up on that because we got time for one more here. Thinking about that participation rate and what's happening with the jobs, how should the, let me put it this way, we're probably seeing some declining productivity figures because we're throwing a bunch of money at the wall and seeing what sticks. Is that another headwind long-term that people maybe should keep in the back of their minds along with the inflation concerns, again, down the line?
The improvement in productivity has been such a durable secular trend for decades now. I'm not sure you really want to bet against it. And look, this is not a declaration of the new normal, but gee, I'd be pretty shocked if inflation went particularly, meaningfully past the 2% Fed target. Not only are they likely to is the Fed likely to become vigilant in that regard and other central banks around the world, but there's just so much evidence pointing towards the long-term trend for productivity growth to allow for both nominal and GDP growth and keep a reasonable lid on it on inflation over time. Now, look, we're still only at 170 on the 10-year. We could get to 3% with very low inflation and real rates below normal, but something kind of out of control, I don't think I would see it in the cards.
All right, Simeon Hyman, ProShares Global Investment Strategist, thank you for joining us. And cannabis stocks getting lit as New York prepares to legalize it. The $4 billion market will also provide some much coveted tax revenue for the states. We got Cresco Labs up over 3%, Grow Generation up over 2%, and guess what? Green Thumb, that's up about 1.36%. After the break, unemployment remains stubbornly high for many. We'll talk to Jean Guo at Connexio. This is a firm that brings digital skills to the displaced. Stay tuned. With jobless claims still hovering around pre-COVID records, some of the hardest hit remain youth, displaced, refugees. And here to talk about this with us is Jean Guo. She's the founder of Connexio. And Jean, I just want to ask you about your personal story here. It's pretty interesting, did a little background reading on it, and how you came to found your company and what you're doing.
Yeah. First of all, thank you so much for having me. I'm happy to be here and to talk a little bit about how I, got to the process of launching Connexio, because I didn't see myself as a social entrepreneur to begin with, but I actually came through a more academic route. I was doing a Fulbright fellowship at the Paris School of Economics, and it was through the research on the ground that I was doing, field interviews and other types of studies, that I realized that there was kind of upfront services that were, targeted to housing or food or shelter, or different types of very basic needs that were being met, but not services helping people to really become integrated in the long term, which was for me skills and jobs. And that's how Connexio got started, helping to really train the most vulnerable for the future of work, the skills that we need, a lot of the changing dynamics of our labor market. And so this is where we see ourselves positioning ourselves to meet the new trends in the labor market with talent that are diverse, that are motivated, and can really bring a lot to our future.
Jean, walk us through how Connexio works. How do you identify the need, and what does that skills program look like?
Yeah, so at Connexio, we have different ranging skills programs that go very much from the basics. So very, basic targeted, almost literacy skills. And we work with, different partners. So the partners that source our students to really be able to identify the needs of our students. We place them, we do an initial diagnostic assessment, and then we place them on a range of modules that can really go from the digital literacy building blocks up to very advanced boot camp, training in terms of development web or other professions that lead to, cloud or cybersecurity experts. So we really run the full gamut of the digital skills spectrum. And our goal is also to work really in tandem with employers and companies. So the idea is that at the end of the training and almost throughout, we work with companies to really identify those who really would like to seek out our talent. We work with them to also, prepare for their interviews. And so, amongst our recruiters today, we have startups in the local ecosystem up to, big corporate partners who have welcomed our talent into their fields.
Well, just following up on that, I had across the other day, Elon Musk, Tesla, he says, you don't need a college degree to come work for Tesla, just come in, we'll train you. Is this the kind of situation that you're talking about? And how much does it matter to form high-profile partnerships? Because, you work with Tesla or Ford even, or one of the big Fortune 500 companies, that gets you some ink in the header in the papers. So exactly what does that larger strategy look like?
Yeah, so I think for us, and I think it's a big question today, do we really need, a certain level of education, a certain diploma, or is, the future of work really trending on the skill sets that we have? I think something we really value at Connexio is thinking about how do we build, well-rounded individuals in both tech, the hard and the soft skills, and really prepare for them to not only, successfully integrate into companies, but to also evolve and really adapt. And so I think, thinking about, our high-profile partnerships, we work with companies like Google, like L'Oreal, who've given their trust in us to be able to work with our students, with our talent. And I definitely do have to say that, for a company like Google, who really also values more how you do in the interviews, not, what university you came from, not what kind of diploma you bring, I think valuing the skill set of the students on kind of the pure meritocracy is something that is really important and I think should be valued moving forward as well.
Jean, a lot of your work is focused in developing countries. How do you look at the economic value that's actually being unlocked as you bring more and more people into the workforce?
Yes, so thank you so much for asking that question. So today we work in Europe, and then we also started developing one of our first programs. Actually, we piloted in 2019 with UNHCR, the UN department that works really with the refugee and displaced persons population. And for us, what was really important about this program was to be able to work in the most resource-constrained environments. So we work on the ground in Jaleka refugee camp of about 40,000 inhabitants, and these are individuals individuals that do not have access to work opportunities. And so what we're able to do with our local partners on the ground, including JRS, Jesuit Refugee Service, is to train them on our digital basic learning track and then really get them access to the freelance, the gig economy, where they're able to tap into the global markets, really compete and bid globally and able to earn work that way. So I think what is really important about this is we're looking at more than 80 million displaced persons globally. With climate change, with a lot of the big trends that are going to be coming in the future, this is not a problem that's going to go away. It's going to be here to stay, and it's only going to amplify. And so I think the big problem that we see, that a lot of these big humanitarian agencies see, is how do we work on livelihood? How do we work on sustainability? These big questions of how do we, think about not just giving aid and shelter, but how do we also help people help themselves on their own terms? And so I think that's what really we come in, is really to bring in the skills learning part, but also to really connect them with learning opportunities.
Yeah, certainly very important work you're doing there, Jean. We look forward to tracking the progress for Connexio. Connexio founder Jean Guo joining us there. We're off for another break, but coming up, a conversation with legendary filmmaker Ken Burns. Our very own editor-in-chief sits down with Ken Burns to discuss his latest documentary on Ernest Hemingway. That's coming up after this break. On this week's episode of Influencers, Yahoo Finance editor-in-chief Andy Serwer sits down with filmmaker Ken Burns. Andy spoke to Burns about his latest documentary, focusing on the life of Ernest Hemingway, and also talked to him about how his filmmaking process has evolved over the years.
In '85, we were talking about what a great golden age it was, because documentary is a very weak word, because it means, what Michael Moore was doing, what some of these. There was a film called Streetwise. It was Errol Morris's stylized thing. It's the self-involved films like Ross McElway's Sherman's March.
Sherman's March. Wow. Yeah.
All of these things, my stuff. It was just great. The whole thing's from right up to fiction, maybe crossing over the line to, pure documentary like Fred Wiseman stuff. I mean, there was just an amazing spectrum, and it's only gotten bigger and more effective. And maybe the success of the Civil War had something to do with people turning around and saying the cost per hour of whatever versus fiction. But look, I've been with public television my entire thing. I'm staying with them. They have one foot in the marketplace and the other tentatively out. Look, I could have gone a few years ago or 13 years ago to a streaming channel or a premium cable and say, with my track record, I need $30 million to do Vietnam. And they would have given it me. But what they wouldn't have given me is 10 and a half years. PBS gave me 10 and a half years. And they gave me 6.5 on Ernest Hemingway and 10 on national parks. I mean, we've got many projects going at once. I've got 8 others happening now with 4 different teams, and I'm not missing stuff. I'm delegating in a way because I don't have to do everything the way I did when I started off with, in knee pants in this. But the interesting model is that it's not a financial model. It's a grant model. We raise money from foundations and individuals of wealth, from the Corporation for Public Broadcasting, from PBS itself. Bank of America has been our corporate sponsor since 2006. They've signed up to 2030. We've had a kind of stable of support from foundations like the Arthur Vining Davis Foundations, the Pew Charitable Trust, the Park Foundation, stuff like that. We started a group was started called the Better Angels Society, which is a nonprofit that seeks money from individuals of wealth to help do these films. And so we make them as zero-sum games, not allowed to put in contingency, not allowed to put in any profit margin, and it just happens. And then when they're done, it's all zeros, and we've already moved on to the other projects that we're working on. What that gives me is total creative control, which is I live in rural New Hampshire. This is my barn, because I do not want to sit here having a conversation with you and saying, well, they wouldn't let me do this and they wouldn't let me do that, or I really wanted to work with that writer, or I really wanted this person. And if you don't like these films, it's all my fault. I mean, in this case, it's Lynn and my fault because she's the co-director, but it's our fault. And that's the way you want it to be. No excuses.
How do you pick the subjects for your films and what's on tap? What are some of those 8 things, Ken?
Yeah, so they pick me as the glib answer, Andy. That's not fair. It's like the way you choose. I have lots of ideas. If I were given 1,000 years to live, I would not run out of topics in American history. I'm not going to be given 1,000 years. And so right now in my late 60s, there's an urgency to try to do as many as I can. And so we're doing as many as I physically can. And it's 7 days a week, 24/7. It's exciting and exhilarating. And I don't even think of it as work, though it is work in a really good way. It's hard. It's disciplined. The people I work with are terrific. So this fall, September, so it's summer, we'll have a 4-part, 8-hour biography of Muhammad Ali. We are and we just locked it. We're now doing the mixing and other sound cutting and mixing and finishing. We've got a biography of Benjamin Franklin, 2-part, 4 hours, difficult, no pictures, no footage, right? 18th century subject. That will be out in 2022. And in 2022 or probably 2023, another film that we're in the editing is a 3-part, 6 hours on the history of the Holocaust and the United States. So what we knew and when we knew it, what we did and what we didn't do and what we should have done. Very complicated. We're working on a biography of an animal, the buffalo, the American bison. It's the story, obviously, of not just the animal, but the people who used it as sustainable to their lifestyle for hundreds of generations. And then the people who came in and in less than a generation brought it to the brink of extinction. And I'm happy to say those very same people then said, oops, and have brought it back from the brink of extinction. I'm doing a big series, the next war after Civil War, the Second World War in Vietnam, on the history of the American Revolution. Another hugely difficult thing because it ain't 55 white guys with powdered wigs in Philadelphia and Lexington and Concord and Washington crossing the Delaware, and then 8 years later they surrender at Yorktown. It's really complicated. It involves lots of people. We're doing a history of a life after emancipation in America, Reconstruction, the collapse of Reconstruction, the Jim Crow era, leading up to the Great Migration when African Americans finally, after the First World War, the Tulsa riots are an example of why you might want to leave the South, began to leave and move up. We're also doing LBJ and the Great Society. All of these are all underway. And the final one is the first non-American topic, which is a biography of Leonardo da Vinci, which takes us even farther back in time.
Sounds like you might have some conversations with Walter Isaacson with at least.
Well, Walter's we've interviewed just spectacularly. He's a dear friend and has been for years and years and years, and gave us a spectacular interview for Franklin. And that film is, I'd say halfway done. Yeah. And we're looking forward to the conversation about of Leonardo with him.
Leo, right.
Well, people say Da Vinci, and that's like saying of Manhattan or of Walpole.
Right. We'll have to ask DiCaprio, if that's okay. Yeah. So this is all such a far cry, Ken, from Brooklyn Bridge, which I believe was your first film in the 1980s. I mean, it's this huge enterprise, and that's amazing unto itself. But I'm curious, how do you think your films are different now from the beginning? How have they evolved? How's the actual filmmaking changed?
Well, filmmaking's changed a lot technologically, but we're trying to do it the same way, handmade. I mean, I edited Brooklyn Bridge like in a little cabin right next to this barn here. I've been living in this house for 42 years, and this is where I live. This isn't like the weekend or the vacation house or the place I escaped to in COVID. This is where I live and work. And so the process is not different. I hope we're better. I'm better as a filmmaker. I think I am. Stuff is more complicated, but we've tried to keep it handmade. And so each of the groups are intimate, and it's not a big deal. They're labor intensive, which make the budget seem like indie feature film budgets, but they're because they take 10 years, and we've got a lot of people working on them.
Labor intensive is an understatement. I've seen some of these things. All right, make sure to catch the full interview at 4:30 p.m. Eastern right here on Yahoo Finance. And coming up, want to watch the big game on a slick new TV? Dan Howley joins us with some key tips and tricks. Stick around. If you want to watch the Mets play the Nationals on a shiny new 75-inch big screen, you're out of luck. The game was canceled due to COVID, but we still got the Final Four, and Yahoo Finance's Dan Howley is here to tell us what to watch out for when you're in the market for a new TV. Dan, save us some money here.
Yeah, I'm still very upset that the Mets game is canceled, but I do have some great tips and some deals for TVs that you may be looking for to check out the final of March Madness. I have 4 in particular. The first I want to start off with is one by Vizio. Now, this is a brand that usually has less expensive TVs. This one, a little bit pricey. It's going to start you at $17.99, 65 inches. The big thing about this, though, and the reason why the price tag is so high, is that it uses OLED technology. Now, just to give you a little bit of background, OLED means organic light emitting diodes, and usually that's the counterpart to LCD screens. OLED essentially means that the TV can turn on and off individual pixels. So black is going to look like actual black. It results in more vibrant colors overall than LCD, but you have that extra price. So it really is a trade-off of whether or not you want that high-end image quality or you don't want to pay $1,700. That's still not a bad deal. The next one up, if you don't want to spend as much money, and something that I honestly had to stop myself from buying, is from TCL. It's $7.99. It's a 55-inch panel. This bad boy uses something called micro LEDs, as well as QLED technology. Now, what QLED is essentially a way for TV makers to almost get as close to OLED screen quality or image quality as they can while still using LCD panels. So the micro LED, they're tiny little LEDs rather than larger LEDs. That means there's going to be less light bleed. And essentially, you're going to get decent image quality, close enough to OLED without that price. And it's $7.99. Look, I literally had to stop myself from putting this in my Amazon cart. Maybe I'll do it a little bit later. One of the big things this has, though, is a gaming mode that you can get out of it. That's going to make sure that the image looks nice and smooth as you go around in Fortnite of Call of Duty. The next one from LG, 65-inch. This bad boy, a little bit more expensive, $19.96. This is from LG, though. They are the kings of OLED panels. Some of the best screens that you can get, period. I have an LG, though it's not OLED because I don't have $1,900 to throw around. But the reason why you would want something like this is because of that screen quality and the fact that it uses NVIDIA's G-Sync technology as well as AMD's FreeSync technology. And that allows for much smoother gameplay if you're going to be using this for gaming. Larger screens, typically, if they don't have something like that, you're going to see a lot of lag. In this case, you wouldn't. And then finally, we have a Samsung TV. That's at $697. This is going to be the least expensive of the group. It uses something called dual LED system. Basically, what that means is it's going to correct the color temperature of the LED so that it'll match better what the actual colors on the screen should look like. It's not going to be near OLED. It's not going to be the same as a QLED, but it is going to be better than a standard LCD panel. And if you don't want to spend the big bucks, this is a good opportunity to grab a TV on the cheap. And I just want to give you a few quick tips. Stick to your budget. I look at TVs constantly because I just want to always buy them. I don't, but it's kind of fantasy window shopping. And I tend to see myself going from $800, $900 up to $1,200. It's easy to do because you think, oh, look, it's a couple $100 more. What's the difference? I'm going to have this for 7 years. But if you really are on a budget, stick to it. The second one is to know your TV size. Just because you want a 75-inch TV doesn't mean you should get one. If it's not going to fit in your space, it's going to look awful. You're going to be looking around all over the place trying to make sure that you can see the screen. If you get one that's too small, you're going to be squinting. You're going to hate the fact that you spent a lot of money on something that you can't really see. And then the final, and this is probably my biggest tip, is do not let anyone in a brick and mortar store or anyone in general rip you off with HDMI cables. If anyone tells you that you have to spend $100 on HDMI cables, they're either getting paid to sell those or they don't know what they're talking about. Either the HDMI cable is going to work or it's not. It doesn't need to be plated in gold or, platinum or anything along those lines. I think the only thing you have to look out for HDMI cables is whether or not it uses HDMI 2.1 or HDMI 2.0. HDMI 2.1 is a newer standard. It means you can use view images at 8K with higher frame rates. That's the way to go if you're getting a more expensive set or you're using a PlayStation 5 or Xbox One. If not, you're getting an older set, you don't really care, go for the HDMI 2.0. The price you should spend really, $20. So don't let anyone rip you off on HDMI cables.
Yeah, Dan, it can be so intimidating when you go in to buy a TV. Number one, because there's just so many different options. We started the conversation by talking about sports, March Madness, baseball. What's the one feature you think our viewers should be looking for if they know that they want the best quality when you talk about live, sort of games? I imagine it's a little different from, for example, gamers who are looking for something else in their TVs.
Honestly, it's essentially the same. Really, what you want is a 4K display. Those are basically, the standard now. It's hard to find something that's 1080p or 720. That's around the $500 range, which is what you might be getting if you're going for a main television. I would say the big thing to make sure that the TV has is HDR technology. That's high dynamic range. That's basically where you're going to get those really vibrant color differences between blacks and whites. There's going to be much better contrast. That's a bigger difference, believe it or not, than going from 1080p to 4K. This is really going to make, if you're watching a game, the green grass really pop, the players pop. And also, if you're watching a movie that's a little darker, you'll be able to make out the screen much better than you normally would because there's that extra contrast. So I think the big thing to look for is HDR. All of the TVs I listed support HDR technology.
Dan Halley with the TV tips. Always appreciate them. Thanks so much for that. We're off for another break, but coming up, we're talking about the lessons learned from the Archegos fallout. Jared's going to walk us through the takeaways for retail investors as major banks look to recover from the hedge funds collapse. We'll be right back. We are continuing to track some of those stocks that were hit hard by the block sale stemming from hedge fund Archegos earlier in the week. But Jared, you've been looking at some takeaways for retail investors, and this is an interesting conversation because when you think back to what happened during GameStop, the meme stocks, the constant thing we heard was let the professionals handle it. They know better. And yet this seems to suggest that that's not necessarily always correct.
Yeah, well, the entire hedge fund industry is centered around giving people who can take incremental amounts of risk and then ramp it up. And if they do well, they just get piled on more money, more money, more money. And eventually they tend to blow up. Most hedge fund managers will blow out a fund or two before they really get started. And a lot of hedge funds have multiple funds that they're managing. So the big takeaway for me is that the risk managers didn't do their job. If you didn't pay attention to GameStop and Reddit and knew that there was potential for a huge short squeeze in one of your positions, things going the wrong way, especially when they're so concentrated in relatively illiquid names that aren't heavily traded, such as Discovery Class B shares. That was kind of the name that we were looking at yesterday. That stock popped by over 100%. You can see over the last 5 days, still up 79, 80%. The takeaway here is these guys are getting bailed out, but as a retail investor, you're not going to get bailed out. You lose money, you have lost it. It's gone. And you have to have a plan in place that allows you to make risk and allows you to keep swinging, because if you run out of money, guess what? You can't take that next great trade. So I think these portfolio managers, hedge funds on Wall Street, they get a little bit wrapped up in their positions. And in this particular case, they were arbing Class A and Class B shares for Discovery. So I want to show something. This is a comparison chart of the two different stock classes. So they technically have two different tickers here, Disc A, Disc B for the different shares. And you can see what happened yesterday. Normally, these two lines are supposed to go along pretty close to each other. They get out of whack. They'll short one and go long the other and plan on an eventual convergence. That's not happening. What we're seeing is a short squeeze in the B shares, and that is just causing massive losses. Now, the other lesson learned is if you're a bank, you got to jump on these problems right away. Credit Suisse, Nomura, they got left holding the bag. Deutsche Bank, they were able to sell a portfolio of some of the assets that they were able to confiscate in the margin call for $4 billion. So they said yesterday that they got out relatively unscathed. But for the retail trader, biggest takeaway here is you're not going to get a Fed orchestrated bailout like long-term capital management in 1998, and you're not going to get a hedge fund just funneling billions of dollars if you happen to drain your account.
Yeah, some important context there. Thanks so much for that, Jared. We're off for another break, but we'll be right back. Welcome back to Yahoo Finance Live. Let's do a quick check of where the markets stand. We're, of course, talking about the very first day of this new quarter. Jared, we've been looking at some of the moves that we've seen. The S&P 500 passing that 4,000 level for the first time, and it is holding on to those gains, up about 39 points right now. The Nasdaq seeing the biggest gains so far with that bounce back we've seen in some of those tech stocks, up 204 points, and the Dow up 165. A lot of big moves coming from President Biden's $2 trillion infrastructure bill. Semiconductors, one that we've been watching very closely in this session, especially given that $50 billion that was set aside for manufacturing, something they've talked about for some time. And then finally, Compass, the new player in the markets, they are popping on their debut, although did price at $18 a share, trading at $21.25. That does it for Jared and I here in the 11 a.m. to 1 p.m. hours. Much more coming up ahead here on Yahoo Finance Live.
Hello and welcome to Yahoo Finance Live. I'm Alexis Christoforous with my co-host Kristen Myers, and here is what's happening. We may already be in the fourth wave of COVID-19. New cases are on the rise in 25 states, with the biggest spikes in Michigan and New York. But health experts say since 73% of seniors in this country have received at least one dose of the vaccine, this wave should be a lot less deadly. And grab those low airfares now, because Americans eager to break out of the pandemic lockdowns are driving up demand for airline tickets and prices. We're going to talk to the points guy about where you can find the best deals. And a little later, we'll hear from Kansas City QB Patrick Mahomes about how he's building his business empire off the gridiron. On Wall Street, looks like stocks are pretty much in rally mode here, Kristen, ahead of the long holiday weekend.
Yeah, absolutely, Alexis. As you can see there, talk about a rally. S&P 500 up about 1% right now. It crossed that 4,000 level earlier in the trading session. As you can see, it is still holding on strong, about 4,011 right now for that level. Now, we are continuing to see a seesaw in those 10-year yields right now, down about 3 8/10 percentage point. Now, that's well off the highs, that 1.68%, well off the highs that we had seen earlier in the week when it hit that 14-month high. I believe it was over 1.75% at that time. Now, of course, with those falling yields, we are seeing the Nasdaq leading today right now, up over 1.5%. Taking a look over at the tech sector, which is, of course, leading some of the gains that we are seeing, that sector up about 1 7/10%. Of course, we have those FANG stocks doing incredibly well right now, as you can see there. Facebook, Amazon, both up about 1.5%. Netflix right now up over 2.5%. Google right now up almost 3%, 2.75 percentage point. I want to take one last look over at a stock that went public yesterday. So that is the education tech company Coursera. Closed over 35% up yesterday, now has a market cap of nearly $6 billion, as you can see there right now, Alexis. Coursera up just under 10% right now.
Pretty nice Wall Street debut, I'd have to say. All right, thanks a lot. President Joe Biden's going to hold his first cabinet meeting later today. It will be used to promote his new infrastructure plan, which he unveiled yesterday. But the gathering will look very different from those held by his predecessor. Our Washington correspondent, Jessica Smith, joining us now with those details. Hi, Jess.
Hey, Alexis. Yeah, the cabinet meeting today will be focused on implementing the American Rescue Plan and selling the American Jobs Plan, that recovery package that President Biden laid out yesterday. It has more than $2 trillion to upgrade the nation's highways, roads, bridges, broadband, and so much more. And now that plan has to be turned into legislation, and Democratic lawmakers and the Biden administration really have to sell that package to enough lawmakers to get it done. The White House says it's already started reaching out to Republicans. We heard from the president yesterday. He was saying that there's no reason it can't be bipartisan. He's making the case that this is a once-in-a-generation investment in America that needs to happen to make sure the U.S. remains competitive globally. But Republicans and business groups argue tax hikes that Biden wants to use to pay for this package will make the U.S. less competitive. He wants to raise the corporate tax rate to 28%. Minority Leader Mitch McConnell said the infrastructure package is a Trojan horse for tax increases. The president addressed some of those concerns about the corporate tax hike yesterday. Let's watch.
No one should be able to complain about that. It's still lower than what that rate was between World War II and 2017. Just doing that one thing will generate $1 trillion in additional revenue over 15 years.
Now, the plan is also getting a little pushback from progressives who say they like what is in the plan. They think it's a good start, but it's not nearly enough. Congresswoman Alexandria Ocasio-Cortez said she thinks in reality there needs to be $10 trillion over 10 years, but she did acknowledge that that is the ideal number. So we'll see what progressives start pushing for next. And remember, this is the first of 2 long-term economic recovery plans that the White House plans to unveil in the coming weeks. We expect the second plan focused on childcare, education, and healthcare to come out sometime this month. Alexis and Kristen.
Alexis, I believe you are muted right now.
I am, and now I'm not. It has to happen at least once a week, though, right? Just to confirm that we're really working from home. All right. Here we go, guys. Take 2. President Biden's plan to pay for his $2 trillion infrastructure plan is to hike taxes on individuals and businesses. We know that he wants to raise the corporate tax from 21% to 28% over 15 years. He's also promising not to raise taxes for anyone making less than $400,000 a year. But our next guest says his tax plan actually falls short when it comes to closing the wealth gap and accounting for race. Dorothy Brown is professor at Emory University School of Law and author of The Whiteness of Wealth. Professor, it is good to have you here. I know that you say our tax system currently fails to account for race. How so? And why is it so important that they not?
So our tax system currently doesn't say anything about race. Think about the tax returns that you fill out. There's no race box, and I don't advocate that there should be. The problem, however, is taxpayers bring their racial identity onto their tax returns. So there are racially disparate impacts. My research over 25 years has shown when Black and white Americans engage in the same activity, tax subsidies help white Americans while disadvantaging Black Americans.
So how does that happen exactly? Because when I was reading this, I immediately thought, oh, well, we do know that a lot of those corporate tax breaks, for example, or those tax breaks that go towards the country's wealthiest disproportionately impact white Americans. But if you're saying that they're doing even the same activities and there's a disproportionate impact, how does that happen?
So let's take marriage, right? There's the joint return. And if you have two spouses where one works in the paid labor market and the other works at home, that couple gets a tax cut when they get married. We call that a marriage bonus. Take another couple where there are two co-equal wage earners. That couple does not get a tax cut. And for decades, that couple paid higher taxes when they got married. Well, lo and behold, my research looking at Census Bureau data showed white married couples were more likely to have a single wage earner and get a tax cut when they got married. Black married couples were more likely to have two co-equal wage earners and not only didn't get a tax cut, but people like my parents, my mother was a nurse, my father was a plumber, their taxes went up because they were married.
You know, this is interesting. I don't think a lot of people even realize that. And another thing that I didn't realize is that I know that part of his tax plan, Biden's tax plan, is to allow for some tax subsidies when it comes to home ownership, especially for first-time homeowners. On the surface, one would think this is good for all folks who are looking to get into the market to buy a home. But you say it actually, in some instances, works against potential Black homeowners. How so?
So a tax credit is going to give you a break when you buy a home. The problem, though, is Black Americans need down payment assistance. We don't have intergenerational wealth. We don't have our parents who can give us a down payment for a home. So what that tax credit will do is just give a tax break to people who were already going to buy a home and had the money for it. So that's going to disproportionately help white Americans, not Black and Latinx Americans.
All right. So I'm hearing, you know, obviously how there's this disproportionate impact that already exists within the tax system because of the disproportionate ways that our systems handle, you know, employment, for example, education, etc. So if you are Black and you're at home and you're listening to this segment and you're hearing how you are essentially losing every time tax time comes around, what do you then do about it, right? Absent of some changes being made to the tax policy, are there some loopholes that folks can take advantage of? Are there some kinds of filings that they should be doing to really try to take as much advantage of the existing tax system that we have?
So one thing I will say is Black Americans who work for employers that provide them with a retirement account, they should max that out to the extent they financially can. Don't leave any money on the table because that is a tax-free benefit that you get. You're not taxed on any amount you put in your retirement account. So there are tax subsidies that Black Americans may be able to take advantage of. But really, we need a fix. We need, first, the Biden administration to live up to their promise of that executive order that said racial equity should go across the federal government and include Treasury. So I spent 25 years being a detective to figure this out. The IRS should be publishing race and tax statistics. So one of the things people at home who think this is a problem like I do, they should be agitating the Biden administration to make good on their promise. we should know what statistics are by race.
Moving forward as we talk about making changes, lately we've been talking a lot about reparations, for example. I'm wondering if one of those potential policies can be enacted through our tax system, perhaps giving tax breaks, tax credits to Black households, or especially households that are descended from American slaves. Is that a reform that we really need to be making here as well?
So in my book, I talk about a reparations tax credit, which would compensate Black Americans for paying higher taxes over decades. But I also talk about that would not be found constitutional. Our Supreme Court would say you need to prove Congress intended to discriminate against Black Americans, which is basically a burden that won't be able to be overcome. But my second best alternative is a wealth tax credit, which would be available to any taxpayer who was in a household with below median wealth, which means disproportionately Black taxpayers because of the racial wealth gap, but white taxpayers, Latinx taxpayers, Asian American taxpayers, all taxpayers in homes with less than median wealth would be eligible for that tax credit. And I think it's obviously something worth considering.
All right, we're going to leave it there. Professor Dorothy Brown, a professor at Emory University School of Law. The book is called The Whiteness of Wealth. Thanks so much for being with us. Coming up, is the fourth COVID-19 wave already here? We're going to talk about it with Dr. Patrice Harris next.
Let's turn now to the ongoing coronavirus pandemic. Alarmingly, we are seeing coronavirus cases continue to rise around the country as the race to vaccinate Americans continues to speed up. So let's bring in Dr. Patrice Harris, former president of the American Medical Association and CEO of eMed. And Dr. Harris will be joining us by phone today. So, Dr. Harris, I mean, Are we in the middle of another wave, or are we not? I know that cases are spiking. And if so, do we need to reconsider a lot of the reopening efforts that we see states making right now?
Well, we absolutely are seeing an increase in the number of cases, and this is certainly alarming, just as we were seeing these cases decline and plateau, and just as we are seeing an increase in the availability of vaccinations. These increases are very concerning. It would not be good for us to be in a fourth wave. I certainly can appreciate that folks are tired of being indoors and want to be out more, but we are still in the middle of this pandemic. It is too early to let our guard down. And that does mean that we should be very cautious in reopening. We should not reopen too soon.
You know, doctor, we're getting some data on just how many people are starting to take to the skies again. They feel more comfortable about flying as that vaccine rollout continues to ramp up. Would you advise folks to pause and perhaps not take that trip? I mean, we're talking to lots of people who are saying that planes are full right now. Prices are going up because demand is so high. Should people not be freely going out and traveling the way they seem to be going to be doing in the spring and the summertime?
Well, listen, it is very important that everyone assesses their own individual risk. And certainly there are those who have been vaccinated with no underlying health problems. Certainly after they do the evaluation and depending on where they're going and what activities they plan to be involved, there may be less risk. I think, there are no one size fits all blanket recommendations. We do know that the airlines have done a lot regarding airflow, but of course, the actual time on the plane is just a piece of the process. And that's why what we've always known and what we've always said about the importance of layers of protection remains critical. It remained critical 6 months ago, and it remains critical today. And so we can think about vaccines. Of course, we can and must still think about mask wearing. We should think about testing and making sure that folks know whether or not, if they've not been vaccinated, whether or not they are positive or not. So it's about layers of mitigation and everyone assessing their own individual risk. And of course, the risk of those who they plan to be around.
So what I'm hearing, doctor, is that the vaccine does not eliminate the threat of COVID or the variants that we're seeing, and that testing is still a very critical part of the equation, even if a person has been vaccinated. And I know that you're head of a company called eMed that has a test. I believe it's an at-home test. Can you tell us a little bit about that and how that sort of fits into trying to battle COVID-19?
As we have these conversations, we have to make sure that we have conversations and we talk about individuals and we talk about population health, right? So individual health and population health. No question. And I am fortunate enough to have received both doses of the Moderna vaccine, and I have been vaccinated. And so based on the studies to date, and we just saw studies yesterday regarding the Pfizer vaccine, and certainly those data support that the vaccine remains highly effective after 6 months. So that's me on an individual basis. Again, but remember, the vaccines prevent severe illness and they prevent hospitalization and death. Good news on that. It does not mean that I or anyone else who has received the vaccine is 100% prevented from becoming infected with the vaccine. But clearly, 100%, we've seen data, 100% reduction of risk of severe illness and hospitalization. But when we look at a population level, absolutely, testing still remains an important tool in the toolbox because we know today not everyone has been vaccinated, and we don't expect everyone to be vaccinated, and we still we've seen some early good news around vaccines in children and younger teenagers, but we still need that data. And so we will still not have everyone vaccinated for months to come. And that's why, again, all of those layers of mitigation and protection, it still is important to be outdoors, of course, less risk than being indoors, mask wearing, and the testing. Yes, EMAD, the company I'm the CEO, we do offer an at-home opportunity end-to-end for testing. And that is so important to be able to have that additional tool in the toolbox to be able to test at home. We think about the opportunities as we do open up, but open up with those layers of protection so that folks can go back to work, play, worship, and school.
All right, Doctor, you're talking about the vaccines, and I want to ask you about vaccine hesitancy. We had Johnson & Johnson say that some of their batches failed to meet, quality standards. We've all seen the really bad headlines out there about blood clots and AstraZeneca's vaccine. We hear all the time about people testing positive for coronavirus even after they've been vaccinated. But, we keep getting a lot of those concerns that people have around the vaccines dismissed. Pretty bluntly, I'm just going to ask you, are there concerns that we're not really addressing or talking about because we want every American or every person to get vaccinated?
Well, certainly that was a setback where that vaccine ingredient did not meet quality standards, because we know that in some areas the demand is outpacing the supply. So anytime there is a setback to the supply, that is not good news. But on the other hand, we can look at it as if and understand it so that the quality controls are in place, right? And so that was identified early. And that is what is key, I believe, to those who still have questions, appropriate questions. We want to get to vaccine hesitance, and it's about being transparent. And so I know that I have, and so many other leaders, physicians, scientists, public health professionals, we have been transparent about the side effects. It's good that we are transparent about the fact that that ingredient did not meet quality standards. Now it's important, again, with the transparency, with the truth about the side effects, making sure folks have all the information. Then we have seen folks become more vaccine confident, and so much so that in many communities of color, of course, we know the history there, but we've still seen demand outstrip supply. So being transparent, giving people accurate fact-based, science-based information, trying to combat the misinformation that's out there will certainly continue to go a long way so that folks can make informed decisions about their own health regarding COVID-19 vaccine. And that holds true about any particular decision that people have to make about their health care.
Want to quickly ask you here, Doctor, we've seen the race gap really widen as the vaccinations are starting to speed up. Wondering if you think that states should set aside appointments specifically for minorities or for underserved zip codes and communities.
That is one alternative, and I think that each state should do all that they can. They should think about where the demand is, because, just stated, there is increased demand in communities of color. So they should make sure that there is appropriate access where the demand is. And by the way, there are other tools in the toolbox. Not everyone is computer savvy. There was a senior here in Atlanta that said she's just not computer savvy. And so what did she do? She went down to Mercedes-Benz Stadium. She said, I'm just going to show up. This was an African-American woman, and she was able to get a vaccine that day. And so we need to think about that. We need to think about door knocking. I've seen that in certain communities. A good colleague, a friend of mine in California, Dr. Jerry Abraham, has really been about the business of working in his community, making sure there are sites there. I've seen others talk about mobile sites. So we need to do it all. Clearly, we have to be intentional because those disparities are not okay. They weren't okay when it came to testing. One of the reasons why I was so glad to be involved in EMED, because we wanted to improve access. So these disparities are not okay when it comes to testing, clearly not okay when it comes to health inequities, and they are not okay when it comes to vaccines. And so we have to have all hands on deck to make sure testing is available and vaccines are available in communities that need them the most.
Absolutely. Dr. Patrice Harris, former president of the AMA, CEO of EMED, thanks so much for joining us for this conversation. And coming up, we hear from Kansas City Chiefs quarterback Patrick Mahomes and about his efforts to build a business empire. That's next.
Welcome back. Kansas City Chiefs QB Patrick Mahomes has had a pretty eventful year. He took his team to the Super Bowl. He became a dad just a few weeks later, and he's trying to build a business empire. Yahoo Finance's Brian Sozzi had a chance to catch up with Mahomes recently, and he joins us now, the NFL superstar that he is. Brian, what did he have to say about business on and off the gridiron?
Yeah, Alexis, in addition to building his empire, probably staying up all night, he's a new dad, as you mentioned, 1-month-old Sterling Sky. He's now also preparing for the upcoming new NFL season, which, as we all learned this week, is going to go from 16 games to 17 games. So I asked him, how will his routines change? Take a listen.
Yeah, I mean, obviously, it'll be different. It'll be something that we'll have to adjust to. But it's something that we had talked about in the collective bargaining agreement. Whatever your beliefs are or not, you have to go out there and adjust and do whatever you can to be the best football player you can be every single day. And this year it'll be trying to figure out ways to take care of your body more and more so that you can adjust your body for a 17-game regular season.
Yeah, talk to us about those changes. I mean, you're a hardcore trainer. I mean, you're constantly training your body to be at peak performance in these games. What changes do you think you're going to have to make?
Yeah, I mean, it continues in that health and wellness part. I mean, you'll have to change your diet a little bit more. You'll have to change how you train. You'll have to change your day-to-day work ethic and work involvement, how much you're going to put on your body every single day. Because you want to be in that Super Bowl again. You want to be playing for a championship, and you want to make sure your body can take the workload of that. And adding another game is adding more to your body. So you have to make sure that you're prepared your body in the best way possible to be ready for that.
Is an extra game, I know they're taking away one of the preseason games, but is an extra game on the regular season, what type of toll does that take on one's body? And then even aside from that, what are some of your friends in the league saying the past 48 hours since the decision?
Yeah, I mean, it definitely puts more on your body. I mean, every single game of your entire career, you're battling through something, and I think you see that in every single body at the end of the season. You're always nicked up a little bit. You always have some injuries and some bruises, and so I think the biggest thing is going to be a learning experience this next year. I mean, we got to go in with the mindset of just continuing to make ourselves better, and knowing that 17 games is how many we're playing. And then you're going to have the postseason after that. And so I think it'll be brand new to everybody. But everybody's going to have to adjust and try to do whatever they can to prepare their body to be ready for it.
In other words, Alexis and Kristen, a lot more protein shakes and aspirins in the daily routine for Patrick Mahomes.
Yeah, looks that way for sure. I know that you had a chance to talk to him, too, about his business endeavors. What are some of the things that he's involved in?
Well, after he signed that big $503 million, it's just amazing to even say that, $503 million contract last year, he took a minority stake in the Kansas City Royals. More recently, he has sold some NFTs for close to $3.5 million. He even told me he's dabbling in stocks, but he is using a financial advisor for all his investments. But clearly, this is a young football player. He's only 25 years old that has burst on the scene. He's a Super Bowl champion, and he's already thinking about life off the field.
Yeah, I mean, he definitely has the money to do all that great stuff with, and happy to see that he's being smart about it. All right, great interview there. Thanks a lot, Brian Sazi. Coming up, more Americans are taking to the skies as the vaccine rollout ramps up. We take a closer look at the travel industry during the pandemic right after this.
People are traveling again. According to the TSA screening figures, almost 1.3 million people flew just yesterday. And as you guys can see there from that chart, just a few days ago on March 28th, we saw almost a pandemic high of nearly 1.6 million people being screened by the TSA. And even more people will be able to cram onto those planes when Delta adds that middle seat back on May 1st. So let's talk more about travel with Brian Kelly, founder and CEO of The Points Guy. So Brian, we're seeing more and more people traveling. When do you think we'll get back to those pre-pandemic levels? Will it happen anytime soon?
Well, we're closing in about 60% of pre-pandemic levels, which is frankly shocking to me, considering almost all international travel to Europe and Asia is cut off. But we won't really get back to those full numbers until business travel rebounds. And in talking to a lot of companies, those old days of road warriors, it's going to take a while to come back till people are comfortable from that. And many are predicting they won't come back at all. Business travel will look completely different. So a lot of open question marks, but the numbers keep rising week over week.
That is for sure, Brian. And I know leisure travel is really taking off. Look, there's a lot of pent up demand, right? We've all been inside, not being able to go anywhere for the past year plus. So people are trying to get out and about. And I'm wondering about where people are flying right now. What are some of the hot spots? And I know prices are insane because of all the demand. Are there places where people can still get some good, airline deals and also some good hotel deals?
Yeah, so Florida, I was in Miami Beach last week, absolutely packed. You would never even know that there's a pandemic there. Definitely Puerto Rico as well, because you don't have to get tested to come back into the country since it's a U.S. territory. But we're still seeing big numbers in Mexico and Caribbean. But we are hearing from travelers, people are not comfortable yet traveling far distances internationally, especially now with new lockdowns just announced in France and Italy. I thought Europe was going to be on the table for this summer. I still do think Greece, maybe Italy will, but their slow vaccine rollout and these new variants are definitely going to keep most people from staying domestic. Hawaii, another huge increase. We're seeing every airline add flights to Hawaii. Even those nice international jets with lie flat seats are going to Hawaii more than ever. So, and as far as deals, there still are deals to be had. But certain markets don't expect it to be empty planes and $30 airfares like we were seeing a year ago. But you can still get deals if you hunt for them.
Yeah, Brian, I hate to admit it, but I'm one of those folks that purchased very recently a ticket to Hawaii, and I was absolutely stunned when I saw that I couldn't get $20 a day deals on those car rentals. They're more like $500 a day. You're talking about how some folks are still very hesitant to get on a plane and to go traveling, especially internationally. How will vaccine passports play into that? Do you think that will bring more comfort to the travelers? Do you think that we're going to start seeing either airlines or other countries start to require them?
Vaccine passports definitely will increase travel because you won't have the stress of having to take a test on arrival and God forbid it's positive and your whole vacation's ruined and you're in a hotel room in a foreign place for 2 weeks or more. So until the U.S. actually mandates that or allows people who are fully vaccinated to come back in the U.S. without having to take, a COVID test, I don't anticipate international travel to be increasing. Now, the U.S. has said that they're not going to mandate vaccine passports, but I am hopeful, especially since these vaccines are so effective, that they will allow people to travel into the U.S. with the fully verified vaccine. But, we've seen a handful of countries with vaccine passports. Iceland's one of them. We actually sent one of our Points Guy writers there last week, and they just are now pausing their vaccine passport program. So lots of kinks to still work out. That's why 2021 for international travel is going to be a wash, but I do think the big boom will be in 2022.
I've got to get back to those deals because I am curious. Unlike Kristen, I have not booked a trip. I don't know if I'm quite comfortable flying just yet, but where can I look to find these deals?
Here's my number one tip. So one of the positives of this pandemic has been that airlines now allow you to use your frequent flyer miles and cancel for any reason and get all of your miles and points back. Now that's different from the free change fees that airlines have on paid tickets, where you won't get your money back, but they'll let you, get a voucher, which isn't that great. So what I recommend is look and use your frequent flyer miles. I know a lot of us have had them building up this past year. So if you're sitting on a bunch of miles, look to see where you want to go. There's amazing, plan for Greece in August. And guess what? If it doesn't end up happening, you get all your miles and points and dollars back. So, and I do believe it's good for your mental health to have something on the books. So use those miles and smile at a future vacation.
You don't have to tell me twice to go to Greece. I'm already there in my mind, Brian.
Me too. I'm actually booked to go in July, so fingers crossed.
Oh, I'm jealous. Good for you.
I know you're showing us all up here, Brian. You're talking about some of the changes that are going to be made going forward. Do you think that there's going to be some changes made in terms of destinations, places that folks used to travel to frequently and are now going to largely avoid? Perhaps they'll start heading to other destinations more regularly instead.
Yeah, I mean, one of those big destinations is Alaska. There's tons of new flights to Alaska this summer. Unfortunately, there are no Alaskan cruises due to the Canadian government has pretty much ruled that off for this summer. But Alaska is going to be a big hotspot. And still, we see this summer, RVs are booking up way in advance. So I do think this summer will model last summer's, where people are going to national parks. And there's so many beautiful places in the U.S. and staying close to home, like Bermuda, Puerto Rico. But I don't really see mass tourists going, real far international destinations until, the pandemic's under control and people have peace of mind that they're not going to get stranded abroad.
All right. So what I'm hearing then, Alexis, is those flight deals to Greece might still exist because the demand is not yet there. So maybe you can book one of those flights soon. Brian Kelly, Points Guy, founder and CEO. Thanks so much for joining us today. And coming up next, it's our Funding Our Future segment. We talk about vaccinating seniors. That's next.
Welcome back to Yahoo Finance Live on this Thursday. The $1.9 trillion COVID relief package includes a proposal that could help keep some seniors out of nursing homes. Joining us now is Ramsey Alwyn, CEO and President of the National Council on Aging. Good to have you here on the show. Tell us specifically what's inside that relief package that could actually be of real use to keeping seniors out of traditional places like nursing homes.
Fabulous. Well, thanks so much for having me. The American Rescue Plan passed just a month ago is just an incredibly momentous package with $1.5 billion worth of community programs that the National Council on Aging fought to ensure were in the package. Programs that can provide a lifeline of services in community around nutrition and health services that can allow older adults, especially the most vulnerable, stay at home where they want to be. As opposed to in those institutions. The package also included $12.7 billion in home and community-based services, just an incredible infusion of support that will allow individuals to stay in their homes.
Now, Ramsey, I know that there was, a huge push to vaccinate as many senior citizens as possible, especially ones living in those nursing homes where we saw coronavirus really spread like wildfire. What are the hurdles that still remain to vaccinating all older Americans?
That's right. Over 80% of the deaths due to the pandemic were 65 plus, a third of which were in nursing homes, disproportionately women and communities of color. What we've really appreciated seeing in the state-by-state rollout are these approaches that prioritize older adults in institutions in particular. And also, we've seen incredible innovation at the community level. We have a network of senior centers that are deeply connected to older adults and have the trust of older adults. And where public health and senior centers have been able to partner in order to reach out to older adults, vulnerable, those that may have a healthy level of skepticism, we've seen really promising results in getting people connected and on track.
Can you talk to us a little bit more about the money in that relief package, the COVID relief package that's going to go towards caregivers? And I'm not talking even about professional caregivers, but say you have a daughter, a son, a cousin you're elderly and they can care for you. There is money in that relief package that would actually pay those people, even though they're your family, for those services. What does that entail, and just how critical is that to keeping some of these seniors out of nursing homes?
It's really essential. I mean, so many individuals receive care from family. That's what's most comfortable, most convenient. And being able to have access to the over $12 billion that were put in the American Rescue Plan in order to provide those in-home services is going to be extraordinary. Building on that, what the administration rolled out just this week in terms of the infrastructure package, we're looking at the potential for an additional $400 billion worth of home and community-based services supports to pay formal caregivers and informal caregivers. And we're just really excited and advocates to continue to expand those programs. The National Family Caregiver Program is just such a lifeline for so many families.
All right, Ramsey, let's connect the dots even more firmly for folks at home. How does taking care of seniors and also vaccinating as many seniors as possible be a boost for the economy? I think so many people think of, elderly folks as essentially economic drags, but I know that you're saying that this is actually an economic boost as well.
Oh, absolutely. The longevity economy, as we call it, the 50-plus market, stimulates over $7.6 trillion of economic activity annually. And so getting our older adults back on track, healthy, to be able to move about the country, participate in employment, consume as they see fit, provides an incredible ripple effect to our communities, to our overall economy.
Yep, do not underestimate the seniors for sure. Ramsey Alwyn, CEO and President of National Council on Aging, thank you. Coming up, why our obsession with snacking during this pandemic may be here to stay.
Welcome back. Well, this should come as no surprise. The pandemic has made snackers out of all of us. And a new report from Coca-Cola has all the details on our snacking habits. We've got Yahoo Finance's Brooke DePalma here to break that down for us in this week's Brooke's Bites. Hi, Brooke. So tell us what we're seeing from this study.
So, Kristen, a lot's happening with this study that we may not even expect that we're actually doing. Like you said, it's really no surprise that we're snacking more. But when you take a look at these numbers, you'll be shocked that it's happening along all generations. So, in particular, the most that's snacking is Gen Z and millennials snacking at 73%. Gen X also guilty of this as well at 54%. And then boomers, nearly half of boomers admit that they're snacking more during the pandemic. Now, Coca-Cola also looked at the most craved snacks. Now, they did consider pizza as a snack, which me being from New York, I was a bit controversial about, but they did say that in the West and in the Southwest, pizza is the most craved snack. In the Northeast, we're looking at wings. In the Midwest, we're looking at potato chips. And in the Southeast, they say that French fries are the most craved snack. So big win there for our favorite fast food giants. Now, in addition to that, I just want to emphasize what they said and how far people are willing to go just to crave that, salty, sweet craving. They're willing to travel over a 1 mile. So people are really looking to snack more and willing to go to extreme extents just to fulfill that craving.
Yeah, I agree with you, Brooke. I don't know if I would qualify pizza or even wings as a snack, to be honest. That is a meal, personally, for me, at least in my house. I didn't think I was a snacker, but apparently I am, according to that chart. I want to ask you about some of the innovations that we're seeing in snacking. How are these brands essentially keeping folks coming back, keeping their hands on those snacks?
Kristen, I do want to point out that in PepsiCo's fourth quarter earnings report, the CEO stated that people are really going to turn to a more experiential, snack and shopping experience. In the beginning of the pandemic, we saw people rushing to stores with that panic-driven shopping, but now they're really looking for innovation, and PepsiCo is jumping on that. In January, we saw them release Cheetos popcorn, that is. Now, earlier this month, we see a lot of these companies teaming up with celebrities. So Dan Levy and Kate McKinnon teamed up to drop Tostitos Habanero, their spiciest chip yet. But the one that got the most attention are these Lady Gaga Oreos. Of course, these were extremely hard to find when they first dropped, but they're also bringing lots of attention for consumers. And Oreo notably drops many flavors, so lots of consumers rushing to stores to capture them while they're still on the shelves.
All right. Thanks so much to Yahoo Finance's Brooke DePalma, breaking down all of those snacking habits. You can read her story on yahoofinance.com. One quick look at the markets right now. We are seeing all three major indices continue to rally. S&P 500 is holding steady above that 4,000 level, hit that earlier in today's trading session. The Nasdaq remains the leader right now, up over 1.5%. That is, of course, led by some of the gains being made in the tech sector. That sector right now up over 1.75 percentage point. Well, Alexis and I will continue our coverage into the next hour here on Yahoo Finance Live. We'll be chatting with Quiddle's CEO on the emergency use authorization that they received for a coronavirus test. So stick with us. We'll be right back after this break.
Welcome back to Yahoo Finance Live. I'm Alexis Christoforous, joined by my co-host Kristen Myers. And here's what's happening at this hour. New cases of COVID-19 are on the rise in at least 25 states, even as the vaccine rollout ramps up. But health experts say frequent testing is a strong tool in our fight against the virus. We speak with the CEO of Quiddle, which just received emergency use authorization for their at-home COVID test. And it has been well documented that women have been disproportionately impacted by the pandemic, with many more women being forced out of the labor market versus men. Well, now there's a new report from the World Economic Forum that says it will take women over a century to achieve pay parity with men because of the progress they've lost during the impact. And on Wall Street at this hour, we have got stocks in rally mode ahead of the long holiday weekend and tomorrow's March jobs report. We've got the Nasdaq Composite, the big percentage winner, but the S&P 500 crossing over the 4,000 mark for the first time ever. Jared Blickery joining us now for a look at some of the big movers today. And Jared, it looks like those mega cap stocks are coming back, talking Tesla, talking Google. What else do you have your eye on?
Yeah, well, there's a lot to dig through here, and this wouldn't be somebody's first reaction. Well, we're talking infrastructure. Why is Facebook and Google up 5% and 4% respectively? Tesla's up 8%, more of an infrastructure play. But I think it just has to do with the general structure of the market. These names, some of these mega caps, have been beaten down, and now they're starting to come back. We're also getting a break on long-term rates. I think the 10-year is down about 5 basis points today. That takes some pressure off of the mega caps. But I want to peer inside and take a look at what is really moving here. We're going to take a look at the semiconductors in a second. But guess what? Energy and clean energy, they have been on the rise. Now, the clean energy is kind of a bifurcated market here. We're seeing some winners and some losers. First Solar, for instance, in the upper right, that's down 1.6%. Some of the newer names, clean energy fuel, that's up about 5%. And then you take a look at the EV space. I mentioned Tesla before. We're seeing a lot of green here, but guess who's not green? Ford Motors, Toyota Motors, some of the old stalwarts of the internal combustion engine. Meanwhile, QuantumScape in the upper left, that's up the most, over 9%. And some of these smaller supplier names, ChargePoint Holdings, for instance, they're up 7%. So we talk about, and Biden's talking about rebuilding the national infrastructure, getting EV charging stations. A lot of these names are going to benefit from it. And we're just scratching the surface here, really.
All right, Jared, you were just hinting at semiconductors. What's going on with the chip industry? I know that there has been a lot of shortages recently, and I'm seeing news that President Biden is trying to provide a substantial boost to those chip stocks.
That's right. As part of the infrastructure program as outlined, $50 billion would be earmarked for the chip industry to get the supply chains back toward the U.S. and in the hands of friendlier nations. The China war, the trade war, was really a shot off the bow, across the bow for the industry to work on their supply chains. You can't have 90% of one part isolated in one geographic region. And so this is to aid that development. Now, $50 billion enough, too much? I'm not going to make that determination, but there's also a lot going on in the space. Micron just released earnings after the bell yesterday, getting a nice pop from that. Excellent guidance for their memory chip business. And then also a couple comments here on from Cowen based on the earnings result. They're rating it an outperform, but raising the price target to 105 from 100, saying it's hard to argue that this was anything but a watershed quarter. And finally, both Micron and Western Digital, this is according to the Journal, are trying to buy Kioxia. Kioxia? Yeah, I think that's right. It's an offshoot from Toshiba. It spun off a couple years ago. It's exploring going public, but this could be a $30 billion acquisition for one of these companies. So a lot is going on in the chip space, and this is just a small part of it.
Also moving over to the entertainment side of things, I know AMC Entertainment, one of those Reddit meme stocks, in the news here because they were able to dodge bankruptcy, and it looks like now they want to issue more shares to the public. What can you tell us about that?
Yeah, this is something that they referenced in a filing some time ago, but they're just clarifying that they want to have the option to issue these additional shares. And AMC Entertainment, their CEO, Adam Aron, said there are a lot of good reasons for shareholders to give us that authority. It could be for improving their cash reserves, buying back debt at a discount, settling deferred theater rents, pursuing an acquisition, or more generally, as they say, working capital. But let's take a look at our meme page here. And we can see GameStop up 1%. AMC, well, they're diluting their shareholders. That's dilutive, so they are 7% down today. Checking out the year-to-date price action, always friendly or always helpful to be reminded of the GameStop phenomenon there, but also how far they've really climbed back and clawed back some of those losses from the highs. So the fact that it's still about a $10 stock, somewhat impressive given the history.
All right, Jared. Well, the IPO race used to be a sprint. It looks like it is slowing down. Tell us what is happening with companies that are trying to go public right now.
Well, we had a bit of disappointing news. You'll remember the other day, Deliveroo has the worst IPO debuting in London in decades. And today we had Compass, which came out. Now you can see this has a 14% pop. That's nice to see, but they had to downsize their offering, and it priced at, I believe, $18, the lower end of the range. So they weren't able to get as much money as they wanted to. But there are also some success stories here. I'm looking at Karoo, I'm assuming that's how to pronounce the name, with all those O's, 5 of them, count them. That's up 24% from its IPO price. So there is money flowing into some of these hot markets, but not all of them.
All right, thanks a lot, Jared. I want to stick with the markets now and bring in Chris Constantinos. He is Chief Investment Strategist at Riverfront. So, Chris, we just closed out the market's best month, at least for the S&P 500, since November. We've got the S&P now above 4,000 for the first time ever. Looks like we're kicking off the second quarter on a pretty nice note. Where do you see the leadership for this market this quarter, and are things going to change at all?
Thanks. Yeah, thanks for having me. That's a great question. What's interesting, I think, about what's happening right now, and Jared pointed it out a few minutes earlier, is that on a day like today, when, again, historic day with the S&P through 4,000, it's actually not being led as much by the cyclical and deep value plays that were really the highlight of Q1. It's being led by more of a mixture of companies, and particularly some things happening on the in the more growth-oriented names. You mentioned tech and semiconductors. And I think this might be a little bit of a harbinger of things to come, when I think Q2 is going to be driven more by corporate earnings and a little bit less by some sort of positive mean reversion and valuation multiples off deep cyclicals. So what we're recommending is a barbell of secular growth stories and some value and cyclical plays, but not going whole hog into the cyclicality, because we think a big part of that move has already happened.
All right. So, Chris, as you're talking about this, of course, I want to ask what the tech story is going to be in 2021 for the rest of the year, and perhaps even into 2022.
Sure. Well, and this is like a theme that we've talked about a bunch in the past, and I still think it has legs. The theme here is that you have a lot of some of the more esoteric parts of tech and some of the quote unquote COVID plays that have been bid to the moon. And some of the valuations on those types of companies look speculative to us. However, you have a bunch of other mega cap tech companies that are really, really solid companies, a little less sexy, if you will, but generate tremendous free cash flow. And in some cases, actually also generate strong earnings growth potential and dividend growth potential as well. These types of things aren't as exciting for investors, but they're just, great cash flow generators. And many of these companies, which are household names, still trade at what we believe to be relatively reasonable valuations, especially because they haven't gone anywhere really in the last quarter or two as these quote unquote long duration plays have fallen out of favor. So we still think there's a fair amount of opportunities left in the tech space, but it's probably the less sexy, think about software and IT services types of companies versus the high flyers that dominated, really since the summer of last year.
I want to get your thoughts on the jobs report, the monthly jobs report out tomorrow. Today, of course, we got the unemployment benefit numbers coming in a little stronger than expected, 719,000 Americans applying for first-time benefits. I guess the good news there, though, is that continuing claims actually declined, as did the total receiving benefits through all government programs. So that at least is something encouraging. What do you expect from that jobs number tomorrow? And what is it going to take for this market to, react in a big way to that report, whether it comes in a lot stronger or a lot weaker than expected?
Yeah, I'm really glad you brought up jobs, because I think this is one of the really important fulcrums for the market, because it's one of the really important fulcrums for the Fed. And what I think that today's data highlights, and tomorrow's data is probably going to do as well, is that the jobs market is still highly dislocated. And this is something that Jay Powell has talked a bunch about. If you look at his recent communications with the press and with the market, he's made statements around the effect that yes, we have a 6% unemployment, but it's really closer to 10 because a lot of folks have permanently dropped out of the employment market, which is not a good thing. And so when I see that continuing claims number, yes, that is good news in a sense. But I don't think it's the full picture of what's really happening on the ground. I think the U.S. labor market is still highly, highly dislocated. And somewhat paradoxically, I think this is actually a good thing for stock markets, even though it's a terrible thing for our country and its workers. The reason I think it's paradoxically a good thing for the stock market is because I think it keeps the Fed accommodative for longer. And again, all I have to do is go back and look at some of the statements of the most influential members of the Fed, including Jay Powell. And I think his recent statements corroborate this. So, if you look at jobs, if you look at full employment, we're so far away from reaching full employment in this country, regardless of how you define it, that it's likely, we think that the bond market is being overly conservative as it relates to when it thinks tapering and, rate hikes are on the horizon. We think that's a lot further out.
Yeah, and certainly Fed Chief Powell has said time and time again they're going to wait for full employment before they make any kind of a move. So thanks so much, Chris Constantinos of Riverfront, for joining us. Coming up next, we're going to speak with the CEO of Quiddle about their just approved at-home COVID-19 test.
Welcome back. Quidel was given an emergency use authorization for its COVID-19 antigen test, which can be done at home, giving Americans another testing option. We have Quidel CEO Doug Bryan here with us, along with our health reporter Anjali Kemlani. So, Doug, the test, I've taken it before, these COVID tests, they cause a little bit of discomfort. How do you make sure that, the testing results are accurate, especially if people don't put it in far enough or do it correctly at home?
Yeah, the key difference here is that with this particular technology, ours and the product from Abbott Labs, the nasal swab is simply on the anterior nares. In other words, we don't have that long swab that you're thinking about that goes all the way to the nasopharynx, and it is quite uncomfortable. And I would say that, you know, athletes that are routinely tested by PCR will tell you it's not very comfortable. Instead, these are very simple, easy swabs to take. It's very easy to actually get a reasonably adequate sample. So that's part of the reason that these tests have been successful and will continue to be successful, because it's a simple nasal swab. So any adult can do it easily, and any child can be swabbed as well under, you know, with the help of a parent or caregiver.
Doug, what's the cost of the test, and where can people find it?
Well, we believe that in a 2-pack format, which would handle what you need during any given week, that it's likely at the retail level to be under $30 for both tests. In other words, each test would be at $15 or less. We've tested that out with marketing. Most of the retail segment that we've talked to, excuse me, have suggested that that's where they would like to land, and therefore we're pricing our product obviously lower than that in order to fit within their scheme. We will be launching the product initially in the state of Arizona. We'll be making some announcements on that, but our thought initially is to do on-site testing for employers where they want to do this on-site, but also make it available to be taken home. We also think that there's a retail segment, and based on our market surveys, there seems to be quite a bit of interest on the part of folks throughout the country to routinely test themselves in order to make sure that they can, go to school, go to work, go to the grocery store, go visit, my mom, who's, north of 80 years of age, and we can do that safely. And on the other hand, if I test positively, I'll stay at home and I'll call my physician. So I'll test twice a week, day one, and then day two would be at least 24 to 36 hours later. Provided those tests are negative, I'm free to move about. If they're positive, either one of them is positive, I stay home and call my physician and figure it out from there.
Doug, Anjali here. So it sounds like you're targeting the employer base first and offices, and then moving into the retail space. What is your production level at right now in order to meet that demand?
Well, to be clear, we're trying to address both. The issue for on-site testing is in that format, we can make significantly more tests. So we can make, millions and millions of tests per week. If we're putting these product in a 2-pack format, the difficulty in packaging and pouching the actual strip itself reduces that volume. So I see it more as a combination of both, and we'll do whatever we can, given that we're scaling up pretty dramatically here over the next weeks and months.
Talk to me a little bit more about that. I noticed that in the statement that you released, you were talking about building out a new facility and targeting the second half of 2021. When can we actually expect this test in stores?
We'll launch into certain geographies and stores in the month of April. So we will have product out there. It won't be widespread throughout the United States, though. We simply don't have the capacity yet to do that. From the next couple of months, April and then June, there are stair-step events that increase pretty dramatically our capacity. And for the product that was just cleared, we expect to be doing somewhere around 50 million tests per month.
Doug, I know that you recently entered a partnership with the National Institutes of Health for a community-based initiative with this antigen test. Can you tell us what you're doing exactly and what kind of data you hope to glean from that?
Well, it's a partnership between the CDC, the NIH, and us. We are providing the product, of course. We're providing up to 2 million tests at no charge. And we will be distributing those products to a couple different areas in Tennessee and North Carolina. I believe it's 160,000 families who will be testing themselves three times a week. And what we hope is that we can demonstrate that by doing these serial tests each week, that we can dramatically reduce the amount of infection and prevalence in those communities.
Doug, I wonder about the pricing. I know you said that it was going to be under 30, but we know that there was a lot of discussion when Illum, for example, was authorized, and their price point is about 30, and their idea was to lower over time as production scaled up. Do you also see a similar strategy in the rollout, or do you anticipate any reduction beyond that into, say, the single-digit dollars?
That's a very good question, and the short answer is, first of all, that for the $30 that we're talking about, that's 2 tests. So we're not at that $30 per test level. We're already down to something around $15. From a cost perspective, our factory absorption, obviously per test, will dramatically lower. Our own costs will be obviously in total lower, and therefore we should be able to lower the product cost down into, certainly sub 10.
All right, Doug, we've been chatting a lot throughout this program about travel and how more and more folks are ready to leave their homes, get on a plane. A lot of places like Hawaii, for example, do require negative tests before you can enter into the state. This is also true for other countries. Is there opportunities there as you see it? I know you said that there's a 24 to 36 hour window, which I think fits very nicely into some of those windows that most countries and states are giving some of those passengers. Are folks going to be able to use a test like yours to get approved to enter into another country or state?
We believe so. It's pretty clear that there's a great deal of interest by entertainment and travel industries to make sure that passengers or patrons feel safe. Certainly this is a way to accomplish that. I think the emerging data suggests that by testing at least twice per week, that we can safely move about, getting on airplanes, traveling to various locations. So I would expect that we will see more of that. I think initially a lot of places, including my own company, we were testing only weekly. Now we're doing it twice a week because the data tell us that by doing that, we can dramatically reduce the chances of folks coming in here to our place of business who might be infected. So we tested probably from the fall until even today, this week. We did find positives early on, and I think we've stabilized that. We've had a couple of weeks now where we haven't had any employees test positive. But in the event that somebody is infected, they're going to discover it, and obviously they'll take what measures they need to consult with their physician and clearly not show up at work. So I do think that there is an opportunity. We do have customers ex-US at airports where testing is done. We've been in numerous conversations here in the US as well.
All right, Quidel CEO Doug Bryan, health reporter Anjali Kemlani, thank you both for this conversation today. And coming up, this is some pretty infuriating news. It's going to take more than a century for women to receive pay parity with men thanks to the pandemic. That's next.
It's been pretty well documented how the pandemic has disproportionately impacted women, specifically women of color. About 3 million women have actually left the workforce because of the coronavirus-induced exodus, and there is concern that they all won't be coming back. And now there's a new report from the World Economic Forum that finds it will take women 130 years to achieve pay parity with men because of the progress they have lost in the workplace during this pandemic. I spoke about that at a recent Funding Our Future panel about women and financial security.
The challenge I see in front of us is that partisan policy isn't lasting policy and won't stick around for the long term to help bridge that 130-year gap you just terrified me with. And I think we need to be pushing for more bipartisan conversation around retirement security. And I would credit Susan's great work and the work of others around this country who helped pass a bipartisan bill called the Secure Act and are working for the next generation of that. There's a lot that has been done in a bipartisan way over the last few years, and I hope we can carry it forward. In particular, I hope we can carry it forward around paid family and medical leave. You know, most working families do not have access to paid parental leave, paid family caregiving leave, or paid medical leave. And there are private sector solutions to that, and there's a public policy solution to that. And we really need a national program that sets some standards, that gets more people access. I think if we would have had that in place, we wouldn't have the numbers we're seeing right now of women who have left the workforce. I think that, 12-week bridge, if they were lucky enough to have it, could have really helped a lot of people stay connected to the workforce and come back quicker. And this whole year away is going to be really hard to return to work without the comfort of a paid parental, paid family caregiving, or paid medical policy that will be there if you have another situation like we've had this last year, or if you have a new baby, or your daughter has leukemia, or your husband gets hit by a car, or you have one of those terrifying experiences yourself. So I'm really hopeful that we'll see bipartisan action on those issues, and that bipartisan action will lead to lasting solutions.
Certainly, I could just add.
Yes,
could I just add that I think Adrienne is right on that. The time is now. Paid family medical leave. We need a public and private market solution, and disability insurance is providing income replacement for employees, particularly women that need to take time out of the workplace. And we've got a lot of knowledge on how to expand that. It doesn't have to be a government-only solution. And again, we have clout as women. I just can't say that enough. We should not be passive right now. We should stand up and shout and get done exactly what Adrienne is talking about.
That's right.
Yeah, Joanna, I see you nodding your head there. I mean, I think we can all agree that the pandemic has changed how we work, right? So many people realize that they could do things from home, do things remotely. I, as a broadcaster, never thought I'd be able to work from home, and yet here I am. So Joanna, can you talk a little bit about how this is going to impact women in particular? How has the workforce changed, possibly forever, post the pandemic?
Well, so that's a great question. And I mean, I think so many women in professional jobs that are the kinds of jobs that have benefits and give you sufficient income. And so the wraparound of benefits plus income, that perfect cocktail, if you will, that happy hour cocktail, the pandemic hasn't harmed them that much. I mean, most certainly mental health wise, I mean, let's be real, but financially hasn't harmed them that much. But that is still not the real lived experience for most low wage working women in this country who, again, don't have the kind of jobs that allow them to work from home like it looks like all of us are doing right now, that give them the perfect cocktail of benefits plus income. So that, I think that's where, as Adrienne was saying, that the real exciting place to be is right now is in where does policy support the kinds of women in jobs for whom that private sector is doing the best they can, right? It's not that we're saying these are bad employers or bad actors, but we need some support from policy that helps both figure out how you get to scale, figure out how to target the right set of workers, and figures out fundamentally how you fund it and how you fund it equitably. And the one thing I'll just add to specific policy proposals is that, Susan's right, like the time is now and people are excited and motivated, and it is really a bipartisan feeling. And so instead of a specific policy I'll mention sort sort of design feature of a policy that I think we need to talk about here, which is portability. And that would really help get to all kinds of workers, regardless of who they work for. You know, it's sort of, I can be, as opposed to my benefit being attached to my job, which may or may not offer it to me, and there's so much occupational segregation, as I mentioned, my benefits attached to me because I work and it travels with me to different jobs. So really just thinking about kind of the heart, we know sort of the heart of the benefits we need, but what we want to be really imaginative around is the distribution of them and the funding of them to make sure they're inclusive for all women.
It was a great conversation, and you can see the full conversation I had on that panel with those ladies a little later on Yahoo Finance. I think it's going to hit our site next week. But, you know, Kristen, we know that women have been disproportionately hit by this pandemic, and so many more women have left the workforce than men, mainly because of the childcare issues and the household duties that women have to take on. In addition to working outside of the home, many of them just found out, you know what, it doesn't pay for me to go to work right now during this pandemic if I have all these other things pressing at home. And I know earlier we spoke with a professor at Emory University School of Law, Professor Dorothy Brown, and she was talking about ways tax policy can actually help women when it comes to child care credits, right? That's an idea the Biden administration should be looking at.
Yeah, absolutely. We do see a lot of tax credits being used to essentially try to help mothers and help on caregiving. And in fact, the Biden administration has been pushed to create a whole caregiving infrastructure. And a lot of what you were talking about in this conversation, but specifically, if I can talk today, Alexis, around childcare, I do think a lot about Reshma Saujani. She was the recently departed head of Girls Who Code, and she kept proposing this idea of the Marshall Plan for moms, you know, pay women to be mothers, essentially, because it's a job. They have it. They have to take care of children. Often they're given that burden. And so we need to make sure that we are financially supporting those women. And, you know, as you were talking there, when it comes to childcare, we often see women giving up their jobs just because in places like New York, childcare is just so expensive. And because of the pay gap, it just doesn't make sense for women to go out and go to work, especially when caregiving is so costly and so expensive. But really, really alarming to see that study, 130 years for pay parity. I mean, that is honestly appalling.
Yeah, it definitely took those women by shock as well. It seems like we took two giant leaps backwards as a gender during this pandemic. Hopefully, though, with the help of policy, private and public partnerships, we can get a large amount of women back into the workforce where we belong. All right. Coming up next, we're going to take a look at the oil close. Oil today moving on some news coming out of OPEC. We'll have that for you right after this.
Welcome back to Yahoo Finance Live. We have Yahoo Finance's Jared Blickery here to take a peek at the energy markets. Now, Jared, we had that OPEC Plus meeting, and it was expected that they would extend production cuts. And in a perhaps plot twist, they actually chose to boost oil production instead. So break down what's happening there for us.
Yeah, you got that right. And they surprised everybody last month when they kept everything the same. So everybody thought, oh, they're just going to do the ceteris paribus this month again. But they didn't do that. They're going to gradually increase production in May, I believe April and May, yes. And also in June and July. They're meeting on a monthly basis right now. So it doesn't really affect things because they used to be on a quarterly basis. So they have the ability to change their mind. And indeed, the Saudi oil minister said, we can reverse course very quickly if this isn't working out. But we've seen the oil market is very fickle to changes in circumstance. We'll have to see if that comes to pass. So we just settled at 61.45 for WTI. We can see year to date, still up over 28%, holding on to those gains. And so kind of the reverse from yesterday when we closed under $60 a barrel, guys.
All right. Thanks so much, Jared Blickery, for breaking that down for us as always. All right. Let's talk now about Cathie Wood. She just launched a new thematic ETF around space innovation. That's ARKX. But our next guest is raising some red flags about their flagship ETF. That's ARKK. Now, he says that ARK's thematic approach is, quote, ill prepared for a major plot twist in the market. So let's bring on Robbie Greengold, strategist for Morningstar's U.S. Equity Strategies team. So Robbie, you really pulled no punches here when it came to some of this criticism. You called, I'm going to quote you here, you called the team inexperienced. You said that they lacked really stringent risk controls and that the portfolio is more vulnerable to severe losses. So what would it take, for that plot twist to come true, for that almost doomsday scenario that you're painting?
It could be any number of things. I think that Cathie Wood herself, let's say right away, she's very experienced. I think that her supporting analyst team, that has seen a lot of churn, and the analysts in place now have only been there for a couple of years, or maybe they joined more recently than that. And so yeah, I'll say that just about the inexperience of the team, and just relative to other of its peers that are investing in these sorts of innovative, disruptive platforms that ARK likes. The other firms out there have teams that have not only been at their firms for an extended period of time, but they also bring technical expertise that is pretty obvious. You have people in the healthcare space, for example, that have medical doctors on staff. They have advanced degrees in neuroscience or biology, and so these skills are important for the same kinds of names that ARK is investing in. They invest in genomics and immunotherapy companies, for examples. Now the downsides, the red flags just surrounding the lax risk controls that we see. This is an issue that is really. This is both a day-to-day issue and also just a question of how ARK is going to handle a market crisis unlike any it has seen before. They were able to navigate the coronavirus sell-off and come out fairly well. I mean, 2020 was an incredible year from a performance standpoint, but things are different now. The heft of the flagship strategy is new. They have not had to run the amount of assets that they have now. I think that the strategy is about 22 or 23 billion now, and so it's grown tenfold over the past year, and so that brings new risks, and the firm doesn't have it doesn't have a robust risk management infrastructure. There's nobody dedicated to risk management, and it's all the more important for a firm like this one that is a high return, high risk. It takes a high return, high risk philosophy. Some of its rivals don't need such attention to risk because they are, benchmark aware, or they are, that they have some sort of portfolio construction parameters that they will manage within. And ARC doesn't have very much of that at all.
What about, you bring up the point that you think that perhaps there's ultra specialization here, that perhaps the team at ARC is a little too narrowly focused on some of their stock choices. Why do you say that, and how does that leave them vulnerable?
Well, I don't think that is, I wouldn't call that a red flag, because they are investing in just these 5 disruptive platforms that they've identified: artificial intelligence, blockchain, energy storage, robotics, and what would be the 5th one? So I don't think that this being a thematic-oriented strategy is by itself a flaw, and I think that they've gone about product development in a thoughtful way. They've invested in these themes because they think they have longevity. So they probably wouldn't think that this ultra specialization within, going back to healthcare once again, they're investing in just a handful of healthcare companies that are tied to these specific themes of DNA sequencing or immunotherapy. And when you look at some of ARC's competition, their healthcare teams are looking across biotech and pharma, and they have just more hands on deck, and they are collaborating across the team. And so,
Right.
yeah, it's just that we come out, as we rate that pillar, the people pillar, we come out at average, because I think that I think we should give credit for the experience that is there, especially at the top. But it
That's
doesn't
very true.
stand out.
Kathy Wood her performance has been absolutely incredible, and she's been very lauded because of it. Robbie Greengold, strategist for Morningstar's U.S. Equity Strategies team, thanks so much for joining us. And coming up after the break, we're going to be talking about the outlook for the telehealth industry with the Chief Medical Officer of the telehealth platform, Nurx. That's next.
Even before COVID-19, telemedicine was a growing part of healthcare. But thanks to the pandemic, the popularity of taking our doctor's appointments virtually has skyrocketed. And some experts say that telehealth is about where it would have been in 2030 if not for the pandemic. One beneficiary of that is Nurx. The telehealth company saw unprecedented growth over the past year. And joining us now to talk about it is Nurx's Chief Medical Officer, Dr. Jennifer Pena. Doctor, good to see you again. Tell us what business is like for Nurx's services now, 1 year into the pandemic.
Nice to see you, Alexis, and thank you for having me back. You know, Nurx and other telehealth platforms have seen tremendous growth during 2020 because of the pandemic. At Nurx, we've seen tremendous growth across our service lines. We have over 350,000 active patients. We've seen growth even in specific service lines like that we've launched recently with acne. We've seen tremendous growth through our migraine service lines, which we also just launched. And our revenue grew tremendously. We're on a pathway to profitability here in 2021, our NPS score of 85%. So we're really looking at a successful year.
So, doctor, I know you just mentioned that you're expanding, beyond birth control and now launching acne treatments. Why did you make that decision to move into the dermatological space?
Yeah, that's a great question. So our new service lines are launched in response to patient demand. So we had birth control patients that were coming to our service asking for birth control to control their acne. And so we responded in turn by creating a real medical acne treatment line. Our medical team was seeing these patients were struggling with this condition, and we wanted to do more to prescribe them than just give them birth control, prescribe them actual other options for their acne. And, remember, acne is more than just cosmetic. It really affects self-esteem and how people engage with the world. And dermatology, unfortunately, tends to be expensive and inaccessible often. And so it fits with the mission of breaking down barriers to care. And it was really an amazing service that our patients wanted.
What about care for areas where, it might be difficult to do things via telemedicine? I think dermatology, and I think, well, wait a minute, maybe the doctor needs to see and feel my skin and get a closer look. How effective is it to do something like that virtually?
Yeah, it's a great question. So actually, we would never launch a line that we would not be able to provide care that's equal or better than the patient would receive in a traditional in-person doctor's office. And for better or for worse, stakeholders are starting to embrace this concept of the model of asynchronous care, where you can message with a patient and get photographs of things like skin and make diagnoses and appropriate treatments that way. Payers and providers and other industry stakeholders have initially been reluctant to engage with that kind of model, but they've been won over because of 2020 and the pandemic. The pandemic accelerated that understanding that care can be safely and efficiently delivered this way. And providers who maybe were not initially bought in either have bought in as well, because they feel that they can provide care that's more comprehensive, that's not rushed with their patients, and they can directly communicate with patients. And in many cases, that just results in better care.
So, doctor, we have like 30 seconds left. Curious to know if you think that telehealth is going to be a permanent change, to the healthcare industry. Folks have been at home this whole time and now don't think that they need to rush off to wait in a doctor's office to be seen.
Absolutely. They keep saying the future of telehealth. It's the present of telehealth. Telemedicine is here. It's very present, and it's no longer a stopgap measure. It's no longer a one-off. I need to call to get a prescription. If you can't get an appointment with your provider, it's the other way around. This is the first stop that most people are using to actually get their care, and then they go to the in-person provider when they need to. Absolutely, when they need to.
All right, incredible growth there at Nurx. Dr. Jennifer Pena, thanks so much. Don't go away, because when we come back, we dive into a report that finds 1 in 4 Americans have no retirement savings, and those who do aren't saving nearly enough.
For this week's Your Money segment, alarming figures out from a new study that shows a quarter of Americans have no retirement savings. Yahoo Finance's Stephanie Asimkos is here with those details. Stephanie, tell us about this report.
Right. The situation is really dire. And like you said, a quarter of Americans just have no savings for retirement. And this is across all generations. But as a little, sort of zoom in, the cohort that is immediately approaching retirement, so those that are 55 to 64-year-olds, PwC found that they have about $120,000 saved, which isn't a lot. And it is, but it isn't. And, when that's translated into monthly withdrawals, that's really about $1,000 a month, maybe less than, which is a very modest, even austere lifestyle. And here's where it gets even shakier, is that should the person in this scenario outlive their life expectancy, or have any sort of unforeseen medical or housing bill that they need to pay for, that amount decreases even more. And that money is also likely going to be taxed. So to take away even more money. And to add, just to the gloom and doom while we're at it, PwC also forecasts that Social Security will be depleted by 2034, which isn't that far away. So there's a huge demographic. Go ahead.
No, we only have about 30 seconds, but this sounds like a crisis is essentially brewing. Is that what the experts are saying? If Social Security runs out, folks have no money saved for their retirement, people are living longer, what happens then?
Right. So to quickly turn this around, employee-sponsored retirement savings plans are really expensive for small businesses to offer. So the proposed solution is that small business owners can sort of take their employees, for them to pool their, sort of collective money, similar to employees of medium and large-sized corporations, so they too can have defined contribution plans. And that can really boost participation and savings, because a lot of Americans work for small businesses.
Well, we can only hope so, because that is alarming, absolutely alarming to see how few people have saved for their retirement. Stephanie Asimkos, thanks for breaking down those details. Well, we're going to continue watching the S&P 500 to see if it can hold above that 4,000 level. You could see there it is actually rising up over 1% right now. Our afternoon coverage continues next.
Promising new data on the ability of the Pfizer vaccine to protect against COVID after 6 months, but will a production mishap at Johnson & Johnson cause a delay in their one-and-done vaccinations? Angelique Emlani has our COVID-19 update. We told you about the plans to pause student loan debt collections for more than 1 million people, but now we have the CEO from Summer, which helps student loan borrowers save thousands and thousands of dollars, on average as much as $30,000. Summer CEO Will Seeley explains how you can save too. But a new day, a new quarter, a new record high. Markets kick off the second quarter as Wall Street prepares for a new earnings season. What's old is new again. As we head to the closing bell, I'm Adam Shapiro.
And I'm Shauna Smith, and Adam, you are right here. We're looking at a new record as we kick off a new month and the new quarter, like you were saying, the S&P pushing above 4,000 for the first time. We'll see whether or not that holds in the final hour of trading. Dow also in the green, up 159 points, and Nasdaq holding on to gains. The biggest outperformer today, up just around 1.6%. Let's get to Jared Blickery for a closer look at today's action. Jared.
Well, I'll tell you what, not a bad first day to the month and the quarter. Last day of the trading week, I'll take it here. So we got the Dow up 0.5%, the S&P 500 doubling that, up 1%, the Nasdaq up the most, 1.6%, Russell 2000, the small caps up over 1%. And taking a look at inside the Nasdaq 100, it's really about the mega caps today, especially Microsoft, which is up over 2.5%. Alphabet's up nearly 3%. Facebook and Amazon each up more than 1%. And we got to check out the chip space because that is flying high today off of the $50 billion that may be earmarked for it in the infrastructure bill, as well as Micron earnings. Micron delivered a rosy forecast yesterday that exceeded analysts' expectations. And you can see they're approaching the top end of their trading range over the last 6 weeks. Have to see if they can break through, but a lot of dark green on the screen here. Taiwan Semi going to spend $100 billion or so. That's up 5%. So really the tech trade is not all about the mega caps, also about some of the chip names. So energy is now back in the forefront. That's up 2%. Had been a laggard earlier, but the OPEC Plus decision, even though they're increasing the supply of crude oil over the next few months, it's going to be gradual, and I think the market likes to take that. The Saudis aren't too concerned about the demand situation right now. To the downside, utilities, healthcare, and staples all on the red. Those are the defensive sectors, so all of it looking pretty bullish today.
Jared Blickery on this first day of the second quarter. We're going to be checking in with Jared throughout, but let's go to our first guest. We invite into the stream Chris Harvey. He is Wells Fargo Securities Head of Equity Strategy. Chris, thank you for joining us. And when we look at the markets as we prepare for a whole new earnings season, we have this issue with the Biden administration and Janet Yellen even talking about the tax situation. We know that there's a push to raise corporate taxes. Do you think that this is going to have an impact on equities going forward?
We do think it's going to have an impact on equities going forward, but we really don't think it's going to affect equities until, I would say, the summertime. By the time the summertime comes around, I think we're going to have two narratives that really weigh on the market. One is taxes, as you point out, is the economy is going to be in full swing at that point in time. And while the Fed won't, when does the Fed become no? Excuse me. And so you're going to have that dual narrative weighing stock. Short term is derail anything.
Hey, Chris, we're having a technical issue. There seems to be some kind of network interference, and I don't know if it's your internet provider throttling, your stream. We're going to have to shut down. We're going to come back in a minute, and we're going to update markets and proceed forward right after this.
Welcome back to Yahoo Finance Live. It looks like we have our audio issues worked out, so we're going to give it a go one more time. We want to welcome back in Chris Harvey. He's a Wells Fargo Securities head of equity strategy. And Chris, let's just start with the record that we're seeing today. S&P above 4,000 for the first time. But I want to ask you about the leadership, because we're seeing some of those big tech names back in favor. Do you expect tech to continue to be the outperformer?
We don't. So what we're seeing today is we're seeing rates go down. We've seen an oversold situation in big cap tech, but at the end of the day, the economy is going to be incredibly strong, and we're going to see rates move back higher. In addition to that, the consumer, we think, starting with this holiday season, the consumer is going to spend, and they're going to spend very aggressively. And so as we go forward in time, what we think is this balance is just an opportunity to reposition, and we're going to see those cyclicals, those more economically sensitive names, real leadership.
Chris, I want to just give this a shot. You had mentioned that tax question I asked you, probably not until this summer, but that doesn't mean that the earnings are going to perhaps plateau. I mean, we're looking at potential GDP of 6.5% in the second half of the year.
Yeah, Adam, you bring up a great point, because what we've been telling clients is we've been very aggressive. We've been talking about small caps, we've been talking about cyclicality, we've been talking about financials, but we're beginning to dial it back. We're starting to move up the capitalization range. We're starting to move up the risk curve. We're starting to look at things on a GARP approach, not so much a deep value approach. When we get to the summertime, is you're going to have one more leg higher. You're going to have a lot of your bond proxies and a lot of your defensive equities take another leg lower. And at that point in time, you may want to take a very hard shift to more defensives. The way things are being repriced very quickly, it's creating a very attractive, or what we think is a very attractive long-term opportunity. And by the summertime, as we look forward another 12 months, the situation may not look as exciting.
All right, Chris Harvey, Wells Fargo Securities, head of equity strategy. We'll get you back on soon after we get all these audio issues worked out. But thanks so much for sticking with us. We look forward to talking with you again soon. Let's get to some news that we got today on student loan debt. President Biden's chief of staff saying today that the president is looking into potentially canceling student loan. Let's listen.
He asked his Secretary of Education, who's just been on the job a few weeks, once he got on the job, to have his department prepare a memo on the president's legal authority. And hopefully we'll see that in the next few weeks. And then he'll look at that legal authority. He'll look at the policy issues around that, and he'll make a decision.
We want to bring in Will Seeley for a little bit more on this. He's co-founder and CEO of Summer, and it's a platform here that you help students save money when it comes to paying off their student loans. Will, I first want to ask you what we just heard from Ron Klain, the fact that he was saying that the president is looking into his legal authority, I should say, to cancel student debt. What's your reaction to that?
Yeah, we just, for context, represent tens of thousands of borrowers who are actively trying to navigate a complicated repayment landscape. And this is folks of all ages. The average age on our platform is well into folks' late 30s, early 40s. So people are spending decades navigating this issue. And so when the president is saying that he's navigating the student loan repayment process for the whole cohort of $1.6 trillion of debt across 45 million Americans, I think it reflects the complexities that are involved and him wanting to get it right. You have a lot of progressive groups that are pressuring the White House to take immediate action on mass cancellation. Obviously, there are a lot of folks on the other end who are saying, I've already paid my student debt. How does that impact me? At the end of the day, we represent borrowers and we want what's best for them. And so we think some form of cancellation makes sense.
When I was looking at your profile, correct, formerly at the Consumer Financial Protection Bureau, correct?
That's correct.
So you've seen how some of these loans can take advantage of people who don't quite understand what they're getting into. I was most impressed with the average savings that Summer has of $30,000 for people with consumer loan. I call it indentured servitude. Can you tell us more about how you save people money?
Yeah, so Summer was created by borrowers to help student loan borrowers across the country. I myself have student debt. Many of the folks at Summer do as well. We work with large organizations like the American Federation of Teachers, representing nearly 2 million teachers who during the pandemic, as you all know, have been put into really tough positions trying to help their students get the education they deserve, all while doing it during a pandemic that is putting many people's lives at risk. We just don't believe that student debt should be the thing that pushes them over the edge, the thing that prevents them from being able to help the people in their communities that they seek to do. And so we go in and help teachers, we help doctors, nurses, anyone who's amassing student debt enter into affordable repayment programs. These are federal, state, and other programs that exist to help people navigate programs like income-driven repayment. Unfortunately, these programs are very complicated. And the reality is even if the Biden administration does cancel a huge portion of student debt, unfortunately in this country, debt's not going away. And so we exist to help create a system where borrowers can enroll in these programs that are complicated to do. A lot of people liken it to filing your taxes, only there's never been an accountant there to help in any shape or form. We're trying to fill that void, give them a trusted source of information and the software to navigate those tough, complicated application forms.
RT, I think you need to unmute.
I believe I am unmuted.
There you go.
Will, we've talked a lot about administrative burden. We've talked about this issue of IDR and basically paperwork being such a challenge. But I'm curious, can you tell us a little bit about the partnerships you've had with the AFT and other organizations, how that works and how you created them?
Sure thing. So the American Federation of Teachers, which represents close to 2 million teachers across the country, they're constantly trying to represent teachers' best interests, and they provide a host of membership benefits in the affiliation. And so they're introducing Summer to teachers. We have similar partnerships with AFSCME, an organization that represents over 1 million public sector employees. And we've heard from these unions that their members are struggling to enroll in programs like income-driven repayment, public service loan forgiveness. And again, not too dissimilar from your taxes, they need additional support. So Summer is a platform, it's a software-based system that these unions and our other partners, we work with dozens of employers, both for-profit and nonprofit employers, providing Summer to their employees as a workplace benefit. And this voluntary benefit allows people to get into these programs and save quite a large sum of money. As I believe was mentioned earlier, we're saving borrowers close to $30,000 on average by enrolling them in these loan assistance programs that they otherwise didn't know about or tried to enroll in but were wrongly rejected.
Well, just a follow-up question. So in the CARES Act and the following stimulus package, there was a provision to basically help employers help their employees pay down their student loan debt. Can you talk a little bit about, have you started incorporating this into your platform? It just seems like a very interesting way to help borrowers.
Yeah, great question. So just recently in December, Congress moved forward with a new provision that allows for employers to contribute to their student loans of their employees tax-free. So there's a tax benefit involved, not too dissimilar from a match on a 401k for an employee. And so a lot of employers are now asking themselves, how can we do our part to fix this problem? Clearly, this is an issue. We're hearing it every day. It's all over the news. Student debt is a problem. And it's not just that student debt is too much. It's that it's very complicated to navigate this issue. You have spouses where two folks have student debt, and we work constantly where there's each spouse has student debt and they have student debt for their children. And so when you think about the complexities of different loans, both private and federal, there's over a dozen different types of loans. There's over a dozen different types of repayment plans. Tracking it is unbelievably complicated. So I think more and more employers are realizing, what is our part? What is our role to play? So Summer is now partnering with dozens of employers, and we're working with them to figure out how much money to allocate to their employees' student debt as another option to be able to chip away at this debt burden that is on the backs of millions of Americans.
Well, just quickly, one last question. So what is the worst case scenario for October? What worries you so much about that deadline?
Yeah, I think that if folks are unaware, millions of borrowers will be re-entering student loan repayment this October. It's just a few months away, and the challenge is that borrowers are paying hundreds, if not thousands of dollars a month on their student debt. So while we've seen the economy and its turbulence over the last several months and really the last year, the premise that borrowers are going to be magically ready to repay in October, I think, is a false one. I am personally worried about how many millions of borrowers will be at risk of missing loan payments and then defaulting on their student debt, which can result in fees of thousands, if not tens of thousands of dollars, and wrecking their credit scores along the way. So what we're doing is we're looking to partner with some very large organizations to get word out that borrowers need to start planning over the summer for this historic moment when loans come due again in October. And one of the best ways they can prepare is by enrolling in an income-driven repayment plan, so that if they're unemployed, their loans can be as low as $0, or if they're underemployed, their loans will be significantly lower than what they would have paid in a standard repayment plan.
All right. Well, Celie, great to see you. Co-founder and CEO of Summer, and then, of course, R.G. Swaminathan. Always great to have you on the show. We'll be right back.
Okay, about 38 minutes to the closing bell, and I want to share with you that when you live in Cleveland, Ohio for about 10 years, you like to make fun of Pittsburgh. I mean, after all, it's snowing today in Pittsburgh, Pennsylvania. Very few good things come out of Pittsburgh, right? That would be a Clevelander saying that, but actually something terrific is coming out of Pittsburgh today. And to help us discuss that is former Steelers, or as they would say in Pittsburgh, Steelers player Will Allen. He is a partner with McGarrick Venture Partners, and congratulations, because your VC firm is going to be targeting tech companies, not only in Pittsburgh, but Cleveland and throughout the Midwest. And forgive me for poking fun at Pittsburgh, because I know Cleveland and Pittsburgh like this. But tell us more about MVP.
Yeah, I'm still feeling that heartburn from that Steelers Brown playoff game, so don't rub it in too much. But McGarrick Venture Partners, MVP, is a Pittsburgh-based venture fund, and we're targeting all the great assets here in Pittsburgh. Like Carnegie Mellon University, University of Pittsburgh, and their life sciences, AI, robotics, and autonomy and autonomous driving vehicles. There's so much happening here. Our robotics industry and companies have grown somewhat of 200%. There's so many dynamic resources that we need to capture that value. So we're excited for this firm. I have some great partners in Jay Katarinzik, Mike Stubler, and Zach Malone, and we're just ready to get after it.
Well, congratulations on the new firm. I know you're focused on diversity, equity, and inclusion efforts. So just talk to us a little bit about that and what specifically you're looking for from a founder's perspective, but then also from a board member perspective.
Absolutely. Obviously, you don't want to just throw diversity out there. You want it to be meaningful and impactful, and you want to be intentional, and you have to look at the business case. And previously, with my partners, we looked historically at the investments they've made and said, hey, we've had some great success. You guys have had some great success investing in diverse entrepreneurs because the dollars show it, the teams show it. Let's double down on that. Let's be more intentional in our actions. So with this firm, we decided to direct capital towards that, and also be very intentional how the formation of the teams, right? The data shows that the more diverse the teams, the better the outcomes. So that's the business case, and we want to be really specific about it. So we're going to target that our firms. That our firm is helping the entrepreneurs build teams that are diverse, saying that we want African Americans, we want women, we want first generation immigrants and other people from diverse backgrounds to form these teams. So we're excited about that as well.
Well, there's a form of that in the NFL via the Rooney Rule, but I'm very curious because a lot of tech folk and a lot of investors tend to what people on the East Coast call flyover. They don't realize that in Cleveland, you got Case Western, great engineering school. That, as you pointed out, in Pittsburgh, Carnegie Mellon, and AI, the development of AI in Pittsburgh. In fact, I think Uber, one of the original self-driving tests, was in Pittsburgh. So can you tell us more about how you're targeting startups and perhaps first round funding firms that you're going to invest in?
No, you're absolutely right. Historically, that's been an issue. And that's what's so great about this firm is that, capturing that value, being on the ground, having that unfair advantage at Carnegie Mellon, at University of Pitt, at the other companies that maybe spin out the entrepreneurs that may leave, the engineering talent that exists. When you think about Carnegie Mellon and University of Pittsburgh, they rival with your Stanfords and your MITs of the world with research and all of the great technologies that come out of those universities. So we're really excited to capture that, but also capture all those great universities like the Case Westerns, the Ohio States, and, the Northwesterns across the Midwest. You can't overlook Illinois and their great engineers that come out of that university. So we're excited. I mean, it's a lot of huge potential that exists. There's a lot of, corporates and supply chains to tap into that we have great networks with. And our entrepreneurs that are flourishing in this region.
Well, how about the timing of your first investment? Anything that you can share with us on that?
Yeah, we're still we're still in our formation mode, and we can't share too much about it, but it's coming soon.
We look forward to when you can share that with us, because we want to have you come back. And I promise I won't pick on Pittsburgh, but next time you are here, feel free to pick on Cleveland. I'll earn it. I'll deserve it. Will Allen is a partner at MVP. We wish you all the best and continued success. When we come back, we will look at President Biden's $2 trillion infrastructure plan. Time for our 2 and 2, where Shauna and I take a look at some stocks you might want to pay attention to. And the first one that I'm going to draw your attention to is NIO. Shares of the Chinese EV company were trading up 2% throughout the first half of the trading session, where they have still maintained as we head to the closing bell. Part of what's going on here is that all EVs are getting a boost from the president's initiative, not only on infrastructure, but also green energy and building out charging stations. As far as NIO, they reported this morning that they delivered 7,257 cars for the month of March, right? Doesn't sound like a lot, but this Chinese EV startup said in their most recent report that they had a 373% increase year over year, and the quarterly number was at a record for NIO, 20,060 vehicles. That's up more than 400% in the first quarter of 2020. Then there is General Motors. Look at what's going on with General Motors right now. Shares are up about 0.5%. They were up a little bit stronger at the beginning of trading. Despite the global chip shortage, GM reported this morning that it sold 642,250 vehicles in the United States in the first quarter of 2021. GM estimates that the U.S. retail total market for vehicles in 2021 will be around 16.7 million units. Shauna?
Adam, I'm taking a look at CarMax. It's actually one of the worst performers in the S&P today. They were out with earnings. They posted a year-over-year drop in earnings. The revenue slightly missed estimates, coming in at $5.16 billion. Same-store sales fell by just over 2%, and you can see that reflected in the stock today, with shares off just around 7%. And then moving on to some IPO news, and a totally different story here. Taking a look at Compass, you can see shares pushing higher in their public debut, up just around 16.5%. This is an online real estate company that's backed by SoftBank's Vision Fund. It opened at $21.25 on the New York Stock Exchange. Right now, you can see it trading just shy of $21 a share. Taking a look at the numbers that they reported for the year 2020 for last year, they reported $3.7 billion in revenue and posted a $270 million net loss. Again, investors seem to be excited about this IPO, with shares up just around 16%. We've got just under 30 minutes to go in the trading day, and stocks continue to push higher. We're looking at a record start to the month of April and to the second quarter. For more on that, we want to bring in Sonal Desai of Franklin Templeton's Fixed Income Chief Investment Officer. And Sonal, we'll talk about rates in just a second, but first, I just want to get your thoughts on the S&P above 4,000. We're looking at another record high here for the market. Do you think we still have room to move to the upside?
So, Sean, I should preface everything I say by saying I'm not an expert on equities. Having said that, if I look at what is happening to the stock market right now, it's turbocharged, and it's interesting because the further it rises, the more the economy has to accelerate to kind of catch up with it. And certainly the type of stimulus we're seeing across the board is pointing in that direction. But I will say it makes me a little bit nervous, no doubt, to see this continued euphoria on the back of stimulus, essentially.
You are an expert on fixed income, and I'm going to call you that. So we're glad you're with us. It's Adam. It's good to see you, Sonal. One of the things you've pointed out, even though the sun is shining, you've got the umbrella out, it could rain, because the Fed's projections might be a bit too optimistic. And you actually say that inflation will immediately settle back right on target, even as unemployment falls below its long-run trend. Quote, I wouldn't be so sure. Why do you think the Fed is overly optimistic?
So it comes down to this. Look, if you're an inflation hawk, you've been wrong now for something like 12 years. I put my hand up here and say, yep, I've been wrong for at least 12 years on inflation. However, if I look at everything that's going on, how the stars are aligning, so to speak, we've got the Fed easier than it was post-GFC. QE, the current round of QE that we've seen immediately after the COVID crisis, it was larger than QE 1, 2, and 3 put together, right? Now, we also had last year a $2 trillion fiscal package to essentially save the economy. And that was launched on the verge of the economy shrinking by a third in annualized terms. And that was Q2 of last year. And then, of course, in December, we had another $900 billion. But now where are we? We've just done another 1.9 trillion. We're talking about another 2 trillion right now. Yes, spread out over several years maybe, but another 2 trillion in infrastructure spend. The Fed continues to be easy. And at this point, almost a third of US citizens have had their first dose of vaccinations. So you're talking about 3 different drivers that could, any one of them individually could turbocharge growth. We've got all 3. So if I look at that actually is pretty unprecedented. We didn't see this after the global financial crisis. And again, the type of collapse we had last year was very unusual because it was essentially switching the economy off because everyone went home and we stayed in lockdown. It's also different because you're not going to take 8 quarters to recover from that. We're recovering as we reopen, and reopening is linked to vaccines. So I think that's why I look at the Fed's forecasts, and I think they are being optimistic. There is a lot of demand. I heard what you said about, I think it was General Motors, the number of cars they've sold. It doesn't surprise me. Consumers are flush with cash. I would expect in the second half of the year, inflation could start going back up, or rather not come down at the pace the market expects.
Yeah, and so going over what you're saying just about the timing of this, I guess how quickly, if you're saying that we could maybe start seeing some traction on that in the second quarter, I mean, what are we talking about? What do you think it's going to look like if you fast forward to closer to the end of the year?
Full year growth this year, I think you could easily overshoot 7.5%. If last year we had an unprecedented collapse, this year we're going to see growth that we haven't seen in this country in, I certainly not in my memory. full year growth will be pretty astounding, I'd say.
Anil Desai, it's always great to have you on the program. Thanks so much for taking the time to join us today. Chief Investment Officer with Franklin Templeton Fixed Income. We're going to take a quick break, but coming up, new analysis of Pfizer's COVID-19 vaccine shows just how long it may prove effective against the virus. We're going to have an expert reaction right after the break.
With 20 minutes to the closing bell, there is the positive news from Pfizer, but there is a bit of a hiccup for Johnson & Johnson when it comes to the COVID vaccines. Angelique Kamlani has all the headlines for us. Angelique.
That's right, Adam. So we got news out of Pfizer today, and BioNTech, I should say, about their vaccine and the observation of the phase 3 clinical trial 6 months out. And that is since a number of those participants were dosed with that second dose. And this observation is really important because it's what sets the company up to be able to apply for full approval of the vaccine, so it can move out of that emergency use authorization status and then go on to marketing the product and expanding their commitments for production. Also, we did know that from the observation of the 6 months, it did lower that efficacy just slightly to 91.3%. If you recall, that was 95% initially. But also some good news out of from South Africa, based on the variant that is dominant there, that B.1.351 variant, that is the most concerning for all health experts because it has shown the most ability to weaken a vaccine's potential. But it did hold up pretty strongly there, so that's some really good news there. But meanwhile, moving on, we know that there's also some news out of Johnson & Johnson and a mix-up at a plant in Baltimore run by Emergent, which was contracted by the government as well to produce vaccines. Emergent is working on both Johnson & Johnson and AstraZeneca's vaccine, but the New York Times reported yesterday that a batch, which is the sort of earlier part of production of the vaccine, was botched due to human errors, and that could set production back. Now, it's important to note that this plant is not yet authorized to produce doses that are committed to being shipped out. In a statement to Yahoo Finance, Johnson & Johnson did say that specifically that that batch of drug substance did not meet the quality standards and that this specific plant is not yet authorized. So it's really the quality control process working in place as it should be to help the system move along and to help them identify problems early on. The current set of vaccines that we're getting is coming out of the Netherlands and will continue to be that way. Johnson & Johnson did also add that they are committed to meeting their commitments of the vaccines by the first half of 2021, and this should not be interrupting that so far. Meanwhile, in the testing space, some really good news. We got 2 over-the-counter tests authorized by the FDA, and that is from Quidel as well as Abbott Laboratories. And so those 2 companies will be able to sell their products in stores, and those are rapid antigen tests. These are those quick turnaround tests that can be done in any space, office space, at home, et cetera. But it's important to note that the supply of those is not yet available in stores. And that's something that we've seen even with earlier authorizations of similar products. Dr. Michael Mina over at Harvard did have something to say about that. Listen to what he had to say.
This is great news that we've had some regulatory hurdles come down. Now we need to get more companies in the space that can actually produce these tests so that people can actually access them. But I think they will be limited. There's going to be a short supply of them, and that will hopefully drive market demand. And we'll see new companies come on board, and maybe Abbott and Quidel will choose to scale to even greater numbers.
So as you can hear, really that concern that a lot of experts are worried about that, as we move forward and employers are looking to reopen, the supply of tests may not yet be available. Back to you guys.
Angelique, thank you very much. Let's bring into the stream Dr. Jay Schnitzer. He is Vice President, Chief Medical Officer, and Chief Technology Officer at MITRE Corp. It's good to see you again. One of the things I'd like you to talk about, because we keep talking about the government role in the COVID-19 healthcare situation, but you're part of a private sector response to the COVID-19 pandemic. Tell us about this.
Well, we started just a little over a year ago now, last March, the COVID-19 Healthcare Coalition as a group from the private sector spontaneously, when private sector organizations came together and said, we really want to try to do something about COVID, remember, this was just before it was starting to break out in the US in large numbers, knowing that there was going to be an impending clinical burden on our healthcare delivery system, to try to do something to prepare the systems for that and better enable them to deal with it from the private sector viewpoint. We started off with a couple of dozen members and very quickly ended up with over 1,000 organizations, not people, but organizations, large and small, who are all volunteering time and resources, all pro bono. Nobody got paid anything to participate in this effort, and this is ongoing to this day.
Doctor, you're looking at the numbers, and the cases have been climbing here in the U.S. We've seen the warnings about another wave. How worried are you that this is the start of another wave here in the U.S.?
Well, I am concerned. I mean, if you look at the most recent numbers for daily new cases, you will see that they came down phenomenally well during the month of February, but more recently, there's been a bit of a plateau and now a slight uptick over the last few days. Which is pretty concerning. We were seeing a nice downward trend, and the fact that it's going back up and driven at least in part by the variants, particularly the UK variant across the country, which is estimated to be 40 to 50% overall of the new cases, that is of concern. We're now in a race between the variants and vaccinations, and we've got to maintain our vigilance in terms of practicing good behaviors. That includes wearing masks, good hygiene, and social distancing until enough Americans are vaccinated to reduce this risk. If we don't, we're going to see this go up.
We got the positive news about Pfizer, though. Their vaccine seems to be quite effective against the South African variant. Everyone was worried about that. So with that kind of news, how do you debunk the perception that Pfizer and Moderna are the great vaccines and that AstraZeneca and maybe the one and done Johnson & Johnson, not so much?
there's really no difference in terms of their efficacy. I mean, the numbers, the differences are small, but what really matters are the data over time. And so far, we only have long-term data, 6-month data on Pfizer, which looks excellent. But what we really want to see is the data from the other vaccines and the other phase 3 trials, first of all. And then secondly, just as what was reported, how they do with the variants. But remember, the important thing is to have as many Americans vaccinated as possible. Having large amounts of people vaccinated across the country is what will decrease the reservoir for the variants to persist. And I'm not only worried about the 3 or 4 or 5 variants we know about today, I'm equally worried about the next 3 that we don't even know about yet. So we really need to get this under control as soon as possible in order to prevent the next round of variants, which could be worse.
Well, Doctor, talking about the variants and how you're worried about the ones that we don't even know about yet, employers have started to talk to their employees about bringing people back to work. When should that be done? Because I think there's a lot of confusion out there just as to how safe, if you're fully vaccinated, should you feel safe about going into the office?
It depends on the environment. If the workspace is such that people are able to maintain social distancing, if they're practicing good behaviors such as wearing masks and practicing good hygiene, and if most of the workers in that facility have been vaccinated, that's a safe environment. If the answer to those questions is no, or one or more of those questions, then you got to wonder whether it's safe enough. This is all about risk reduction and risk mitigation. We're never going to be able to eliminate the risk entirely, but we got to make the risk low enough so it makes sense for everybody. And that's going to vary case by case, depending on the answers to the questions I just raised.
Dr. Jay Schnitzer is Vice President, Chief Medical Officer, and Chief Technology Officer at MITRE Corp. Thank you very much for joining us. We'll be right back.
Baseball. Today's the opening day for the Major League. The minor league starts up next week. We want to bring in Larry Battelle. He's the president of Alliance Sports. And Larry, I know Alliance Sports just announced a a partnership with Oak Tree Capital where you're going to be giving loans to minor league teams in need of cash. So we wanted to bring you on as the season gets underway because you know what you're talking about. You own and operate a couple of minor league teams. Just give us a sense of the financial situation that these teams are in as they start a new season 1 year into the pandemic.
Yeah, and actually the season starts May 4th to add to the uncertainty and the dynamics of what we're facing in the business right now. But, you know, as I think people realize, there was no minor league baseball season last year. And that means for us that we had no revenue last year. So COVID had a very big effect on our business. And that's something that we will probably not recover from, you know, even this year or going into next year as fans get more comfortable returning to the stadiums. The one thing that's interesting about minor league baseball is that 100% of our revenue is driven from people coming to the ballpark. We don't have television contracts. We don't have national sponsorship deals like the major league sports do. So we are very reliant on fans in the ballpark. You know, last year we had 0. You know, this year we're hoping, you know, that most will return, you know, subject to rules and regulations and keeping people safe. But our revenue is going to be severely constrained this year. And that all creates the need for money and the need for capital. And
Sure.
minor league baseball typically didn't have great means of financing to begin with. And given the current situation, that has gotten even worse.
Larry, this brings up memories because I recall going to, it was the Maine Guides. This is a billion years ago. AAA team played in Old Orchard Beach, Maine. But I'm curious, do the minor league teams, could they have accessed, not that it's a solution, but accessed any of the government programs, the PPP, to help get through the pandemic when they're not playing, and then your financing to get to the next stage?
Yeah, great question. And we did. You know, both programs were able to be used by minor league baseball teams. But just to put some perspective around that, on average, and there were 160 minor league baseball teams, now there are 120 because there was contraction going into this season. But on average, a minor league baseball team's top line revenue was about $5 million a year. I will tell you that, you know, PPP loans probably filled about $500,000 of that. So 1/10 of our revenue, you know, may have been mitigated by PPP loans. Obviously, there were other ways that we mitigated, you know, with layoffs and furloughs and cutting expenses and things like that. But for the most part, I think the average minor league baseball team on a bottom line basis lost $2 to $3 million last year. And that's a big number for a minor league baseball team.
Hey, Larry, real quick, just going back to what you said earlier, we thought AAA started next week. Has that changed now with the recent surge in COVID?
I don't know if it changed with the recent surge in COVID, but it changed. May 4th is now opening day for AAA. Actually, May 4th opening day for all levels. And I think what Major League Baseball decided was that they were comfortable putting, you know, let's say 25 to 30 players into 30 different markets with the proper protocols, but they were a little hesitant to put 25 to 30 players into 120 markets, which are, you know, what we have in minor league baseball at this point in time. So I think they're hoping that, you know, we put in place the protocols that they've set, that there are more players vaccinated, and that they can more comfortably ramp up safely, you know, in the minor leagues come May 4th versus April 1st, which is what it was supposed to be.
Larry Battelle, we really appreciate you taking the time to join us today. Thanks so much for hopping on here with us, President of Alliance Sports. We're going to take a quick break. We have the closing bell for you when we come back. Looking at a record start to the month, all three of the major averages in the green, S&P hitting a new record high. We have full coverage for you. Kevin Nicholson, Riverfront's Global Fixed Income Co-Chief Investment Officer, is with us. We also have Ed Egalinsky. He is Directions Managing Director and Head of Alternatives. And of course, Jared Blickery standing by with a closer look at some of these big movers into the close. Jared, let me go to you first, because we're seeing some buying here on the first trading day of April, with all three of the averages here moving to the upside.
That's right. And the action today has been centered in tech. We can see the Nasdaq 100 up 1.7%. Excuse me, this is a composite. Let's take a look at what's happening over the week. 2.54%. That's a nice add for the Nasdaq, which has been under pressure during various times this year. Also looking at the Dow, that is a laggard of the day, up 0.5%. Going to probably notch about 0.25% for the week. And if we drill down inside the Nasdaq 100 this time, we can see the mega caps adding to gains, except for Apple. Looks like Apple losing a little bit of steam here, but look at Alphabet. Alphabet up almost 3.5%, 21% year to date. And let's check out what it's done this week. Another 5%. Also, Facebook has been a gainer this week. That's up over 1%. Microsoft and Amazon up over 2%. Also, the chip space. Got to highlight this again, because after those Micron earnings yesterday, then followed up by that Biden speech on infrastructure, potentially $50 billion outlaid for the space. We're seeing a lot of dark green here. Applied Materials also up 5.5%. Lam Research up 7%. Probably going to see some more consolidation in the space. Now, we also have to take a look at the energy market, because that has been in focus since OPEC Plus finally met today and decided that they were finally going to raise production just a little bit, catching market participants off guard just a little bit. But we closed over $60 per barrel, and we're seeing some nice gains in the space as well. Exxon up over 2%, Chevron up 1%. And here is the closing bell on the first day of Q2.
All right, we got a closing bell. Curtain drops on the first day of trading on the second quarter. And as Jared just said, we had some winners. Let's take a look at where things are going to settle. Dow's going to be up about 0.5%. The S&P 500 is going to be up more than 1%, record territory, 4,019. Nasdaq up more than 1.75%. We'll keep an eye on that. Big sector winners today. Communications services up about 2%. Energy, Jared was just talking about that, up 2.5%. Sectors that lost, consumer staples down 0.25%, healthcare off 0.25%, and of course utilities, they were off about 0.25%. Let's go back to our guests, and I want to throw it to Kevin, because you've pointed out that the expectation is for revenue growth in the first quarter, especially as we're going to hear from the companies. We're going to get a whole new round of earnings. But is it possible that, I'm going to quote Moira Rose from Schitt's Creek, that people are counting their poultry before it incubates, that they're jumping the gun on this?
Well, I think that's what's happening is the market is pricing for perfection right now. And when I say perfection in the sense that we're going to have a smooth reopening of the economy, and that we're going to continue to have vaccinations go smoothly, and that we're not going to have any hiccups. But I think that, first quarter earnings are going to be good, and it's setting up that, there's momentum that's going into second quarter.
And what do you think of the leadership that we're seeing, at least for today? We're seeing tech back in favor.
Well, you've seen really schizophrenic behavior. You've seen a couple of days where the small caps have led this week, and the last 2 days tech. What we're seeing, especially with our short-term trading vehicles, in light of the infrastructure stimulus that is proposed, continues to be in our triple leverage industrials and transports. So from a short-term trading perspective, we're seeing money in the industrials and transportation. Also, as your guest said before, in the semis as well. SoxL is our biggest fund at Direction. It's triple leverage semiconductors it tracks, very short-term trading vehicles, but we continue to see momentum there. Despite the fact that some people are thinking that with rates as high as they are now, albeit off of low levels, that areas like healthcare and tech and utilities might suffer if that rate rises continue.
Well, and I want to keep this discussion going, especially when it comes to infrastructure, because with the market as high as it is right now, and everyone anticipating big spending with infrastructure, but that's going to be a several month, perhaps even a year-long debate without a guaranteed outcome. Would you be buying at an expensive point right now, or would it be better to wait till we get more direction out of Congress?
Well, that's $1 million question. I think some infrastructure bill is going to get through. How big remains to be seen. So I think that has bipartisan support. Could you wait a little bit maybe and let the dust settle? Yes. But ultimately, I think those are areas to be in for the foreseeable future where there's opportunity. Also, let's touch on with the stimulus proposal, alternative energy as well as electric vehicles. And you're seeing those are catching a bit over the last couple of days. In fact, we just launched a hydrogen ETF this week, HJEN. That's seeing some flows in there, as well as our Moon ETF, which encompasses a number of innovative, disruptive companies that includes electric vehicles and alternative energy.
Kevin, after you heard President Biden's infrastructure plan yesterday, did that change at all your projections for yield, at least in the, maybe not short term, because like Adam was saying, this is something that we might not get for some time, but maybe looking a little bit longer out?
No, it really hasn't. In the short term, I expected rates were going to be within a 25 basis point range in that 150 to 175 range. As we move further out in the year, I really don't see, yields crossing much higher than 2% this year. And the large reason for that is because I think that there is opportunity from foreign investors to actually pick up some incremental yield, both in Europe and Japan. Those investors can pick up anywhere from 100 to 115 basis points, and that's including the hedging costs. So I think that we're going to have some support as far as yields are concerned, as far as moving higher. So there's going to be a little bit of overhead resistance, I think, because you're going to get those buyers coming in as yields have moved higher here.
But Kevin, you also point out that in your terminology with the equities, they're going to grind higher because wages are not going to be going up, if I'm reading you correctly. Therefore, the demand or the spending we would want to come with that, not so much. Right, Kevin?
Yeah, I mean, from the equity perspective, equities are going to be dependent on how fast yields actually move up. And if yields don't move up, that quickly, I think equities will continue to grind higher. And when I say grind higher is because I believe that there are going to be some pullbacks. So when you go back from to March of 2020, when the market was at its lows, we've pretty much had a straight path straight up over the past year, with some very short pullbacks, very minor pullbacks in the market. And I think that going forward, we're going to see a lot more pullbacks, and they're going to be a little bit more volatile than we have seen over the past year. So that's why I think it's going to be a grind higher from current levels, because we are priced for perfection, as I said earlier.
All right, Kevin Nicholson of Riverfront and also Ed Eglinski of Direction. Always great to have you both. Thanks so much for hopping on here with us today. We're going to take a quick break, but when we come back, how President Biden's proposed tax changes may impact your financial planning. We have all that when we come back.
Alan Becker is Retirement Solutions Group President and CEO, and we invite him into the stream to talk about retirement in our retirement segment, which is brought to you by Fidelity Investments. Good to have you here, Alan. And I guess the question to ask is, I would hope we all have estates in the multi-million dollars that we can leave to our families when we depart and get our heavenly reward, hopefully heavenly. What is the status on that? These tax changes that could potentially come, where do we stand?
Well, first off, Adam, thanks for having me. I think there's definitely a separation between the different political parties with people, but in general, though, taxes are going to most likely go up, and we're going to see more as the laws come out and we can figure out how they are. The biggest key, though, is to be with a financial advisor so you can understand, because a lot of this is going to be about distribution. When you're in retirement, right, and you've got to take your money out, too many people are looking at using their IRAs, maybe they don't need the money, so they're letting that stay instead of using Social Security earlier. And if taxes go up, we're looking at a lot of different sides. We're talking about the idea of lowering the estate tax. You said in the millions just a moment ago. I've heard talk about lowering that down into that $3 million range. That's going to take a lot of, kind of the millionaire next door, people that have a lot of money in their 401ks. And they're going to end up with estate tax. This is something we haven't had to face in a few years. So I think people are very concerned about it.
Well, Alan, because it's not only individual tax, but also the corporate tax rate. I mean, what does that mean just in order for 401ks? Because if corporations are facing higher taxes, maybe they won't be as willing then to do the matching, right?
Right. So, we tell our client family that if they have a 401k and that 401k has a match, absolutely, that's free money. Don't leave that on the table, invest in that. But if you have a 401k that is not matching, there might be better solutions out there looking at opportunities with a true holistic financial plan where you're looking at all different aspects of things. You can do Roth IRAs so that you're not borrowing money from the government, because the way we look at it is, our Uncle Sam, and I served in the military, I love this country, but they're controlling our taxes. As they get raised, they control the distribution. It's kind of like having a loan where you don't know the interest rate. So a lot of people are scared that the money's not going to go as far in retirement. And yeah, if companies are not investing, if you really think about it, there's only a couple ways to fix debt. You either cut spending or you raise taxes. And I don't see the government cutting spending anytime. So yeah, the corporations, when they can't get money as inexpensive, they're going to have to spend their own capital.
What would you say to an individual? I'm going to just pick an age out of thin air. Let's say 67, because I guess that's the point when your Social Security really maxes, who has both the traditional IRA, but also perhaps Roth 401k. What do you start pulling first, the Roth or the taxable?
All right. So to me, this is really easy. When you look at the current tax brackets, and obviously those are scheduled to change here. So you have to look at that, and you should be maxing your bracket. I see a lot of people that'll come into the office and like, oh, I love my financial advisor. I didn't pay any taxes last year. And I'm like, well, you're, the lowest tax rate, you're in that like 12% rate, you're saving money. But if taxes go up in the future, then you're going to be paying more taxes later, right? So why not take and live on your qualified money now? So to answer that is the IRA, the traditional. Pull that out, max that to the highest bracket you're comfortable. But if you're 67, you want to keep that under 171,000, because then you'll go into Medicare surcharges. So theoretically, keep your income under 171 using your adjusted gross, using your qualified money to max that out. Then you'll be in the best tax rate for right now. And then use that Roth IRA for those external purchases. If you, for like a car, a vacation, something that's, those once in life, not the needs.
Hey, Alan, real quick, we only have about a minute left, but I want to ask you, because the proportion of older workers now participating in the labor market, we've seen that steadily decline, pretty much steadily decline. Right now, it's around the lowest level that we've seen in about a year. Have these workers retired? From the people that you're talking to, are they permanently out of the workforce, or do you expect them to re-enter the workforce, say, a year or so from now?
Well, life's short, and I think COVID has taught us, if anything, that we don't know what the future necessarily holds, right? That, we could be healthy one day and not the next. So I think a lot of, especially in our area, a lot of the older clientele are looking at it going, why am I working? Is there something else I could be doing? Whether reinvent myself, so they might go back into more of an entrepreneurial job. But others are saying, once this, the remote learning is over, or working from home, do they really want to go back into the office and do that daily grind? So I see a lot more people retiring and enjoying life. At least that's what we see here in the Midwest.
Life is short, but as they say at Faber College, knowledge is good. We appreciate the input. I've just made I can't even remember the movie. That's how old I'm getting. Anyway, Alan Becker, Retirement Solutions Group President and CEO, Animal House, just came to me. That's the 50-plus-year-old brain. We'll be right back.
Talk about digital currency. The Fed continues to look into its use of a central bank issued digital currency. We want to bring in Brian Chung for a little bit more on this. And Brian, the big question is, should we expect a Fed-backed digital dollar anytime soon?
Well, it seems like Fed officials right now are on the fence about whether or not they want to issue a digital U.S. dollar. And for those that are unaware of how this would work, obviously the United States Federal Reserve, in addition to the Treasury, mint physical bills. But at some point, because so many people are taking digital transactions through Apple Pay or through QR codes, whether or not the Fed could issue its own wallet where you would have digital currency that you could use at your 7-Eleven, at your grocery store, at the clothing store. But the Federal Reserve is saying pump the brakes for right now. There are a lot of concerns about issuing a digital currency like privacy. If the Fed uses some sort of blockchain technology, people might have concerns about the Fed knowing where you're using those individual transactions at an individual basis. Then, of course, there's also the concerns about whether or not that would get banks upset, because obviously if you have your own digital wallet that the Federal Reserve is issuing, that could be pulling customer deposits from where they might park them otherwise at a bank. So we heard from Fed Chairman Jerome Powell in testimony last week saying that they're not going to move forward on any sort of US digital dollar unless they have the explicit blessing of Congress itself. And then you also heard from Randall Quarles, who's a Fed governor who spoke earlier this week. He said, quote, the fundamental question of what are we trying to do with this is not clearly answered. He later said, I don't see an urgent flaw in our system that a central bank digital currency would fix. And that's a pretty lukewarm approach to the US digital dollar. So it seems like for right now, the Fed's saying, we're looking at this, we're experimenting with it, but we're far from announcing that we're actually going to do this.
Is there, I'm trying to get my brain around this, and I don't have the brain capacity you have, but we have a dollar and we've got Bitcoin. Why would we even need a US digital dollar? We already have fintech systems to allow.
Yeah, absolutely. And one reason for that might be because there's just competition in the space. When you look at the European Central Bank, you have Christine Lagarde saying they already have plans to get something launched in terms of a digital euro within 4 years. You have Facebook's Libra project, which by the way is now called Diem. That's going to be a project that they're trying to also use to have more digital use of currency. The trend here right now is that we're going to a more cashless society. At the same time, the Federal Reserve has said we're not going to eliminate cash. And I think the European Central Bank and other central banks that are playing around with their own digital currencies like Mexico, like Sweden, they've said the same thing. Cash is not going to go away completely, but using digital currency would have some sort of implications for the central banks themselves. Think about negative interest rate policy in the Japanese and also the European central banking systems. They have negative interest rates that penalizes people for parking money at a bank. It would be more effective for them to transmit those negative interest rates if they were already having those direct lines into customer wallets, which have digital euros or digital yen, for example. I think that's why you have a lot of central banks that are interested in it. Obviously, we don't have negative interest rates here in the United States, but there is something to be said that digital currencies also increase the effectiveness of central bank policy, something that, of course, at a broad level, every central bank will be interested in.
Brian, you mentioned some of the other countries that are also looking into this, or other central banks, I should say. Where do their efforts stand right now?
Well, for right now, it's all over the place. So you have the likes of China, for example, the People's Bank of China. They're already piloting the use of a digital renminbi with users in, I believe it's Shenzhen, where they're doing pilots. They're already dropping lucky users amount of money into a digital wallet that they would be downloading onto their mobile phone and trying to see how they use it in transactions at the store, at the grocery store, at clothing stores, and the like. Whereas in the United States, all they're doing right now is just testing possible use cases for a digital dollar. Right now, the Federal Reserve Bank of Boston is working with the Massachusetts Institute of Technology. Obviously, a lot of brain power in both of those two institutions, trying to work together to see where in practice the US dollar might be able to try to do the same thing. And then you have central banks that are kind of in the middle. Like I said, the European Central Bank, which has done a lot of its testing already and said that it's already trying to investigate possible uses of models that they've already tested. Even in Mexico, they already have the use of a QR code where, again, they're also trying to test out the use of it on the ground. So it's all over the place. The Federal Reserve has said they don't care to be first in this space, and especially when the US dollar is the world's reserve currency, you want to try to minimize the amount of changes that you do to that currency. But of course, the Federal Reserve is saying because everyone else is paying attention to it, so are we.
All right, Brian Chung, thanks so much. We want to switch from the Fed and talk about fame and fortune, or I guess misfortune would be a better representation of this case that we're going to be talking about. Real Housewives star Jen Shah, she's running into some legal issues. She's been charged in a telemarketing scheme. Alexandra Canal has a little bit more on this for us. Ali, what can you tell us?
I like that, Shauna. Fame and misfortune. And you are right. Real Housewives of Salt Lake City star Jen Shah. She was arrested on Tuesday on charges of conspiracy to commit wire fraud in connection to a telemarketing scheme, in addition to conspiracy to commit money laundering. Now, both of these charges carry a sentence of up to 50 years in federal prison. So this is serious stuff that we're talking about here. I did reach out to a lawyer to ask him about this case, and he said that Shah's role on the Real Housewives Housewives of Salt Lake City is actually a net negative in the long run. The things that she said on that show, the questions that she's answered that could and most likely will be used against her in court. For example, just last month, Andy Cohen asked her, okay, well, what exactly do you do for work? How do you make your money? Why do you have to employ 8 assistants? And she gave quite a confusing answer, bit convoluted, saying that she runs 3 different marketing companies, and that most likely is an answer that they're going to use in court. The indictment also called out the fact that she's a reality star. So all of this exposure isn't really that good. In some cases, the lawyer that I spoke with told me that it could actually lead to a harsher punishment. So moral of the story here is if you're going to commit a federal crime, just don't do it on national television. So we'll see what happens in this case.
So let's shift gears, because this is not a crime if you love the movie Knives Out, which I think actually was the last movie I saw in a movie theater. So Netflix is going to shell out big bucks for this. Tell us more.
Yeah, Netflix is putting their money where their mouth is, and they have pledged to commit $450 million to secure the rights to the Knives Out sequel. That's according to multiple reports from both Deadline and Variety. And this is something that I was shocked at. It's a very high number. It's actually the largest movie streaming deal in history. This is a ton of money that Netflix is throwing here. And I spoke to an analyst, Santosh Rao, on this, and he said, look, you really shouldn't be that surprised. For 2021 alone, Netflix has committed $19 billion on content. So this is really just a drop in the bucket. And this is something that not only do they want to do, but something that they absolutely need to do if they want to be able to compete with all of the other streamers that are out there, Disney Plus, Amazon Prime, Apple. They are all getting very aggressive when it comes to trying to get as much content on their platform as possible. And with Netflix, they have well over 200 million global subscribers. So there's an expectation there that they are going to have the strongest content. So they're willing to put up the big bucks in order to get that. So it's certainly a good thing for Netflix and their position in the streaming wars. And I'm excited to see it. I hope that it comes out soon, because the first one was very good.
So, Allie, real quick, it sounds like then if this makes sense and the analysts aren't surprised about this, that we could expect more of these types of deals going forward.
Absolutely. And I think specifically for Netflix, who they're known, right, for spending a lot of money on content. This is not anything new. And that's why I also think you're not seeing too much happen with the stock. I think investors largely expected this to happen. This wasn't that too big of a surprising move. And at the end of the day, content is king. Movies are important. Sequels are important. So I think you can certainly see some more of these deals develop over the next few years.
All right, Allie Canal, thanks so much for breaking that down for us. And we should mention that Netflix was one of the winners here in today's market, with shares closing up more than 3%. Let's take a look at where things closed here before we let you go. It was a record day, like we said, as we started a new month and started the second quarter. You can see the S&P closing up just over 1% and closing above 4,000 for the first time. The Nasdaq was the outperformer, powered by a lot of those big tech names, with the Nasdaq closing up just around 1.7%. The Dow closing up 171 points. I mentioned Netflix being up more than 3%. Alphabet was also a big winner today. That stock closing up more than 3% as well. Well, stay tuned right here on Yahoo Finance, because the latest episode of Influencers with Andy Serwer comes up next. He will be speaking with legendary filmmaker Ken Burns. That all starts right after the break.
For more than 30 years, Ken Burns has brought to life some of the most important aspects of America. From the Civil War to baseball, his documentaries have inspired an entire generation of filmmakers while introducing American history to a mainstream audience through his broadcasting partner, PBS. His work has earned awards and broken records, reaching many millions of viewers with his signature style, now called the Burns Effect. But despite all of his success, Burns shows no signs of slowing down. In this episode of Influencers, I'm joined by the legendary filmmaker as we discuss his latest documentary on the life of Ernest Hemingway, his filmmaking process, and why he says we're experiencing one of the most challenging times in American history. Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Ken Burns, celebrated documentary filmmaker. His latest movie, Hemingway, co-directed with Lynn Novick, premieres on PBS on April 5th. Ken, welcome.
Thank you, Andy. Great to see you and great to be with you.
So why Ernest Hemingway, Ken, and why now?
Well, the now is a complicated thing. So I found a scrap of paper from the early 80s or mid 80s that said after baseball, meaning we were working on the Civil War, but baseball might be next, do Hemingway. And then Lynn in the mid 90s had visited Key West, one of the places where he lived famously, and came away with a sense of his presence there and sort of reinvigorated us. Jeff Ward, our writer of this and longtime collaborator, longest collaborator I've had, he and I have been talking about it for ages. And so finally we reached a place where there was the bandwidth, a break in the unbelievable schedule. I'm working on 9 films at once, if you count the Hemingway promotion as a film. I mean, literally they're underway. I mean, this is not on the back burner, not in development or turnaround. So we did our first interview on this in 14, and we had said yes to it probably in 12, but 14 it goes. So it's not now, it's just you're looking for enduring and evergreen subjects, not because they'll live forever, but because I'm interested in the American beat. But then you find out that, history doesn't repeat itself, but as Mark Twain might have said, and he was the hero for Hemingway, history doesn't repeat itself, but it rhymes. And so you hear the rhyme. So whenever we finish a film, we pick up and it seems to be exactly speaking to the moment in a way. I mean, first of all, here's this guy with this toxic masculinity, certainly you got to throw him out, right? But no, it turns out that's a sort of an edifice built to sort of mask deep insecurities and anxieties and gender fluidity and curiosity about the other sex. His wives, he's always having them cut their hair short like a boy, and he's growing his hair long. And so there's unbelievable stuff that maybe only now we can begin to understand and speak about freely within a social dynamic. So he's a great writer. It's a hell of a story, and that's all that is really takes for us to do it.
It certainly is. I just watched it, and it's 6 hours, but it doesn't seem like it at all. You fly right through it, and you think you know about Ernest Hemingway. Trust me, you don't.
We don't. I had no idea.
So rich. I mean, 3 wars and all the writing and the wives and the relationships and the families. And I actually, after I stopped watching it, I went into Wikipedia to find out more about his descendants. I mean, it's a very rich story. And as you said, Ken, it touches on masculinity, mental health issues, alcoholism. How do you balance bringing a modern day look at these topics while honoring the history at the same time?
Yeah, well, it's not bringing anything modern. It's just telling the story. The story is always it. So we're not thinking about stuff other than the fact that we are human beings, Lynn and I and Jeff Ward and our senior producer, Sarah Botstein, and our remarkable team. We are thinking in this moment, but it is informed by trying to get a story right. And the laws of storytelling are as old as human beings. And so you're not sort of have an eye on it. Whenever we finish a film, we look up and see the way it resonates. You know, in Vietnam, I used to go out with a stump speech and say, what if I told you I was working on a film about mass demonstrations taking place across the country against the current administration, a White House in disarray, obsessed with leaks, a president certain the press was lying about him, about big document drops of stolen classified material into the public sphere that destabilized the national political conversation, and accusations that a political party reached out to a foreign power during a time of a national election to affect that election. You'd go, wait, it's 2017. This is what's just happened to us. But that was true when we began work in 2006 about the Vietnam War, and was true when we finished the editorial work in 2015, a month before the Iowa caucuses, out of which Donald Trump was not supposed to emerge. So, you know, this is human nature that doesn't change. Mental illness has been around from the very beginning. Read Ajax and other works of the Greek stuff. The PTSD is there. So here we have a story. A great writer who's a minimalist with spare prose. It's like an iceberg, right? Just as he says, only an eighth is showing above the water. 7/8 is below the water. He's pulled it out. It's spare, inviting meaning. And he's focusing on observing nature. He's focusing on the relationships between human beings, particularly men and women. He's focusing on war. He's focusing on death. And then you've got this edifice of this macho guy that has to be done. You've got letters that help betray that. So what we do is we just go along and you begin to appreciate the demons that are going to catch up with him in his 61st year are many and come from childhood and come from experiences in life, abandonments by women, PTSD in war, alcoholism, chronic brain injuries. So you can't at the end be a pathologist and say, this is what did it. But at the end, it's a drama that's a heart racing drama of almost like a guy on bareback horse, you know, riding in a thunderstorm with these 20 horses behind him of the apocalypse that are just trying to overtake him. And at the end, they do. Which one got him? I don't know. Probably all.
We'll be right back with more from documentary filmmaker Ken Burns. Welcome back to Influencers. I'm Andy Serwer, and I'm here with documentary filmmaker Ken Burns. You were kind of the OG, the original gangster of this modern documentary era, though. And, now it's sort of spread out, I think, to a really great degree because of your work. You have this arrangement with PBS, but, HBO has, of course, gotten in the business. Netflix. What do you make of the world of documentary films right now, Ken?
Well, in 85, we were talking about what a great golden age it was, because documentary is a very weak word because it means, what, Michael Moore was doing, what, some of this, there was a film called Streetwise. It was Errol Morris's stylized thing. It's the self-involved films like Ross McElway's Sherman's March.
Sherman's March. Wow. Yeah.
All of these things, My Stuff, it was just great. The whole things from right up to fiction, maybe crossing over the line to, pure documentary like Fred Wiseman stuff. I mean, there was just an amazing spectrum, and it's only gotten bigger and more effective. And maybe the success of the Civil War had something to do with people turning around and saying the cost per hour of whatever versus fiction. But look, I've been with public television my entire thing. I'm staying with them. They have one foot in the marketplace and the other tentatively out. Look, I could have gone a few years ago or 13 years ago to a streaming channel or a premium cable and say, with my track record, I need $30 million to do Vietnam. And they would have given it me. But what they wouldn't have given me is 10 and a half years. PBS gave me 10 and a half years. And they gave me 6.5 on Ernest Hemingway and 10 on national parks. I mean, we've got many projects going at once. I've got 8 others happening now with 4 different teams, and I'm not missing stuff. I'm delegating in a way because I don't have to do everything the way I did when I started off with, in knee pants in this. But the interesting model is that it's not a financial model. It's a grant model. We raise money from foundations and individuals of wealth, from the Corporation for Public Broadcasting, from PBS itself. Bank of America has been our corporate sponsor since 2006. They've signed up to 2030. We've had a kind of stable of support from foundations like the Arthur Vining Davis Foundations, the Pew Charitable Trust, the Park Foundation, stuff like that. We started a group called the Better Angels Society, which is a nonprofit that seeks money from individuals of wealth to help do these films. And so we make them as zero-sum games, not allowed to put in contingency, not allowed to put in any profit margin, and it just happens. And then when they're done, it's all zeros, and we've already moved on to the other projects that we're working on. What that gives me is total creative control, which is I live in rural New Hampshire. This is my barn, because I do not want to sit here having a conversation with you and saying, well, they wouldn't let me do this and they wouldn't let me do that, or I really wanted to work with that writer, or I really wanted this person. And if you don't like these films, it's all my fault. I mean, in this case, it's Lynn and my fault because she's the co-director, but it's our fault. And that's the way you want it to be. No excuses.
How do you pick the subjects for your films and what's on tap? What are some of those 8 things, Ken?
Yeah, so they pick me as the glib answer, Andy. That's not fair. It's like the way you choose. I have lots of ideas. If I were given 1,000 years to live, I would not run out of topics in American history. I'm not going to be given 1,000 years. And so right now in my late 60s, there's an urgency to try to do as many as I can. And so we're doing as many as I physically can. And it's 7 days a week, 24/7. It's exciting and exhilarating. And I don't even think of it as work, though it is work in a really good way. It's hard. It's disciplined. The people I work with are terrific. So this fall, September, so it's summer, we'll have a 4-part, 8-hour biography of Muhammad Ali. We are and we just locked it. We're now doing the mixing and other sound cutting and mixing and finishing. We've got a biography of Benjamin Franklin, 2-part, 4 hours, difficult, no pictures, no footage, right? 18th century subject. That will be out in 2022. And in 2022 or probably 2023, another film that we're in the editing is a 3-part, 6 hours on the history of the Holocaust and the United States. So what we knew and when we knew it, what we did and what we didn't do and what we should have done. Very complicated. We're working on a biography of an animal, the buffalo, the American bison. It's the story, obviously, of not just the animal, but the people who used it as sustainable to their lifestyle for hundreds of generations. And then the people who came in and in less than a generation brought it to the brink of extinction. And I'm happy to say those very same people then said, oops, and have brought it back from the brink of extinction. I'm doing a big series, The Next War, after Civil War, the Second World War in Vietnam, on the history of the American Revolution. Another hugely difficult thing, because it ain't 55 white guys with powdered wigs in Philadelphia and Lexington and Concord and Washington crossing the Delaware, and then 8 years later they surrender at Yorktown. It's really complicated, involves lots of people. We're doing a history of a life after emancipation in America, Reconstruction, the collapse of Reconstruction, the Jim Crow era, leading up to the Great Migration, when African Americans finally, after the First World War, the Tulsa riots are an example of why you might want to leave the South, began to leave and move up. We're also doing LBJ and the Great Society. These are all underway. And the final one is the first non-American topic, which is a biography of Leonardo da Vinci, which takes us even farther back in time.
Sounds like you might have some conversations with Walter Isaacson with at least.
Well, Walter's we've interviewed just spectacularly. He's a dear friend and has been for years and years and years, and gave us a spectacular interview for Franklin. And that film is, I'd say halfway done. Yeah. And we're looking forward to the conversation about of Leonardo with him.
Leo, right.
Well, people say Da Vinci, and that's like saying of Manhattan or of Walpole.
Right. We'll have to ask DiCaprio, if that's okay. Yeah. So this is all such a far cry, Ken, from Brooklyn Bridge, which I believe was your first film in the 1980s. I mean, it's this huge enterprise, and that's amazing unto itself. But I'm curious, how do you think your films are different now from the beginning? How have they evolved? How's the actual filmmaking changed?
Well, filmmaking's changed a lot technologically, but we're trying to do it the same way, handmade. I mean, I edited Brooklyn Bridge like in a little cabin right next to this barn here. I've been living in this house for 42 years, and this is where I live. This isn't like the weekend or the vacation house or the place I escaped to in COVID. This is where I live and work. And so the process is not different. I hope we're better. I'm better as a filmmaker. I think I am. Stuff is more complicated, but we've tried to keep it handmade. And so each of the groups are intimate, and it's not a big deal. They're labor intensive, which make the budget seem like indie feature film budgets, but because they take 10 years, and we've got a lot of people working on them, but not that many. I mean, Vietnam, which is probably the most complex of all the films and one of the longest at 18 hours, is basically 15, 16 people are mostly responsible for it.
We're going to take a quick commercial break. We'll be right back with more from Ken Burns. Welcome back to Influencers. I'm Andy Serwer, and I'm back with documentary filmmaker Ken Burns. Many of your films give an authoritative account of a quintessentially American topic like jazz, of course, the Civil War. Is that harder to do as America has become more politically polarized, Ken?
No, not at all. And we are politically polarized and on the surface, and that surface may destroy us. I mean, this is one of the most challenging times, if not the most challenging time in American history. I don't want to undersell that. And certainly the combination of the three viruses, COVID, that's a year plus old, and the 402-year-old virus of racial injustice and white supremacy, which is having, we hope, a sustained reckoning right now. And then the age-old human virus of lying, of misinformation, of conspiracy, of paranoia. These are always there, and they bubble up to the surface. You know, the great writer Isabel Wilkerson in her book Caste talks about this, anthrax that was frozen in the Siberian tundra. And then when global warming heated it up, people started dying again. And so I think this is the metaphor for us too. This hatred, this suspicion of the other. Look, one way to do this, Andy, is just tell you, I have been for 45 years making films about the US, but I've also been making films about the lowercase plural pronoun of that, us. And what I've discovered, all of the majesty and the complexity and the contradiction and the controversy of the United States, but all the intimacy of us, is that there's only us and there's no them. There are a lot of people out there making lots of money on them. And it's being exploited, and the big lie is part of the combination of that. But a story is a story. Richard Powers, the novelist, said, the best arguments in the world won't change a single person's mind. The only thing that can do that is a good story. I am in the business of trying to tell stories. I hope they're good, and I speak to everyone. I do not put my politics on display in my films. If you want to ask me about what I think about something, I'll tell you. But, I've got yard signs when the elections are coming. People in my little town know how I feel. However, in the films, we tell a complicated American story. I had an example of one guy who was thinking of underwriting the Roosevelts. And he said, yeah, but, show me what you do for the New Deal and then I'll give you money. He was very conservative. And I'm saying to myself, no, I'm not going to do that. That's not how it works. Nobody can have that kind of thumbs up, thumb down with me. He's turned out to be a wonderful friend. But when he came to me after the film came out, he said, Ken, that was perfect the way you did it. Right. So here was a guy who wanted at least the anti-New Deal views to have some daylight. And we put them all in, just as we were talking about with Hemingway, about the writing that is of the period and reflecting the racism and the sexism of the time. And here's this toxic masculine guy, but also is interested in gender fluidity. So what you have to do is remind people that when we tell stories, what makes us drawn to these stories are the complexities of people, not the perfection or the absolute evil that just don't exist. Like when we use the word hero, we're always disappointed today that we have no heroes. But the hero is a Greek concept of someone who has great strengths and great weaknesses. And heroism is defined by the negotiation, sometimes the war within that person between those. Achilles had his his heel and his hubris to go along with his great strengths and great powers. So it's storytelling our human beings watching, sometimes in figures like Hemingway or Achilles writ large, to see themselves. All of us have this egotism and narcissism and gender bias and racism and all of that. And we need to negotiate it. And when we tell stories in a way that invites everybody in, Civil War or Vietnam or whatever, and says, here's what your enemy was thinking when you were firing through those hedgerows. We would interview the North Vietnamese people on the other side of that hedgerow, right? And then all of a sudden, that gives you a more dynamic view. And I don't know how many veterans have come up and said, thank you. I now understand where I was in that country, what I was doing, the foolhardiness of this, the bravery of them, the bravery of us, the foolishness of the lying of the politicians and the generals. That's all you want. That's all you want to hear, is just that this is a complex story.
I think this notion, Ken, of an agreed upon shared set of facts for Americans is so important, and it is harder to characterize, to get us to agree upon them, but that makes your work, I think, that much more important.
We have to do that. I mean, you can't say we're in a post-fact place. There are people who want that to happen. It is in the financial interests of a lot of people to promote that. I mean, if you look at the big lie, the ex-president's team raised something like $250 million between the election and the inauguration to just support something that is just factually not true. And we know it isn't because one of the lawyers arguing in his behalf about fraud that didn't exist her defense rests on the fact that no reasonable person would believe her.
Right. I love the paradox.
So give back that money because that didn't happen.
Right.
And it's just you just can't, you can't do it. You have to continue to tell the truth. And the people who don't, their noses grow longer and longer and longer, which is another good story.
One would hope. So final question, Ken. You said you're 67 years old. In Hemingway, the biographers started to flock around Hemingway. You know where I'm going here. I was just reading Remnick's review of the Philip Roth biography, and that's really about biographers coming to Philip Roth and the trouble he had. What about you, Ken? What would your legacy be? And would someone make a film about you, and would you let them do that?
Well, a couple of people have done that, and it's sort of embarrassing, and people seem to enjoy it because I've been willing to talk about loss in my life, my mother, and how a lot of what's animated my work is as a therapist. My late father-in-law said to me was, I wake the dead, and who do you think you're really trying to wake up? You can make Abraham Lincoln and Jackie Robinson come alive. I don't need that anymore. I mean, they gave me in 2008 the Lifetime Achievement from the Emmys, and I just said, no, half lifetime. Come on, we're in a financial crisis. Let's cut it from a lifetime to a half lifetime achievement. I got films I want to make, and we're trying to do that. Joe Biden, in his inaugural address, quoted a song that was in our World War II film. And it's called American Anthem, written by a friend of mine named Gene Shear. And its chorus goes, "Let them say of me, I was one who believed in sharing the blessings I've received. Let me know in my heart when my days are through. America, America, I did my best for you." I could think of no better epitaph, if that was to be mine, than the chorus of American Anthem.
Ken Burns, America's documentary filmmaker. His latest movie, Hemingway, co-directed with Lynn Novick, premieres on PBS on April 5th. Thanks so much, Ken.
Nice to see you. Thank you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.